Good morning. It is 9 a.m. on Tuesday, February 22nd. This is Yahoo Finance Live. I'm Julie Hyman alongside Brian Sazi on this Tuesday morning. Let's take a look here at futures this morning. We continue to see a lot of reactiveness to headlines out of Europe. Right now, futures way up off the lows of the overnight session, but still indicating a lower open this morning. This all as Russia's Vladimir Putin continues to beat the drums of war. We'll have the latest developments as headlines continue to whipsaw markets and as Western nations begin to sanction Russia over its incursion into Ukraine. Plus, how to play the situation via U.S. stocks, recommendations from the pros on what to avoid on Ukraine exposure. And no e-commerce spinoff for Macy's, at least not for now. The department store chain pushes back against an activist strategy suggestion as it raises its forecast for sales this year. Well, this morning we are closely following the situation out of Russia and Ukraine. And first thing we want to bring you are some developments and what we are watching on those developments. By the way, we, of course, continue to watch U.S. stocks in reaction to all of this. But this morning, we have a number of different headlines, including the idea that Germany is halting its approval process for the Nord Stream 2 pipeline. That's the pipeline between Russia and Germany that brings natural gas to that country. So let's take a look inside the Yahoo Finance Interactive at those natural gas prices, which are rising today. We're seeing a 2% increase on the session, and we actually had Dmitry Medvedev of Russia tweeting this morning about the effect of that natural gas delay, that it's going to spike prices for Europeans. So being a little bit provocative there, of course, natural gas prices have been moving higher as we have seen concerns about an incursion or invasion ramping up, down off the highs where they were in late January, but nonetheless still moving higher. Of course, we're also watching Brent. I'm focusing on Brent here versus WTI. Brent tends to be more reactive to what goes on in Europe because it trades over there. You see over the past 2 months a 29% surge. By the way, this morning it went as high as $99 a barrel. So that's something, of course, we've been watching very closely. And then one of the other proxies that we watch here in the United States, besides just U.S. stocks, which have been reactive, is the ETF that tracks the Russian markets. So that is the RSX, is the ticker on that ETF. And that, of course, has been seeing declines in pre-market trading. It is down quite sharply here this morning. All of this, as we've had Vladimir Putin say, Russia was formally recognizing two areas in the Donbas region. Now, this is eastern Ukraine. Russia has been trying to sort of form two statelets there that are affiliated with Russia, and now it looks like it is putting potentially military force behind that declaration. So all of this developing very, very quickly, including what's going on with sanctions and what's going on with Western reaction. Jen Schonberger is covering that angle for us, and she joins us now. Good morning, Jen.
Good morning, Julie. That's right. Russian President Vladimir Putin has ordered troops into two breakaway regions in eastern Ukraine as Moscow on Monday recognized those regions as independent, raising the specter for a full-fledged invasion. Now, UK Prime Minister Boris Johnson says Putin is bent, quote, on a full-scale invasion of Ukraine and is unveiling a package of economic sanctions against Russia. This as the European Union as a whole on Tuesday says it will announce a full package of sanctions on Russia. Meanwhile, Germany will not approve the Nord Stream 2, that gas pipeline built by Russia's Gazprom to transport natural gas into Europe. As for the White House, Jonathan Feiner, White House Principal Deputy National Security Advisor, on CNN this morning used the term invasion to describe Putin's ordering of troops when he was pressed on whether the term is appropriate. But the White House is officially not yet deemed this a full-scale invasion, and officials say they are going to observe and assess what Russia does and act appropriately. Administration officials view Putin's speech Monday as laying the groundwork to justify war and see an invasion at any moment. Still, officials say they will continue to pursue diplomacy until the tanks roll, but are under no illusions about what is likely to come next. President Biden signed an executive order on Monday blocking trade and investment by Americans in those two separatist enclaves of Ukraine, and will announce additional measures today, including more sanctions, though those sanctions will be distinct from the strict measures promised if Russia further invades Ukraine. Now, as for whether President Biden will meet with Putin later this week, the White House says that will depend on Russia's actions. Secretary of State Anthony Blinken will meet with his Ukrainian counterpart in Washington this afternoon to discuss next moves. No word on whether Blinken will meet, however, with his Russian counterpart on Wednesday. That was conditioned, of course, upon whether Russia invades. Guys?
Jen, thank you so much. Obviously, a lot to keep track of, so keeping it all straight for us is very much appreciated. Let's get some analysis now and perspective on the Washington reaction. That's Greg Valliere right there, AGF Investments Chief U.S. Policy Strategist. Greg, I thought it was really interesting there that use of the word invasion, right, which could pave the way for increased sanctions. The UK, speaking of paving the way, is already out with sanctions, including on individuals. Is the U.S. going there? Does the U.S. need to go there?
They have to. I think to not go there would invite the use of the word appeasement. This is something that Biden does not want to hear, especially after what happened in Afghanistan in August. So he has to consider this an invasion, and he has to unveil lots of new sanctions probably today.
Greg, looking through the prism of the energy markets, how might Russia respond to any of these sanctions that could potentially be put out there by the U.S. and other superpowers?
Well, I think Putin, who showed a really extraordinary anger, resentment yesterday in that 1-hour speech, would not react well to this. I think he has to know that severe sanctions would hurt his domestic economy. I think he also has to worry about casualties. So, no, I think the reaction would be quite hostile.
Greg, I keep trying to figure out here, what does winning look like in this scenario for Vladimir Putin? And how would that even be possible with the eyes of the West and the weapons of the West, potentially both economic and actual militaristic weapons trained on that border?
Well, that's the big question, isn't it? Is there an end game in which he could declare victory? I would say no, he does not have much of an end game. In fact, I'd go even a little bit further, Julie. I would say that he's already lost to the extent that he has now become a pariah in all of Europe. And I think that pariah label is going to stick with him for quite some time. I don't know what the off-ramp is. What I worry about more than anything else is lots of casualties in the next week or so. If there are, I think he probably has to drive even further into Ukraine.
You know, and in terms of what this has sort of accomplished for the West in a way, I mean, you know, already coming out of the Trump presidency into the Biden presidency, we have seen more global cooperation, of course, than was characterized by the previous presidency. This would seem to even solidify that even more. So again, sort of backfiring against Putin in yet another way.
I fully agree. So he wants NATO out of his life. So he's taking action that makes NATO, as you say, even more unified, even more united against him. To me, that doesn't make sense. What also doesn't make sense is that he has to have a premise that people back home in Moscow and St. Petersburg will go along with this. I think if casualties start to arrive, if you see kids come back on stretchers, that would be devastating for him politically. So I think this could weaken him politically, and I think it certainly has already weakened him in Europe.
Greg, what's the longer term impact to Russia from this?
Well, I think, Brian, that there'll be more isolated than ever, countries not wanting to do deals with them. I think this pariah label will stick for quite a while. I mean, countries have to fear Putin. I mean, if you're in the Baltics, or I think you'd have to be a little worried. I think Belarus is already gone. They've already been folded into what used to be the old Soviet Union. But I think that much of Europe would continue to view Putin with great anxiety.
Greg, let's talk about your bread and butter here. That is the political implications here in the United States from all of this. It's sort of become conventional wisdom now that it's super early to talk about the midterms, but we've all been talking about the midterms already. Is it also too early to sort of extrapolate this situation and its effect on the midterms, hoping and presuming that this conflict will have faded by then?
Yeah, you certainly hope so, yes. But I do think that it's inevitable that gasoline prices will go even higher. That is a huge albatross for Biden and the Democrats. The one perhaps bright note here is that I can't see the Federal Reserve doing a 50 basis point rate hike in early March with this kind of instability and uncertainty around the world. So maybe the rate hikes will come a little bit slower. But I think from a political standpoint, it's an economy that still has a big inflation rate. It's the whole issue of appeasement. I mean, there's a lot that Biden has to answer for. And I would have to say right now, the issue is not will the Democrats lose the House? The issue is by how many seats? And I think the Republicans could gain the House by 25 seats or so.
Yeah, and as you say, this doesn't necessarily help them in that department.
No.
Thank you so much, Greg. It's always really great to
Okay.
get your perspective. Greg Valliere, AGF Investments Chief U.S. Policy Strategist. Appreciate it. Before we leave you, just quickly wanted to check on a couple of stocks we're going to give you more details on around the opening bell. One of them is Macy's, the company out this morning with numbers that beat estimates and also coming out with a forecast for its fiscal year that is better than estimated. And it says it's not going to spin off its e-commerce business, which is something an activist have been pushing it for. Meantime, Home Depot numbers show that people are still doing a lot of work on their houses, but the company is cautioning that growth is going to slow, that effect is going to wane as the year goes on. So those shares are down 3%. Again, we will have more details on both of these names coming up in just a bit. And coming up next, we will get a view from Europe on what is going on there from Italy, specifically. Lennar Hawkins of Tomatica Research is going to join us next.
Full-blown crisis between Russia and the rest of the world. If Putin invades Ukraine, could do some damage to the global economy, to say the very least. How much damage precisely, though? For more on this, joining us now is Lennar Hawkins, Chief Macro Strategist at Tomatica Research. Lennar, always nice to see you here. So you are based in Italy. Give us the European mood on the ground right now as the situation develops.
So what's really interesting about this is it's coming at a time where we're already dealing with a bit of an energy crisis. For example, my heating bill alone in my home in Italy is up about 30%, and that's at a time where, for example, Italy got hit a lot harder by the pandemic. I think Americans can't really appreciate how hard the economy got hit here, where we were locked down completely for months, and even now it's loosening up. But the number of restaurants and retail establishments that got hit hard are profound. And then you've got all these higher costs for energy, the supply chain problems, and now we've got this, which is an even bigger headwind when it comes to energy and supply chains. I mean, I'm not sure if everyone's aware of this, but the natural gas from Russia accounts for about 1/3 of what's used in Europe. And for oil, for crude, it's a little over 1/3. So getting into a rumble with Russia and Ukraine really is going to hurt Europe in a way that not hitting the U.S. as directly. Europe is also facing problems with food. For example, Russia and Ukraine together account for about 20% of global corn exports. And 25% of wheat. Russia's the world's largest wheat supplier. So as these sanctions take hold, and if Russia decides it wants to push back, it's going to have an impact.
And this is at a time when Europe is really starting to see it's a little bit behind the U.S., if you will, on inflation starting to ramp up. So one would think that's going to hasten things along there. So from an investment perspective, how are you thinking about, in particular, that potential commodity shock in Europe?
Right. So the supply chains are a really big problem. And particularly as an investor, one to keep in mind is that there's a very big problem with semiconductors. So the Ukraine actually is responsible for about 70% of xenon. And so it's a major supplier of raw material gases, including neon, argon, krypton, xenon. And it supplies about 70% of the world's neon gas capacity. And while the proportion of neon gas that's used in semiconductors is not as high as in other industries, it's still absolutely vital to produce semiconductors. So if the supply of that material is cut off, and it isn't like semiconductors have been going so well. And then that trickles down, affecting, as we know, a big problem for the auto industry, but also, well, what we're doing right now, all the computers, those are going to get hit hard if that xenon, which I think is going to put pressure to start finding these natural resources elsewhere. And also what we were talking about with energy costs, and an interesting place, I think, for investors to look is actually at nuclear power, because, nuclear power got a really bad rap after what happened in Japan. But this move to cleaner energy is really hurting Europe. Our energy costs keep going up because we're trying to go greener, which is, everybody wants that. But the shift is expensive. Now we're facing potential political crisis with energy. That can make this nuclear power look a lot more interesting. And for investors, that means things like looking at uranium.
Lennar, you said your heating costs for your home have gone up 30%. Now, humor us here. What are you paying for a tank of gas right now in Italy? Because gas prices here in the U.S. are rising here before this really hits crisis level. Do you think this is the type of situation where these higher gas prices globally could tip us all into a global recession?
Well, historically, yes. When you've got an economy that's already starting to slow, and let's face facts, with the inflation that we've been dealing with, the household income is actually contracting, like real income is contracting. Then you've got more of the wallet is going to just pay for I must have, things like food and filling up the car, rather than the I want to haves. We've had that huge cut in fiscal spending that's about 4% cut to GDP. We're no longer sending out those checks that were really helping people struggling. And now this could only make things a lot more expensive. And that's the kind of thing. And then we're looking at the Fed potentially raising rates in this environment. And I'll point out that never before have we really seen the Fed going to raise rates when the Russell 2000, the Dow, the S&P, and the Nasdaq are all below their 200-day moving averages. It's a new time.
So, yeah, I mean, and we just heard Greg saying that this whole situation means that the Fed is less likely to raise by 50 basis points when it begins raising. Does that feel accurate to you? I mean, on the one hand, as you say, markets are getting beat up a little bit. We have concern about all of what's going on. On the other hand, you have prices going up, which is the Fed has a mandate to fight against.
Yes, but I think we have to ask why those prices have been going up. And if we just blanket it, and I hate the word inflation because it's used so broadly. If we look at what's really driving those prices and we look at where those are trending, if we exclude, obviously right now we've got a problem with the energy, but prices are actually starting to roll over a bit. And with the household wallet really constrained, this Fed tightening is more likely to just be a hard hit on asset prices at a time where we desperately need the stock market to keep going up, because that's where that extra spending has really been coming from, given that household income's not going so well, and that can easily tip us over into a recession. I would not be surprised to see the Fed hike a lot less than people are expecting. And the bond market's telling us that anyways, that it's not going to be nearly this dramatic increase.
Well, Lennar, let's just hope those prices for Krypton and neon come down, because I'm tired of paying so much for my electrical gadgets. I've just had enough of it. Lennar Hawkins, Tomatica Research. Stay safe. We'll talk to you soon. All right, it's an important day for retail earnings with results out of Macy's and Home Depot. We'll pull apart the numbers from each next.
In just a few minutes till the opening bell on this first trading day of the holiday shortened week, and we continue to have U.S. investors and global investors really grapple with what's going on between Russia and Ukraine. Russia beginning to make incursions into eastern Ukraine after essentially claiming two states there as its own statelets, as they've sometimes been referred to as its own. So Brian Sozzi, we've been going through some of the notes this morning as U.S. strategists try to figure out how to play all this. Goldman Sachs, for example, is saying that this could cause, in a worst case scenario, 5% hit to the S&P 500. So there's that commentary. You've been looking at some of the individual names that could be affected also.
Yeah, even just staying on that Goldman note real quickly, Julia. I mean, Goldman looking at a potential worst case scenario, Euro stock 69.3% decline. The Nikkei could fall about 9%. The Russell 2000 is at risk for an over 10% drop here. So Goldman, of course, I would just say dropping the hammer here. I'm just trying to shed light on investors that, hey, this is it could be a worrisome situation here for markets around the world, just not in the U.S. But also the folks over at JP Morgan put together a good list of 25 companies with outsized exposure to Russia in terms of their sales. A couple, I listed 7 in a new piece now on the Yahoo Finance homepage. A couple notables that stick out. McDonald's, 4.2% of their sales actually come from Russia and Ukraine. Mohawk Industries, they're one of the largest makers of tiles and carpet. 4.3% of their sales come from Russia and Ukraine. PepsiCo, 4.4% of their sales come from Russia and Ukraine. Now, even Philip Morris, 8% of their sales from this region. Arconic, 9.4%. So you get the point. There are some big, large multinational companies with a lot of exposures here. And it is interesting, Julie, we're not seeing these stocks move much here in the pre-market here, despite those exposures. But still, it's something to very much keep in mind here if you're investing in these companies.
Yeah, I mean, I think to, again, come back to the point that the Goldman note makes, you're talking about worst case scenarios here, right? So in order for a real hit to earnings for some of these companies, the fallout here would need to be much broader than it appears to be at this point. And we just don't know yet. It seems like there are still some diplomatic channels being left open. We don't know yet how severe this conflict is going to end up being. So perhaps investors are sort of waiting here before they react. But I thought Lennar made some really good points a few moments ago in that conversation that shows it's, of course, not just companies that have direct revenue from Russia and Ukraine. It's the supply chain effect. So if you see a shortage of certain gases that are made, that are integral to various tech manufacturing processes, then you're going to have more the exacerbating of the already bad supply chain issues for the semiconductor industry, for example. And there you also see the direct effect on the RSX, which is the ETF that tracks Russian stocks that's trading sharply lower. So, Saz, there's a big ripple effect here potentially.
No, and make no mistake, consumers in the country, if not around the world, are very much concerned. Google searches for the word recession have been on the climb the past about 3 weeks. That is, I tweeted that out over the weekend. You have gas prices in California approaching $5 a gallon on average. That is a major increase. And one of the top stories on Yahoo Finance for us the past week has been this view that if this invasion does happen, perhaps we get gas prices going to $7 a gallon, as Dan Dicker told us last week. So there's a lot of angst out there. Make no mistake about it.
Yeah, there is a lot of angst out there. And also, by the way, on the flip side, something that might alleviate the oil supply situation, it looks like we are close to another nuclear agreement with Iran, which could then unlock some of the sanctions there and get that oil flowing to other areas of the world where it hadn't been, including the United States. So that's something also that could mitigate some of the effect. But this morning, we're not necessarily seeing that mitigation as we are watching energy prices continue to climb. We've been watching oil, we've been watching natural gas, we've been watching all of those various other commodities, including metals and ags, that have been climbing on concerns about a cutoff in supply there. There you see crude oil futures. That's WTI. Brent is even higher and touched $99 a barrel this morning. So all of that factoring into investment decisions this morning. And Brian, I think we should really put a fine point on this. We now seem to be having an increasing drumbeat that if Russia and Ukraine continues to worsen, the Fed is less likely to raise by 50 basis points. I mean, that's a really important point here, because it seemed like last week people were saying the Fed needs to raise by 50, right? That's what the market wants them to do. Now that seems to be waning a little bit.
But still raise. I think that's the key takeaway, and it's ultimately why you have, I think, the market in a very hard spot. Fed's in a tough spot here, Julie. Very tough.
Yeah, the Fed's been in a tough spot, and this doesn't make it any easier as we look to this opening bell on this Tuesday. So opening bell here, we are coming off of 2 straight down weeks for the major averages. The Dow, the S&P, and the Nasdaq all fell last week yet again. So we've been seeing this pretty dramatic uptick in volatility as of late. You already had an uptick in volatility because of rising inflation, because of the debate over central banks and how much they're going to move, particularly the Fed. And now you have Russia layered on top of all of that. So we are seeing the Nasdaq out of gate this morning down by nearly 1%, leading as it has been to the downside. So amidst all of that, we still got some earnings to talk about, Brian.
Yeah,
As if that
just
wasn't
refuses to
enough.
stop.
Let's start with one of your perennial favorites, Macy's. I think they're taking your advice, Saz. They're not going to spin off their e-commerce operations. You had questioned the logic of that move, which is something that an activist investor had been pushing for. And Macy's sort of has a little breathing room here, it looks like, because the company came out with numbers that beat estimates. Comp sales coming out better than estimated from investors, so from analysts rather. Revenue beating, adjusted earnings per share beating. The company's forecast for the full year, it's looking for at least earnings per share of $4.13. Analysts had been looking for $3.98. And the company's sales forecast for the full year is also ahead of estimates, Saz.
Hey, Julie, be right back. I'm going to go take my victory lap around my kitchen. Hold on. Rich, hang with me. No, of course. Macy's not going to spin off its e-commerce operations. This has been the hottest thing in retail really over the past year and a half. You have these financial wizards here plugging different scenarios into their Excel spreadsheets, and they present to the various retail boards that maybe they should be spinning off their e-commerce business. It makes no sense. On paper, of course, it does, but these businesses make a lot of sense to keep internally. And I think Macy's came out here they came out here today, well thought out decision. I've been critical of Macy's, but this was a very well thought out decision by them. There's a lot of costs associated with potentially spinning off an e-commerce operation, and costs you can't even measure, potentially missed packages to people's homes here. So Macy's board is a very strong board. It does make sense they're keeping this business in-house. What is interesting too, Julie, is just the quarter out of Macy's here. You have Macy's same-store sales up 6.1% versus the fourth quarter of 2019. That is pretty good. Bloomingdale's up 13% versus the fourth quarter of 2019. That is good. They also came out here, reinstated their dividend, about 15 cents. Now, it's not the same level as it was when Macy's was paying about a 38-cent dividend in March 2020. That is when they cut it, really when the pandemic was raging on. But by and large, it was a pretty decent quarter for Macy's. Now, the real question is, what does this business look like later this year as they start to cycle some of these tough sales comparisons when everybody's been stocking up or restocking up on their clothing because they haven't bought anything during the pandemic. So that would be much more interesting to talk about.
Yeah, and just a couple of other notes here. In addition to that dividend raise, the company also has a new share buyback authorization of $2 billion worth. So returning cash to shareholders in a couple of different ways there. And one more thing that stood out to me, that's the gross margin last quarter, Saz, 36.5%, which is an improvement year over year of almost 3 basis points. It's also ahead of estimates. So in this environment, as you know, for anything consumer facing, there's been a lot of focus on margins, and the fact that they delivered in that department, I think, is also pretty key.
Yeah, I know. The margins were down 30 basis points versus 2019, which of course makes sense. Various lines of inflation in there. But this is a company that's cut a lot of costs, Julie. And I would say this was the first quarter, really, all those cost cuts, those hundreds of store closures over the past 3 or 4 years really started to show up on Macy's financial statements. But again, if you're listening to this Macy's earnings call this morning here, you really want to watch out to see if they've seen any resistance, the consumer, to some of these higher prices that Macy's started to push through. Why? Because it's vendors. It's Nike. It's an Under Armour. All their vendors are out there increasing prices right now.
And when you were talking about what's going to happen later this year, that really appears to be the central question for Home Depot. Flipping on over to that one, which was also out with its numbers this morning, because it says growth is going to decelerate in 2022. I guess the party couldn't last forever when it came to people spending to improve their homes. Home Depot has been a prime beneficiary of this. Comp store sales last quarter, 8.1% increase, which is a pretty hefty one and came in a lot better than estimates. You can see revenue, adjusted earnings per share also beating estimates. Here, Home Depot said it was, or the implication is it was benefiting from higher prices because customer transactions, the number of transactions fell by 3.4%. but the average ticket went up. So in other words, people are not going as much, but they're spending more when they do go, and that implies that at least higher prices were a part of the picture here. Home Depot is saying for earnings per share this full year, it's going to grow in the low single-digit percentage. The increase last year was 30%. So that's a pretty dramatic slowdown.
This market response to these results, Julia, frankly, has put me in a bad mood. It's dumb. It's a dumb market response. This is a very good quarter from Home Depot. They put up an 8.1 from a very well-run retailer, I would say. Let me just add that too as well. 8.1% same-store sales increase. Last year at this time, they put up a 24.5% increase as people were locked in their homes or investing in their homes. But still, to put that type of sales increase against on top of a very, very strong result last year is very impressive. And their operating profit margins were up about 75, 80 basis points year over year. That is very good in this inflationary environment. And then lastly, too, their inventory up 33% year over year, which tells me they have entered this quarter with momentum into the key spring selling season. Of course, a lot of the inventory reflects higher prices because that merchandise is coming in off of ships at higher prices versus last year. But still, it looks like Home Depot is making a bet this will be a strong spring buying season for his business.
But you're looking back. You got to look forward here. That's what the stock
that's why I'm looking at
about.
inventory. I'm looking at inventory. That is a good forward-looking indicator. But still, this market response is stupid. Hate it.
Well, the company says their operating margins are going to be flat this year. So that's if you're going by the margin story, that I know you got your tea leaves, but when the company itself is telling you that things are going to slow down, sounds like the market's listening. That was quite an emotional roller coaster from you, from the victory lap to you being upset about the stock reaction. Home Depot.
You never know what you're going to get. You know what? Actually, Julie, I'm going to go out this weekend and I'm going to buy a bag of concrete to support Home Depot. I have a one-bedroom co-op, but still, I don't need concrete. I'm going to go out there and buy some concrete. I'm going to put it in my living room.
Okay. I don't know what you're going to do with that concrete. I look forward to seeing what kind of home improvement project you can potentially do with that. Fashion yourself a new desk out of concrete, perhaps.
Okay.
I don't know, but I can't wait to see what that's going to be. But first, before that, let's go. We're going to go to Jared Blickery when we come back from the break on the floor of the New York Stock Exchange. We'll find out what he's buying from Home Depot this weekend. I bet it's not concrete. We'll be right back.
Let's head down to the New York Stock Exchange and check in with Yahoo Finance's Jared Blickery. Jared.
Yes, let's go straight to the Wi-Fi Interactive, where notably everything in the U.S. is underwater right now. But I want to take a step back, take a longer-term picture, a 2-month look at the S&P 500. As feared, as I was pointing out with the possibility last week that we are going down and testing now these lows. The question is, how low do we go? Do we exceed them? What you want to see is a strong reaction to the upside, and that would create a candle with a long tail or wick like we're seeing over there. So we could easily hit 4,200. We could easily hit 41 or 4,000 even. Have to see where we end up. Probably have that momentum low already in, but then now we're looking for that price low. So here's the sector action for today. Energy. I'll give you 99 reasons why energy is up today. That would be Brent hitting almost $100 per barrel, but to the downside, we're seeing some weakness in those consumer discretionary retail stocks that we've been talking about, like Home Depot. That sector is off 1.5% to the downside. And just want to check out some of the action here. Here's Brent hitting $99 and change, 97.91 right now. It's up 4.5% on the Russian headers. We got RBOB gasoline at the highest prices, I think, in at least 52 weeks. That's up 3%. Also checking out gold as well. We're seeing that catch a bid, and we've seen it break to the upside very recently. As I've said, I think we have momentum to go quite a bit higher here in gold, though we may take a pause around $1,900, $2,000 per ounce. And also natural gas. We've been talking about the situation with the Ukraine and also how Russia really has a stranglehold on Russia. So all in all, really seeing the futures light up here, just not really seeing it in the stocks, guys.
Yeah, we are not. But another place where we've been watching for reaction to all of this is actual gold and digital gold. And one of them has been benefiting more than the other, which has been interesting.
Yeah, and I'll tell you what, I'm looking at a Bitcoin chart right now. We've seen Bitcoin and equities move together only on the big move. So if we have a big downdraft based on Ukraine headers or inflation headers in the stock market, in general, we're seeing crypto follow, and not the best overnight or over the weekend price action, given that extended stay that we had from the markets. We're seeing the lowest levels in several weeks here, and you take a look at a 2-month chart, really just testing these lows. So we had the beginning of a short-term uptrend. Looks like that's probably negated, not out the window just yet, but not the best technical information or technical presentation setup that we're seeing in Bitcoin right now. Also want to check out some of the other tokens. Ethereum down 3.5%. We can see their chart, the Ethereum chart, pretty close to Bitcoin. Haven't really tested these lows just yet, but trying to head down there. And then Ripple, XRP, we see that approaching the lows from last week and last month as well. So interesting to see how some of this equities volatility to the downside has also spilled into crypto.
Indeed it is. Jared Blickery, thanks so much. All right, Julie, out of everything that's going on today, the top ticker, the top trending ticker on the Yahoo Finance platform right now is Digital World Acquisition Corp. Of course, that is the SPAC that is supposed to merge with former President Trump's media company here, and it comes following the release of Truth Social. That is the former president's new social media app. And Julia, I tried to sign up for the app this morning here, and I guess I joined a long list of folks here that have not gained entry to this. So as you can see there, I tried to sign up, and I got put on a waiting list. You know, I'm interested to at least try this out, see what the platform is all about. But from some of the people that have been able to get access to it, it looks like it resembles Twitter, except it shares truths. So you don't tweet, you share truths, and you can retweet or retruth truths. I can't even get this stuff out of my mouth, but nonetheless, this is what's happened. So I will keep you posted if I do gain access to the special club. Maybe you can join with me, Julie.
I didn't realize that they were called truths, which is
truths
possibly
and retruths.
The most ironic thing that I have ever heard in my entire life. Mm-hmm. That yeah. I didn't realize that they themselves were called truths. So that mm-hmm. when Trump truths, I can't. What I can say is that the Digital World Acquisition hasn't completed its actual de-SPACing of that Trump media company as of yet. It was announced in October. Not sure when it's going to happen, but it did get $1 billion PIPE in the meantime. from investors, and certainly retail investors have been pouring into this thing. We talk about SPACs coming public at $10 a share, and some of them, by the time they actually de-SPAC or complete their merger, they're trading under $10. And that's obviously not the case in this particular situation. But, when you join the big boys, you got to actually have an operational product. So, but it doesn't seem to be hurting the stock today, even though they couldn't fit everybody on the platform. I don't know. I don't know that Twitter have ever had a problem signing up for Twitter.
I've never had any problems, but Julie, I will keep you posted on my progress here in gaining access to this club. I encourage anybody on the platform and searching for me, only send me truths about the markets. I can't wait until this other stuff. But speaking of truths here, let's look at the good old Yahoo Finance stat of the day, which is always loaded with many truths. Half of the stocks in the Dow Jones Industrial Average are down 5% plus year to date. The two worst performing Dow components are 3M with a 17% drop in Salesforce with a 23% decline. Both, again, are truths. All right, coming up, shares of Macy's and Home Depot on the move after reporting earnings this morning. We'll dive into those results and just discuss the state of retail next.
We got some breaking economic data just a few moments ago. The PMI numbers, Purchasing Managers Index numbers from market coming in for manufacturing, the preliminary February number at 57.5. So that is a rebound from an 18-month low in January. Services PMI ticking up pretty strongly to 56.7. That is above the 53 estimated, and also a big jump from January. And that means the composite of the two numbers comes in at 56. Remember, anything above 50 is expansion, so expanding at a faster rate. I'll take a look to see how much increased prices had to do with some of these numbers. And speaking of increased prices, That's something some of the retailers have been benefiting from. We heard from Macy's and Home Depot this morning. So let's get some more detail and perspective on that. Sucharita Kadali is joining us now, Forrester Research retail analyst. Good morning, Sucharita. We are looking at these numbers, particularly for Macy's, that show perhaps some surprising strength in apparel here. The people are still going out there, they're buying, and we don't appear to be seeing price pushback. Is that your interpretation as well?
Well, I think that a lot of these numbers that we're seeing are really a reflection of a strong Q4. We knew it was going to be a strong Q4 because other retailers had been saying that it would be a strong Q4. I think that what is going to be the big question is that Macy's seemed to have a strong outlook for 2022, which does suggest that it's maybe a little bit more bullish than other retailers who are wondering if consumers will continue to be purchasing in their categories that are particularly discretionary, like apparel and footwear, and how they will actually purchase with respect to these higher prices. The truth is that there's a lot of competition in apparel. There's growing competition in apparel, particularly with a lot of these online Chinese sellers. So even though I have no doubt that they had a great Q4, which was really just the lingering effects of people purchasing because they had held back purchasing through the pandemic. I'm not super bullish on the 2022 numbers. I think that apparel will be much, much softer, especially for the U.S. retailers.
Do you think Macy's then is just being too optimistic for the year?
It sounds like they're being very optimistic, and they may be really optimistic for good reasons. I mean, you have to remember that they're in the middle of an activist discussion right now where there are investors that want to break out its .com business, that want to split up the company. And that would be pretty deadly for Macy's overall. So, even though some shareholders may benefit, the employees would really suffer, landlords would suffer, and that would probably pretty much mean the end of Macy's, I would say. So I think that, it is in their interest to be as optimistic as possible and to try to persuade investors that Macy's is actually operating from a position of strength.
Sounds like you agree with Brian Sozzi on that point pretty strongly. I want to move to Home Depot because this is a very different story where they're not being optimistic for the full year. So while we have definitely seen a very strong business trend fueled by home improvement, do you think that they're being overly pessimistic on the flip side?
I think Home Depot is actually being pretty realistic. I think that what we saw in 2021 was just the all of that the energy and the demand that we had suppressed in 2020 was coming out in 2021, and now we have everything from supply chain issues to inflation issues, and Home Depot isn't necessarily expecting a bad year. They're just expecting that demand will probably stabilize. And I think that is, and it's still going to be figures that are higher than 2019, which you have to remember are some of the highest spending years on record. So I think that overall, they're just expecting a little bit of flatlining of demand, which makes complete sense. But the market's reaction, and this is one thing that on the one hand, I see Brian's point of view that it's a little bit of a stupid reaction, but here's the other side, which is that Home Depot now has a valuation which is nearly as high as Walmart's. So that's really the question. Is it just a correction because of a belief that maybe, the bulls are a little bit more bullish on Home Depot than they should have been in the first place? Or is it really just, investors, taking some of their gains, recognizing that Home Depot may be a little richly valued for where it is, or maybe Walmart's undervalued?
So, Trita, I have 15 seconds left. Is this the perfect environment for a Target and Walmart?
It is a good environment for the two of them because you do have, they're going to do well no matter what. They do well in any economy. Where we're heading into is, people may be trading down. So the question is, how much of the merchandise do they really have? I think that's who's going to continue to win in 2022 is who has good inventory and who has the right products that people want to purchase. And we're still seeing supply chain issues, and until that gets sorted out, we probably will see more concentration with some of these large multi-category retailers like Walmart and Target.
So good, but not perfect. Brian, he's always wanting the superlative. Sucharita, thanks so much for your perspective. Sucharita Kodali, Forrester Research retail analyst. Have a great day. Thank you. We're going to have a market update when we come back as we see the S&P and Nasdaq turning a bit higher. We'll be right back. Well, we are seeing a little bit of a bounce here in the major averages, at least 2 out of 3, and a bounce to unchanged. But nonetheless, a little bit of optimism appears to be creeping back into the market, even as the Dow remains lower by 0.4%. We're going to continue to watch the Russia headlines and bring you the very latest and the reaction to them as we head through the next hour. We'll also be talking about the commodity effect in just a few moments. Plus, we're going to have 2 back-to-back executive interviews. First, you're going to have a treat. Then you're going to run it off. We're going to talk to Krispy Kreme CEO Mike Tattersfield after the company reported earnings this morning, and Brooks Running CEO Jim Weber after the company saw record growth in 2021. Keep it right here.
Welcome back to Yahoo Finance Live on this very busy Tuesday morning. I'm Brian Sozzi alongside Julie Hyman. It's mostly a risk-off morning for markets as traders stay glued to the developing situation between Russia and Ukraine. I say mostly because we have seen a bit of a reversal here in markets. At one point, just a few minutes ago, you saw some of the major indices in the green, but now they are all in the red. The Dow is down 140 points. The S&P 500, Nasdaq also in the red. Now, Julie, over to you. Some breaking news on consumer confidence.
Yeah, consumer confidence as measured by the Conference Board for February coming in better than estimated. 110.5 is the reading for the month of February. 110 is what economists have been looking for. It is also, by the way, comparing with a downwardly revised 111.1 in January. So even though it's better than estimated, represents a little bit of a drop from consumer confidence in January. Present situation, how people are feeling right now, 145.1. Expectations much lower, 87.5, and that is a drop from where we saw it in January as well. So definitely some concern about the future appears to be baked into these numbers, and it comes on the back of those PMI numbers that came in better than estimated just a few moments ago as well, Sauce.
All right, let's stay on consumer confidence here because that will be an interesting report to watch moving forward, just given where oil prices have gone and where they could be headed. Let's dig deeper into the oil trade now with Bill Baruch, Blue Line Futures President. Bill, always nice to get some time with you here. When might we see oil break through $100?
Well, thanks for having me on again. I always enjoy joining you all. I've been calling for oil to go for 100. For about a year now, and I think we're basically there. I mean, I wouldn't, the number $100, I think will get hit at some point. But this run, I mean, when you look at a move that's created from a news event, we've basically had this sort of jump last night, overnight, and that can bring some capitulation. I would not advise chasing oil at these levels. This is going to be the tough money sort of area to look at. Now, if a real conflict starts to develop, and that takes place, I think we could be through $100. And I don't think the overall rally in oil ends until we have $5, $10 days and swings that are more where there's a lot of pain, 120, 150 bucks. But right now, I'm looking for a pullback to bring opportunity.
And so let me just get this straight. So first of all, does this conflict need to heat up for oil to continue to move higher this year? I guess would be part one of that question. But it sounds like you think we're going to go much higher before we go lower.
Yes, you get this type of move. I mean, look what happened last April. And I mean, obviously, everybody talks and knows about this negative move in oil. And I think as same way moves to the downside can be exacerbated, I think we're going to get it the same way to the upside. And I don't think the upside move ends until then. Now, there are other factors at play here right now because the Iran nuclear deal is something that's on the table. And when those headlines were hitting last week, we saw prices come in a bit. Now, what does that mean here with Russia, Ukraine? Is the U.S. and Europe, are they more inclined to get a deal done soon due to potential sanctions? And then you also have Europe pushing back on sanctions on Russia that involve energy products. So there's a lot of question marks right here, right now. But one thing I'm pretty confident in is the Iran deal is to buy the rumor, sell the news event. In other words, actually, because oil would be lower, you would really be buying the news if oil is lower on an Iran deal. I think Iran's oil is being factored in quite a bit, and I think that OPEC Plus would also constrain their oil the same way they have in their production deal across the entire pact.
Well, I can't seem to get a good answer on this one, so perhaps you can help me. So oil over $100 a barrel, is that $5 gas? What point do we see $6 gas? What equals $7 gas? How should investors think about these moves?
I think that once this move takes place, and if we get above 100, it's more about how long we hold above 100. How quick can the government potentially? I don't think Washington is really stopping oil from going above 100. But what maneuvers can they make? We've heard from shale already that their production levels are really not going to return the same way that we saw it previously. And been overweight energy companies, and I really like energy companies right now. I think there's great value within there because they're playing the long game here. So I don't think that once oil gets above 100, there's going to be a lot of reason for it to fall back unless you have that capitulatory type action among market participants. And so again, it's a tough answer because it matters how long it's up there. Once oil gets above there, obviously gas prices for the consumer are going to be raised, and once they get raised, it's tougher to see them pull back. So I do think we will see gas prices peak some point in June through July during that summer driving season, and then potentially dissipate through the back half of the year.
And I'm not trying to be too gloomy here. I'm just trying to handicap, what could happen, because this is how investors or traders are thinking about these things. Are gas supplies so low right now that we could see lines at the pump again, like the 70s?
I don't think it's a tough answer again here. I don't think that's what we're going to see. But one thing when we're looking at what is driving oil right now is looking at inventories at Cushing. And we're looking at inventories at Cushing have slipped below the drop that took place in October through November. We're looking at inventories going back to, I think it's 2018 levels. Those are the things that I'm watching right now. If on these weekly reports, if we continue to see drawdowns in inventories at these major hubs, that's what's going to drive prices. And gas lines, I mean, if Washington gets more involved and they're trying to bring down prices, I mean, gas lines aren't necessarily going to drive. They're not going to help. I think they would really drive prices higher to some degree and give pricing power to the provider. But again, there's a lot of moving parts within that. And what I'm focused on is how I can make money today, tomorrow, and next week, and the rest of the year for my clients. And I don't think that's by chasing oil right here, right now. Although I'm watching 93.50, 93.83 on a closing basis and crude futures. And I remain overweight energy stocks because I like the companies being priced to $60 oil, $65 oil right now. You are getting Citi and you're getting Bank of America. They're all both calling for Brent to get back to $80, and they do expect the demand situation to sort of calm in the second half of the year. So that's something that to keep in mind. And another part of it is gasoline. Everybody really talks about gasoline through the driving season. Well, it's really the run up to driving season where it makes the move. So again, you want to, as a trader or an investor, you don't want to be chasing these moves around. And another thing to really take to heart is it's never as bad as it seems while it's taking. It's never as bad as it seems while it's taking place. So again, patience it rules all.
Bill, I got to ask you about natural gas also, because there too we've been seeing an increase, but unlike oil, it sort of spiked in late January, came back down. It's still moving higher, but hasn't regained that high. We're coming out of winter. And so what can we expect unusual seasonal moves for natural gas given what's going on?
Well, unusual seasonal moves, they don't call the March-April natural gas spread the widowmaker for no reason. So that's what I think we're going to see, unusual seasonal moves. I mean, right here in Chicago, I mean, we had 50 degrees the day after basically 0 degrees Fahrenheit. So, yeah, we're going to continue to see driven moves here amid the U.S. weather as it cycles through. But when we talk about U.S. natural gas, I mean, it traded to a high of, I think, 480 last night, and we're back below 450 at some point here this morning. That range, I mean, we've already backed off as that situation in Ukraine has escalated. Natural gas prices in Europe, I mean, are at least double at times what we're seeing here in Europe. I mean, here in the U.S. So there's different components. Now, Nord Stream 2 has been stalled, by Germany, keeping a pulse on that and where where gas is going to be provided is going to be a big question mark. But again, I think we're going to see seasonal swings, and there's a lot driving this market right now outside of only Ukraine, Russia.
Right, definitely. Finally, I want to ask you about palladium, because we keep showing this chart that shows just how much of the globe's palladium Russia provides, and it's a lot. So what are you telling clients when it comes to that?
Well, I wish, the CME has done a terrific job in bringing micro contracts and tradable contracts to to the retail masses as well as institutional investors. And palladium is a big contract and it moves very fast, so it's a tough one to trade and get a pulse on. I mean, there's some ways to invest in it otherwise, but what I'm watching here most closely is the move back above the 200 moving average this week and kind of holding out above there. And it's moved to $2,400. It's a nice, real round out technical move that's getting these obvious fundamental and geopolitical tailwinds right now. I mean, palladium, it's already a scarce in supply due to many facets of demand. And right now, I think as it moves higher, it looks bullish technically. But again, I mean, the same way I'm looking at crude right now, the same way I'm looking at natural gas right now, we're getting less certainty almost here by the day. The fact that Russia did move and recognize those two states and Ukraine, I mean, we're moving closer to the end than where we were, I think, last week. And markets, again, they hate uncertainty, but I think we're getting more known knowns as the days go. And if that's driving up palladium and crude here in the near term, I think we're going to have better opportunities to invest in those commodities and maybe, the next month or two.
Bill Baruch, Blue Line Futures President. Always nice to get some time with you. We'll talk to you soon. All right, SoFi is making its first sizable acquisition as a public company. Julie is back with the details next.
SoFi said today it is buying cloud-based banking platform Technisys. It's an all-stock deal valued around $1.1 billion, and it's SoFi's largest thus far as it expands its fintech capabilities. Under this deal, Technisys shareholders will get 84 million SoFi shares. That's less than 10% of its share count. The deal expected to close in the second quarter. SoFi shares are trading off by about 4% on the announcement. Meantime, Volkswagen, along with Ferdinand Porsche's family, announced today they're in talks to take Porsche public. The car manufacturer said it worked out a framework with Porsche that still needs approval by both companies. An IPO would provide Volkswagen with extra income to pursue its push into electric vehicles and self-driving cars. Those shares in U.S. trading are up by about 5%. And AT&T is shutting down its 3G network today. That means older smartphones and devices that ran on the network will no longer work. Verizon first launched 3G in 2002 at a time when BlackBerrys were the top smartphones and iPhones were still in the distant future. And if you still own a 3G phone or a phone that doesn't support HD phone calls, it will no longer make or receive calls. Outside of cell phones, though, the shutdown could affect a lot of other devices, e-readers, vehicles' SOS systems, home alarms, medical alert devices, other older tech that relies on the network. T-Mobile and Verizon have yet to take down their 3G networks. Sprint's will be decommissioned on March 31st, T-Mobile's on July 1st, and Verizon plans to take down its 3G at the end of the year, December 31st. Saz?
All right, U.S. soccer and women players have agreed to settle an equal pay lawsuit. Yahoo Finance's Josh Schaefer has the details. Josh.
Yeah, Brian. So the U.S. women's national team players, this is current players and some past players, reached an agreement with U.S. Soccer for $24 million. This is over pay inequity and compensation that kind of dates back several years now. And the other big part of this agreement that we should point out is that they've also agreed to equal pay for between the men's and the women's national teams moving forward. Now, U.S. Soccer noted in its official statement this morning that equal pay in the future isn't guaranteed until a new collective bargaining agreement is ratified. This has been a long process, guys. This is something we've been following for about 6 years now. And it really dates back to 2016 and then became a huge story during the World Cup in 2019. The women's team marched on to the World Cup championship that year. It was their second straight win at the World Cup. And you can kind of remember that they were really talking about this throughout that run. After the games, before the games, every media appearance, it kind of became the big talk of the town because the women's team was winning the World Cup while the men's team wasn't even qualifying for the World Cup and their pay wasn't equal. So it didn't quite make sense, I think, to a lot of folks. And we really saw at that time period, too, they became bigger and bigger stars. They kind of became rock stars when they came back to the U.S. You had Alex Morgan, Megan Rapinoe, those kind of players, and their jerseys ended up being some of the most sold jerseys we've ever seen. Nike reported that year that their jerseys were literally the most sold jersey. The home jersey was the most sold jersey ever for a single season on Nike.com. And I remember back in that summer, they did a victory tour. They had that much fanfare that they came back and did a victory tour where they played games that didn't even matter. It was just so U.S. fans could go and attend. And I actually covered one of those games out at the Rose Bowl in California. And there was about 40,000 people there that night. The place was rocking. People were celebrating the World Cup. So they were selling tickets, selling jerseys. You could see the momentum kind of building for U.S. women's soccer. It's continuing to build, and I'm sure we'll see that kind of carry into next year. We got the World Cup coming up in the summer of 2023, guys.
Good stuff. All right, Yahoo Finance's Josh Schaefer. Thanks so much. Coming up, Krispy Kreme CEO Mike Tattersfield joins the program to discuss the company's latest quarterly results and, of course, his new Twix donuts. Stick around. Krispy Kreme saw double-digit sales growth in the fourth quarter in the U.S. and Canada and overseas. Margins also rose 290 basis points in the U.S. and Canadian segment. The company did serve up a full-year profit outlook for this year that was slightly below some analyst estimates. Joining us now is Krispy Kreme CEO Mike Tattersfield. Mike, good market response to the earnings report today, and I would say part of it is just the sales gains you guys have put forward. Where are you seeing some of these sales gains the strongest right now?
If you think about the business transformation that we've done, Brian, has been pretty phenomenal, right? You took a slow growth business, which was capital intensive, primarily a legacy franchise business in the US. We flipped it around to a high growth, top line and bottom line focused, very capital efficient as we really run a global omni-channel model. And what that means is we really leverage our hot light shops and then get fresh donuts out in a hub and spoke daily. And when you can combine that with the seasonal aspect of our brand, this is not a daily ritual where people are coming in and having a donut every day. We really absolutely maximize the opportunities when it's around Halloween, when it's around the holiday season, when it's around Valentine's Day. It's actually our #1 day in the world, where people use our brand for those celebratory occasions. And in fact, Halloween and holiday season were tremendous. So you saw that in our performance. We delivered 12.5% organic growth and 30% EBITDA for the year. But it's about capturing that opportunity and then making sure the assortment matches. And there's pricing power when you end up really thinking about the product packaging, et cetera.
Well, Mike, just given how competitive the environment is, are you surprised that a Krispy Kreme has pricing power in this environment? You mentioned on the release that you did raise prices in September and November, but it doesn't look like you saw much resistance, right?
We did. Again, we're an infrequent brand, right? So the average user visits a Krispy Kreme 2.5 times a year, right? So when they're going to use this, it's about a celebration, and it's about a shared experience. So pricing is not the #1 feature that someone's walking into Krispy Kreme to order the dozens. What they're looking for, particularly when they're looking at those occasions, is does the product match their expectations? Whether it's the glazed hot light donut or new premium donuts that we can come out, or seasonal Halloween, and we just did our Valentine's Day donuts, which were very successful, right? So that's where you can see the pricing power coming in. But more importantly, when we really do this hub and spoke, because we only have 400 hot light shops in the world, and it's getting to 10,000 points of access, right? So it's how do we do that fresh every day? And that's the #1 attribute that customers continue to look for, because the #1 complaint we've always had for Krispy Kreme's history is, how do I get to you? So figuring out a model that we did, which is use points of access, grocers and convenience shops where we can deliver on a daily basis. You get the point of access that way, as long as you can continue to make it fresh and exceptional. Pricing happens when you can deliver against that.
Hey, Mike, it's Julie here. What you're talking about, of course, to our point about pricing, costs, right? You got to get people into those stores. You got to get the real estate, right? Secure the real estate, construction, et cetera, et cetera. So you guys are doing this expansion, but you're also talking about expanding margins. So talk to me, is all of that coming through price increases that you're going to get that margin expansion?
So the majority of what you're seeing, so we call these points of access, right? We laid out 10,000 points, and actually we even introduced that we see a 50,000 points of access. We're not building that many shops. So it's those incremental drops that we actually drive from our hubs to the what we call a deliver fresh daily, to a grocer, in a cabinet or in a tower. That's where you see this incrementality, that each spoke, which is what we call, if you're in one grocer, you have one spoke attached to that, you could have 10 grocers, that would be 10 spokes. That efficiency of each additional spoke on top of our production or our hubs is where you see the margins come through. You can take price, but we're very disciplined about price. We do plan for price increase this year, but it's pretty much around what we think inflation might be. And then we can get the premiumization of the business. And so you'll see that benefit of those hub and spoke model, the efficiency of that. When you deal with also the pricing power we have, you can see that we can really generate margins.
Mike, I've started to navigate outside my home, and I stumbled upon your new Times Square location. It's pretty grand. How many more of those locations do you want to open up?
You know, the first one we opened up in New York is pretty amazing. If you get a chance to do it, if you're in New York, I'm a visit, you'll get an idea of the power of the brand. That we're so vibrant today and what we see. We see a couple more opportunities on a global basis, but not significant. But again, it's that aspect of a hub that's also really demonstrates the hot light ability, the vibrancy of the brand. It really showcases our glazing innovations that we can do, and even unique donuts, just even for that site. So the one in New York, which is incredible with its video display, everybody in Times Square knows it's there.
Yeah, most definitely. Sazi really made an impression on him. Also making an impression, you talked about how these are sort of special occasion donuts, and you talked about some of the limited edition ones. I know you're really pumped about the Twix donut, which sounds like a lot, to be honest. I mean, that's like a treat on top of a treat. So what do you think is going to be the excitement, and how do you think this is going to do?
So we do, I mean, we know right away, right? So when you're a merchant, you can see it in either you're putting it to the delivery, you can put it through your shops, you can take it to the DFD channel. So you can see the velocity and the demand today. Today we can't, there's a lot of pent-up demand to try to get a product like this. Power Partnerships is a platform that really matters. And it really comes to life when the partner that you choose that you're partnering with, actually their product is really well represented, not just crumbled up on top of a donut, but you're really getting the caramel of the Twix cookie, or you're actually doing a full Twix cookie inside of a Long John donut. That opportunity just showcases both brands and the power. We'll continue to use that type of innovation with other brands along the way, as well as our own versions of our own donuts. But we see that as a platform that has a lot of life, not just in the US, but around the world. It's been done already with Reese's. It's been done with Hershey's and other things. Last year, we had an amazing Oreo cookie with a big Oreo cookie on top of the donut, which was fantastic. If you can get that merchant touch, it's got to deliver the taste, and then the storyline and packaging really bring it to life. And then both brands tend to be incredibly happy, because when we do it, we can sometimes generate billions of impressions, right? So a partner brand really appreciates that, because we're not spending the dollars in marketing.
Mike, how do you try all these new products you guys test? Are you eating donuts around the clock?
We don't. I do try them. I immediately yesterday I was trying the Long John Twix donut, and a father came by and says, "I'm taking one for my son." I go, "You better take two, because you're gonna have a little battle there." And he's like, "Oh, they'll be nice." But I do try. They bring unique donuts to me. I'll give them comments on glazing and this. You take a bite. You enjoy it. But yeah, I still am a huge fan of just the original glazed donut that's hot. It's incredible.
Fair enough. All right, Krispy Kreme CEO Mike Tattersfield, always good to see you. Have a great rest of the week. All right, from eating donuts to burning it all off. Berkshire Hathaway owned Brooks Running just passed a major sales milestone. We're back with Brooks Running CEO Jim Weber on the other side of the break.
Well, Brooks Running, which is owned by Berkshire Hathaway, set a record for revenue in 2021, which it just reported, of $1.11 billion. That's an increase of 30% year over year. And we've got Jim Weber with us. He is Brooks Running CEO to talk about the numbers and what feels like sort of a running renaissance that we have had, at least here in the United States, Jim. Do you think that we are amidst that? And if we are, kind of where are we in that cycle?
Thanks for having me this morning. Yes, we think we are in a running renaissance. We really see a secular growth in our sport. And running has ebbed and flowed a bit over the decades. It's always there. But boy, did we see people get outside when the pandemic first hit. Walking, hiking, and running made the cut. And so what we've seen in past growth spurts is it's sticky and people tend to stick with it. So yes, we think we see running growing for the next decade. There are 150 million people that run worldwide around the world today. We think it literally could double in the next 10 years.
Jim, help us understand, we've talked to you in the past, but help us understand why runners are so just fascinated with your shoes. There's a lot of competition out in the market, but one of our producers, I think she has 20 pairs of your shoes. I mean, it's just enormous.
Well, I love to hear that. And, you know, we're an overnight success over the last 20 years, I would say, because runners know if a shoe is working for them 20 miles in. 3 weeks into the show, they know mile after mile if they would buy it again. And so we've always challenged ourselves to earn that second shoe, that second pair that people buy. And so the experience underfoot, fit, feel, and ride, performance, its materials, its biomechanical science, and dialing in the fit for people shoe by shoe is actually really, really hard. And people are different. We've done clinical research in the labs with hundreds and hundreds of runners with some of the best universities of the world. And here's the outcome. People are different. Your joint motion is different person to person. So because we're anchored in that, I think people at mile 20 like the experience our product's giving them. And it's not just shoes, it's run bras, head to toe. And that's been the key to our success. It's our focus.
And so Jim, how are you guys thinking about innovation these days? We were just showing some of the top ranked shoes, and it's very interesting to me, even with running shoes, how there are trends that sort of come and go, from the minimalist shoes to some more maximalist shoes that are more in vogue now. What are some of the innovations that you're most excited about at Brooks?
You know, there's several, and I think what you're hitting on is there are different experiences in running. There are race day experiences and training experiences and comfort and cushioning. So people are experimenting and they're curious, but here's the key. Shoes have never been better. The material science that we're bringing into the cushioning puzzle on just engineered materials that are specific to only running shoes is just a part of what's happening in our category. And so I think people are seeing that. There's exciting product out there that's giving them new experiences. And mile after mile, we compete really well with all those products in the industry, but the runner has a lot of choices, and it's kind of fun because there's minimalist proprioception, close to foot experiences where you're feeling every stride, maybe on race day or to go fast. And then there's cushioning experiences where you don't want to feel the road or your feet, and we're delivering against all of those.
And Jim, not only, of course, you guys always sort of pushing ahead when it comes to the science of running. I have noticed that you've gotten a little snazzier with some of the fashion as well, as we have really seen sneakers come a long way in being a fashion statement. How are you guys thinking about that while still trying to unite it with being a good running shoe?
You know, I think the word fashion isn't often mentioned in our hallways here at Brooks, but we're focused on crafted beauty. Great product ought to be fantastically designed and beautiful. And we think we're building well-designed, beautiful products today. And color matters. You know, I think the truth is when you're wearing something, even if it's in a marathon, performance might be first, but it's personal expression about who you are. And we're a running brand. So if you're an active person, you know, we want you to be associated with our brand. So, you know, color is a key part of the apparel and footwear world. When I started at Brooks, the adrenaline came in one color for 18 months. I think it's in a dozen colors today, but that's great. It gives people choice.
Jim, of course, Brooks is owned by Warren Buffett's Berkshire Hathaway, and you're about to become a published author. You know, in that book, you know, can you share anything you learned from Buffett in terms of leadership?
You know, I'd be glad to, because I've learned a lot. I think the number one thing that has resonated so well for Brooks to be a part of Berkshire Hathaway is they believe in building brands in the mind of the customer over the long haul. And we're trying to play the long game here. So I think every time we've hit a wall here and had some margin issues, whether it was supply chain or currency or what have you, we've tried to go to work on those puzzles from a financial planning point of view. And the feedback from Greg Abel and Warren Buffett has always been focused on your customer. And so what a platform to build a brand in. We just couldn't be more grateful to have the patient capital to really focus on brand building, because that's the game we've been in for 20 years. So big advantage. And they're just super smart people all around. And the game we're playing is trying to build a great brand in the mind of runners. And they're just so fully supportive of that.
Jim, it's great to see you. Be well, run well. Jim Weber, Brooks Running CEO. Nice catching up with you after that record year. We're going to take a break. When we come back, shares of DraftKings are they're up now. They were down earlier in the session. Now they're rebounding despite a downgrade by Wells Fargo. We're going to talk about the talk to the analysts behind that call next.
DraftKings getting slapped with a downgrade by Wells Fargo after a worse than expected quarter. Wells Fargo senior analyst Jed Kelly joins us for our call today. Jed, good to see you here this morning. So why the downgrade?
I work for Oppenheimer. We have an outperforming $32 price target.
Oh, my apologies there, Jed. Oppenheimer, I should say. So I'm guessing you were pretty disappointed with the quarter.
No, the quarter was actually in line with what we thought. I think we had been on your program beginning of last week. We were street low we were one of the lower ends of the street for 22 EBITDA. I think what you have right now is you have a stock that's a expanding TAM stories. TAM stories we know are hard to pitch to shorter term investors in this market. But if you take a step back, I mean, the street, we all took our revenue numbers up for 2023. what DraftKings is essentially doing is they're investing in a rapidly expanding online sports betting market that's growing faster than they previously thought in 2020. They're seeing still pretty good return on their LTV to CACs, therefore justifying the investments. It's right now tough to go out and say, hey, we're making these investments for revenue, for future revenue opportunities in 2025. However, we think fundamentals are still intact. It's just a rough market for these kind of names.
And what do you think, something we were trying to sort of wrap our heads around after the numbers is how contingent future growth is going to be on getting that expansion into more states. The company has kind of said, we're good, it would help, but it's not necessary. What's your thinking around that?
Well, I think what they were talking about on the call is getting to profitability, right? I mean, that's become a pretty big focus, especially among more of the gaming investors and gaming analysts. So they were making that point, like if no more states legalize, we can get profitable by 2023. However, California's probably could potentially be legal by 2023. We keep telling people that's the seventh largest economy in the world, so expect more spend. I think if you look, so that's why when they go to their investor day, they're going to show a cohort of states, particularly around New Jersey, that speaks to like the contribution profit and their profitability. They want more states. I mean, we're still in an environment where Florida, Texas, and California aren't legal, right? So they want Florida, they want Texas to be legal. They want every state to be legal. That's what they're working on. They're spending a lot of money in lobbying to get all those states legal. It's part of our longer term thesis that the leagues want it, the media companies want it, DraftKings wants it. Everybody wants sports betting because it drives so much fan engagement. Just look at last week's Super Bowl ratings.
So Jed, if they can't get some of those states through the line, is DraftKings just an unprofitable company?
No, they're not an unprofitable company. I think you look at a couple of things. One, gaming companies have been profitable even with states taking a decent amount of taxes. Two, we're still in the early days of a consumer internet story, right? So they are building the foundation to become profitable. You look at the UK, it's a pretty intense, it's a very competitive market. The 3 or 4 leading players are all profitable. I don't think the United States is going to be any different. It's just very early. We're 12 to 15 years behind the UK right now.
And Jeb, when we're talking about competition in this space as well, I'm curious how you think about a DraftKings versus a FanDuel. Does it matter to have sort of first mover or early mover advantage in this space? Or do you think it's going to remain competitive sort of as it proceeds through its life cycle?
No, it definitely, the first mover advantage matters, but what we see after the state launches, there's a consistent cadence where the top 3 players make the share. We think it's going to be more on product. FanDuel's been doing a better job on their product, particularly with same game parlays. They're backed by Flutter, which is, the Betfair bet engine. That's working well. However, we think as DraftKings improves their product, it'll drive more customer stickiness and they should be able to close the gap. They're still doing well on handle. Where they are underperforming is GGR. You particularly see that in the New Jersey numbers. So we're still early, but as DraftKings is able to improve their product, we still think they're going to be top 3 in every state.
All right, we'll leave it there. Jed Kelly from Oppenheimer. Good to see you again. Have a great rest of the week. All right, as part of Yahoo's Black History Moves Us, businessman and TV personality Damon John spoke to Marquise Francis about what Black History Month means to him and why it's a good time to have difficult conversations. Take a listen.
Whew, what does Black History Month mean to me? It means it is, America hopefully reflecting, acknowledging, and celebrating the contributions of African Americans towards this country. It is a celebration of America, Americans. And it's a time to have tough conversations, and it's time to have informative conversations and inspirational conversations. Not that that should stop in the month of February or should ever stop about any color, culture, sex, creed, religion. But it is a time to say, let's highlight this and let's talk about this. Did you know?
Absolutely. And I'm curious, are there any specific Black trailblazers that have influenced you specifically or moved you really to get where you're at today?
The list would be too long, by far. From whether it's Harry Belafonte or Sidney Poitier taking on civil rights at the height of their career when the best thing was to be quiet, or Sammy Davis Jr., and James Brown, or of course Martin Luther King and Malcolm X and Harriet Tubman and so many people, the unknowns. The ones who were the first to go to school and segregate, and the ones to march in the streets, and Sam Cooke, Muhammad Ali. So there's so many that it's really really hard to 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 look at them and to name a couple.
Be sure to catch the full interview with Damon John as part of Black History Moves Us, Yahoo's celebration of the culture and contributions of the Black community, Thursday, February 24th at 3 p.m. Eastern, streaming live on Yahoo. And we'll be back with another look at the markets. We should also note that a little bit of breaking news here. President Biden will be speaking at 2 p.m. today on the situation between Russia and Ukraine. We'll be right back.
Carl Icahn, animal activist, the legendary investor, is now an activist at McDonald's, and it has to do with the treatment of pigs. Brian Salzi, he's been talking about this now for weeks, and that he was going to nominate some new folks to the board, and now he has gone ahead and done just that.
Yeah, no oinking around here, Julie. Very different campaign here by Carl Icahn, not typical corporate raider type one. He's pushing McDonald's essentially to abandon the practice of keeping pigs confined in crates. Now, Icahn has bought about 200 shares here, according to reports, worth about a little over $50,000 here. Icahn would like McDonald's just get rid of that practice of keeping or working with suppliers that keep those pigs in crates. Now, McDonald's is out with a statement saying that by the end of this year, 85% to 90% of its U.S. pork will come from cow or pigs that aren't housed in these gestation crates. They are shooting for a 100% target by the end of 2024. Icahn is stepping up here saying that's not quick enough here. He wants action now and has put forth 2 potential board members to join McDonald's. One of them having strong ESG focus, and the other one working for Bon Appetit. And she has spent a long career inside of the supply chain. So you can see those 2 candidates there for the board as well. But Julie, really, it's starting to turn into the year of the activist investor. You have Kohl's out there being attacked. You have U.S. Foods being attacked. You have Hasbro just has a new attack now it's dealing with last year. Now McDonald's. Clearly, the market's pullback has woken up a lot of these activists.
Yeah, and just to make a couple of points on the actual pig issue, I mean, Icahn's pretty late to the party here. This is something that animal activists, at least, have been outspoken on for many years. Years ago, I actually visited a couple of pig farms to look at the difference in how a company like Niman Ranch, for example, sources pigs and farms pigs versus a more traditional operation. And it's pretty different in terms of the approach. I should also point out the non-gestation crate approach, raising pigs. Now, there's a lot of gray area in between these 2 extremes, but raising pigs outside, for example, or free range, if you will, it's a lot more of an expensive proposition. You don't raise as much livestock in that method. And so that would mean McDonald's presumably would be paying more for those types of pigs. So it should be interesting how that hits margins when it does enact that change fully, although it's McDonald's, so it does have some, obviously, negotiating power. You didn't think I knew this much about pig farming, did you, Brian Sazi?
Well, hey, thanks for the invite. I would have come check out those pig farms with you. That sounds like a fun trip.
It was in a prior life, so sorry.
All right. Well, if you book a new one, I'm down. Count me in.
Okay, maybe we should go revisit that whole story. Let's take a look at what's going on in markets right now, because we are seeing stocks back in the red a little bit more deeply, but we have been seeing quite a lot of bouncing around just since the beginning of the trading session. Right now, the Dow is leading the way downward. It's off by about 0.8% at the moment. And, you know, we are obviously seeing a lot of reaction to Russia headlines. As you mentioned before the break, President Biden is now scheduled to speak at 2 p.m. today. Presumably, we would get more information maybe on sanctions. So we'll be watching not just the U.S. markets, but all the other stuff that you and I have been talking about for the past 2 hours. Commodity markets, the RSX ETF, and then those stocks that you flagged that have exposure in Ukraine.
Yeah, and amidst all this, we still have earnings coming out. Retail earnings are continuing along, Julie. Top ticker on the platform right now is Home Depot, followed by Digital World. And I can confirm I just got approved to join True Social, Julie. So I'm going to hop on there soon after the show and toy around with this.
That's interesting. Yeah. After you were something 300,000, 50, whatever it was on the list. I don't know. Important. Maybe they just wanted. Yeah, sure. We know you're important. Now you can go say the truth is out there or something. I don't know. I continue to not, I can't even with that whole situation.
I know.
Okay. So we're going to leave it there, which is why you keep talking to me about it, isn't it? Okay. We are going to leave it there. Akiko Fujita, Brian Chung will take you through the next 2 hours of trading. Keep it right here.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brian Chung. We are seeing stocks pushing lower 90 minutes into the trading day as a Russian invasion of Ukraine sends a chill across global equity markets. Right now, the Dow now down roughly 300 points, the Nasdaq down 70, and the S&P 500 down 20 points. We are also watching some big swings in the commodity space. A big rush to safe haven assets, sending gold futures to an 8-month high before pulling back, while oil futures also pushing higher on fears of a supply disruption. The White House prepares additional sanctions against the Kremlin as Russian troops move into territories in eastern Ukraine. President Putin declaring that Ukraine is not independent, and we will hear from President Biden later this afternoon. And retail comeback, shares of Macy's getting a big pop as fourth quarter earnings and sales surpass expectations, while the department store says it is not spinning off its e-commerce business despite pressure from one activist investor. We are beginning this hour, though, with the global response to a Russian invasion of Ukraine. The Russian military has now moved into two separatist enclaves, Luhansk and Donetsk, after Russian President Vladimir Putin recognized their independence. In a speech on Monday, Putin falsely declared that Ukraine, in his words, had never had its own authentic statehood, prompting this response from the U.S. ambassador to the UN.
And then President Putin asserted that Russia today has a rightful claim to all territories from the Russian Empire, the same Russian Empire from before the Soviet Union, from over 100 years ago. That includes all of Ukraine. In essence, Putin wants the world to travel back in time, to a time before the United Nations, to a time when empires ruled the world. But the rest of the world has moved forward. It is not 1919. It is 2022.
President Biden has signed an executive order banning all U.S. investments into the separatist region known as Donbas, and he is expected to announce additional sanctions at 2 p.m. Eastern this afternoon. Meanwhile, Germany has halted certification of a key gas pipeline with Russia, Nord Stream 2. UK Prime Minister Boris Johnson now saying Russia's latest move amounts to a renewed invasion of Ukraine. He has announced sanctions against 5 Russian banks and 3 individuals. And as we noted at the top of the show, we've seen a big rush to safety in the markets, with investors pushing gold to its highest level since June of last year. Treasury yields also pushing lower, with investors running to some of those assets. Let's bring in our first guest for the hour. We've got Samantha DeBender, Chatham House Associate Fellow. And Samantha, it's great to talk to you today. There's a lot of investors, I think, who are sort of catching up on the news that played out over the last 24 hours, 48 hours. Talk to me about what specifically has shifted as a result of what we've heard from President Putin and his actions.
Well, what has shifted is that President Putin has now started to be transparent about his ambitions on Ukraine. In 2014, when he annexed Crimea and when he supported the separatists in the Donbass, he had already invaded the country, but he was not really admitting it. He said the annexation was as the result of a referendum, and he denied having Russian troops on the ground in the Donbass. Now he's gone beyond pretending. He said yesterday in a meeting to the Russian Security Council, and later on in an address to the Russian people, in a televised address, he said that he considers Ukraine's independence and Ukraine's statehood to be a fabrication, that Ukraine was an invention of the Bolsheviks. And what he is saying here sounds very much like the kind of things that Hitler was saying back in the 1930s about the countries that had a right to exist or not. This is a sharp shift in Putin's rhetoric. He has stopped hiding behind the facade of proxy invasion. What he's done now by sending what he's calling peacekeeping troops in Ukraine, he's still pretending this is not a total invasion. And a very worrying development for me as a European, I'm British, but I do consider myself to be European as well. Josep Borrell, the European Foreign Affairs Commissioner, said that it is not a total invasion. It is an invasion. Ukraine is a sovereign country. What is worrying, though, Putin has picked up on things that President Zelensky said in Munich on Saturday. And President Zelensky alluded to agreements that Ukraine made in 1994 to renounce its nuclear weapons in exchange for security guarantees. Zelensky alluded to the fact that maybe Ukraine would not be bound by those guarantees anymore. Now, Ukraine is not going to have a bomb tomorrow. It does not have the capability today. But Putin has latched on that phrase. And he said, both in his Security Council meeting and in his address to the nation, that he believes that Ukraine is developing a nuclear capability. The way analysts are interpreting this is that he might use this as an excuse to take out infrastructure in Ukraine that he will falsely claim are developing a nuclear capability. This is a sharp uptake in the rhetoric. And I've been studying Russia and Ukraine for the past 30 years. And this is the first time that I'm really pessimistic as to where Putin will stop. And I personally don't think he's going to stop in the Donbass, something which, as myself have an investment portfolio, is something I'm looking at with horror. But I am very concerned indeed.
Samantha, Brian Chung here, obviously, in the humanitarian aspect of this can't be discounted at all. But within the context of what was announced by the Russian president, we need to, I guess, clarify the difference between recognizing what they see as separatist movements in those regions that you highlighted, and then Kyiv, the capital itself. And I think that there is kind of the open question about whether or not what Putin suggested yesterday is also a suggestion that they want to, at some point, get into the capital as well. Now, the United States calling this an invasion, ordering embassy staff to evacuate the capital. Do you see the announcement from Russia as also heightening the odds that they would want to wage an attack on the capital as well?
He certainly seems to be preparing his population for that eventuality. The way the Russians work is they put their chess pieces in place and they start creating alternative realities. Now, Putin has been creating an alternative reality around what is going on in Ukraine for the past 8 years. And he's now augmented his alternative reality to a very different level. So I've been an optimist for most of the past few weeks, and I've actually been dismissing some of the claims coming from the US and from my own government in the UK that Putin intends to take Kiev. I'm now actually feeling that these claims might have a lot more truth to them because of the way Putin is talking. What is also interesting to note is how his Security Council is behaving towards him. They all seem absolutely terrified. We had the image of Putin's foreign intelligence chief stuttering when he was being asked questions by Putin speaking to him in the way you would talk to a naughty child at school and asking him to repeat things until he gave the right answer and then dismissing him like you dismiss a child. This is a man who seems to have lost contact with reality. We joke in the think tank community about Vlad the Mad. It was a joke up until now. Now it's sounding a little bit more ominous. And when people lose touch with reality, that is when you start to get worried.
Yeah, Samantha, throughout the diplomatic process, the U.S. and NATO allies have maintained that sanctions are a deterrent. Now that Russia has actually invaded these two separatist enclaves, how much leverage is there with those sanctions? And really, how effective are they likely to be in deterring President Putin from going further into Ukraine?
Well, quite frankly, the sanctions that were announced yesterday seem really insufficient. The sanctions that were announced by President Biden, that no investment into the separatist republics. I mean, no one in their right mind would want to invest in the separatist republics. It's like saying, let's go and invest in North Korea. And I'm hoping that the sanctions that are going to be announced later today will be more far-reaching. Sanctions, of course, have limited impact, particularly in a regime which has been slowly turning towards China, both for new markets and for new sources of imports. But far-reaching sanctions, which would really hit Russia's access to capital markets, Russia's access to sovereign debt, would seem to be would certainly have more of a reach. What would be interesting to think about would be sanctions which would touch the second tier of his circle sufficiently for enough people in Russia, enough people in senior positions to feel the time has come. This man is ruining our country. He's ruining our lives to begin with, because we can't enjoy our money. And he's ruining our country. And I think if one is to think of sanctions, and if one is a policymaker, it would be important to think of the kind of sanctions that would weaken the regime enough to see some kind of change, bearing in mind that the problem in Russia is not just Putin, it is the lack of democratic institutions. The sanctions are the only tool we really have. We cannot imagine going to war with Russia. Russia is a nuclear power. And when your ambassador to the UN said that Putin seems to be wanting to go back in history, the thing is, we can try and behave like we did behave in 1919, but we have nuclear weapons today. This is not 1919, this is 2022. Big difference.
And finally, Samantha, I wonder if we can speak to some of the cracks, if you can call it, among NATO members. Obviously, we've seen Germany respond today, but you've got other countries like Italy, for example, saying over the weekend at the Munich Security Conference that the sanctions should be more narrow in scope and should not include energy. You've got those like Turkey who are coming out and saying that, not necessarily committing to sanctions, obviously because of the exposure they have to Russia. Are those divisions, you think, big enough to divide this NATO alliance the longer this carries on, or are we making too much of that?
There are divisions. There are divisions for the exact reasons that you have mentioned. There are also divisions because many senior politicians in Europe have financial interest in Russia. You have a former presidential candidate in France who is on the board of a Russian energy company. You have the former Austrian finance minister who's also on the board of a Russian energy company, the former German chancellor who's on the board of Nord Stream. So there are a lot of conflicts of interest within the European Union. Within NATO, you have conflicts of interest, even in the UK, where you have a lot of Russian money that has gone to financing the ruling Conservative Party. NATO has been disunited in the past. I think the fact that America is back is making a big difference. What I'm seeing, and I used to actually work at NATO headquarters. I was a political officer at NATO responsible for relations with Ukraine, so I'm quite plugged into what's happening there now. We are seeing more unity, that this crisis is really opening even the most skeptical people's eyes to the reality of who Putin is. I live in France. France has been traditionally relatively pro-Russian. And the fact that the French government is now taking, first of all, a leading role in brokering talks between Putin and Biden, but also coming out with a lot stronger rhetoric than it has been in the past, I personally feel is showing a positive step towards more unity in the alliance.
Well, Samantha, it's good to have you on today to give us some context. Hope to have you back on the show again soon. Samantha DeBendern, Chatham House Associate Fellow. Let's turn our attention back to the market action. We've been watching all three major indices pushing lower as we go into the session here. The Dow down about 280 points right now, and the Nasdaq down about 97. Let's bring in Hani Retta. He is Pine Bridge Investments Portfolio Manager. Hani, you've been listening to Samantha talk about the geopolitical implications. What does this mean from a market perspective? Does geopolitics now is that now the big driver? Is it ultimately still about the Fed?
Hi, good to be here. So look, we're in a maelstrom of factors that are pretty challenging for markets. On the one hand, we have this geopolitical risk. Right now, I think we're in this gray zone. The move up to now that the Russians have made is not a major surprise. That's why markets are weak but not panicking. It's really only if it goes further that much more downside could be in the cards. But at the same time, we have a backdrop that is very challenging that I would describe as anti-Goldilocks. We had an environment last year where real yields were declining and growth was accelerating. We now have the opposite happening. As we look into the second half of the year, we see growth decelerating while central banks are actually tightening policy at the same time. Put those three things together, geopolitics and tightening policy with slowing growth, and it's going to be a pretty challenging environment for markets.
Hani, it's Brian Chung here. Great to speak with you. I want to highlight some Fed speak that we got actually during the holiday yesterday. Fed Governor Mickey Bowman making some remarks with regards to interest rate policy. She said, quote, "My intent would be to take forceful action to help reduce inflation, bringing it back toward our 2% goal while keeping the economy on track to continue creating jobs and economic opportunity for Americans." Forceful action. You don't hear an adjective like that often from the Federal Reserve. What do you see as the odds of a more aggressive move in the Fed's next meeting in March?
Yeah, so good question. Look, I think forceful is what they want to get across both verbally. I think if they can job on the market, that helps them. But at the same time, we think that investors should not focus exclusively on hikes. Our focus is actually much more on what they do with the balance sheet. And it's that combination that matters. So we would say that the likelihood of 50 basis points in March is still not odds on. And we look much more to the combination that you'll get from steady hikes, perhaps at every meeting initially, along with clarity on the balance sheet that remains the elephant in the room for markets.
So, Hani, let's talk about how you're positioning your portfolio. I know you've highlighted the fact that China is actually stepping up its stimulus at a time when we've seen pullback in other central banks too. What does that suggest in terms of the opportunities that you see in emerging markets, specifically in China? And are you increasing your exposure in that direction?
Yeah, so China really is out of sync with the rest of the world in terms of growth and what policy is doing. So while we see this tightening happening around the world, both with fiscal withdrawal and monetary tightening, China's going the other way. They're actually trying to avoid slowing down too much, which is the path that they're on right now. And so that can lead them to be very out of sync with markets. One area we find interesting, if you have the capability to be very, very selective with credit skills, you can actually start to look at the property sector bonds as this stimulus is ramped up. But aside from China assets directly, we prefer to look at emerging market fixed income, specifically local currency bonds in Latin America, where the inflation cycle and the central bank tightening cycle is much more advanced than it is in developed markets. And so we should see a peaking in inflation much sooner and an easing cycle kick in. So these are areas that we find to be idiosyncratic, opportunistic, and away from core markets, which look quite challenged.
All right, Hani Redda, Pine Bridge Investments Portfolio Manager, thanks so much for stopping by Yahoo Finance this morning. Well, coming up on the other side of the break here on Yahoo Finance, take a look at shares of Macy's. Actually, it popped as much as 8% earlier in the morning, but along with the broader market movements has paired some of those losses. But they did report earnings and revenue that beat analysts' expectations. We'll have someone stop by next to discuss the road ahead for the retailer as challenges like inflation and labor shortages linger. We'll be right back. Well, we are still in earnings season, and we did get Macy's on the tape before the bell this morning, although shares were up as much as 8.5%. Some of those gains have been paired through the remainder of this session so far. Strong holiday sales and company strategy changes led to a, quote, stronger, more agile, and financially healthier company, according to the company's management. Revenue coming in $8.67 billion on the top line, and on the bottom line, $2.45 of adjusted diluted earnings per share, beating the street's estimates on both the top and bottom line. So for more on this, let's bring in Oliver Chen, Cowen senior research analyst who watches the stock very closely. Oliver, before the show today, I was tuned into the earnings call. I heard that you asked a question to Jeff Gannett over there about cost inputs and the ability of the consumer to take price increases in this inflationary environment. What'd you hear from the company about how they're hedging these higher costs?
Brian, great being here. So the company is really thinking surgically. At opening price points, the consumer is pretty sensitive, but at higher price points, the consumer has been less sensitive. So supply chain management, inventory management, thinking about the price elasticity by customer, these have all been very good execution-orientated strategies Macy's has taken. And as you know, Cowen's one of the only banks recommending Macy's. We think the valuation at a 6 to 7 times PE versus 8 times history is very attractive. In addition to this product strategy execution, and it has one of the biggest digital businesses, $8 billion of revenue, number 2 market share as well.
Oliver, I mean, that is a pretty big turnaround when you think about the conversation early on in the pandemic, which was about Macy's moving too slowly on the digital or e-commerce side of things. Is it safe to say that pivot has fully happened now and that plays to their strengths? Or you think there's still other competitors that are well out ahead in terms of other department stores?
Well, Akiko, the innovation and looking ahead always continues to be dynamic and change. But what is impressive is digital's 39% penetration, and the company is focused on replatforming, specifically improving the mobile experience and adding speed, also integrating a very compelling loyalty program. At the same time, Macy's has acquired a lot of new customers, which has been quite positive, and building loyalty with new customers and reactivating former ones is a big piece of the strategy. The other piece of the strategy, Akiko, is really omni-channel and continuing to execute on this integrated journey. That means buy online, pick up in store, ship from store, reserve in store, and minimizing split shipments as well, and just making sure the whole shopping journey is very integrated and seamless. So there's a lot of runway ahead. I mean, we think the metaverse will be a big idea, reinventing the mall, live streaming, all these things are TBD and evolving, ever evolving, I'd say.
Oliver, but at the same time, this is still a legacy brand that has that physical presence. I mean, you know, you walk around Herald Square, obviously everyone still wants to talk about the location there. We know that they've been changing their physical footprint in terms of where they have stores. There's been store closures. How important is the off-mall format for Macy's going forward?
Yeah, Brian, I think off-mall is an attractive place to be. Also the value segment in terms of Macy's Backstage competing against off-price retailers such as TJ Maxx and others. What's great about what Macy's is thinking about is taking the store count down to 500 from about 700 currently and integrating the experience and also focusing on high quality locations. At the same time, real estate value and monetization is an important part of the fundamental story. At Cowen, we value the real estate at about $2 billion or $7 per share, and the company will look for ways to monetize that creatively as well. So there's a lot happening. The future of the store is very different. The future of the store is the store as a customer acquisition tool, and customers will transact online in store or some hybrid way. That's what will happen, and investments in transforming the stores is very important. People do still love stores. The immediacy factor, the emotional factor, trying beauty, apparel, stores will play a big role in the future of retail. We think bricks plus clicks is really what the customer wants. There's many types of customers who have very different kinds of shopping journeys and different occasions and different needs. Macy's executed very well with inventory in a tough supply chain environment, specifically jewelry, fragrance, athleisure. Those were key categories, and the company really had to think strategically about buying early as well as buying with flows. As you know, a supply chain's been a hot topic across retail.
Bricks plus clicks, I like that. I want to switch gears to another company that you cover closely, which isn't necessarily in the same universe as Macy's, and that's Virgin Galactic. We saw a big stock pop last week off of the news that they would start to be taking orders for their commercial space flight. People can sign up for a journey to go to space for $450,000 a ticket. The stock pop that we saw last week has essentially gotten erased so far. What do you see as the important story for Virgin Galactic going forward? And do you want to be one of those people going on a commercial space flight?
Yeah, Brian, the story here is really a unique luxury experience. It's highly experiential and very expensive. The story is also a fair bit of risk because the prospects of generating revenue are very important. We have an outperform rating as we think about the luxury goods, the experiential angle, and also this is a very supply constrained opportunity with lots of global demand. So the CEO is formerly from Disney, and what we're really looking forward to is redefining and defining this experience from your pre-flight journey to your post-flight, involving friends and family, and also looking at spaceports globally to think about demand. But scaling will be a question/opportunity. The earnings calls later today. Also, the timing and the hurdles from which they develop new scalable ships and replenish and the mothership, those will all be important factors, as well as just paying attention to the reality of safety and production in this volatile environment too.
Oliver Chen, Cowen Senior Research Analyst. It's good to talk to you today. I appreciate the time. Coming up, Bitcoin sinking in the session as tensions grow between Russia and Ukraine. The latest developments as the cryptocurrency has lost almost half of its value since its November high. We'll be right back. We're seeing Bitcoin getting punished in this session as a Russian invasion of Ukraine pushes investors out of risk assets. Looking at where the price is moving right now, Bitcoin below that $38,000 handle. Over in Russia, lawmakers have now given Putin the green light to use force outside of the country. President Biden, meanwhile, expected to announce additional sanctions against Russia in a speech later this afternoon that has now been moved up to 1 p.m. Eastern. Let's bring in Emily Parker, CoinDesk Global Macro Editor and Anchor. Emily, let's first talk about the price moves here. Is this just kind of similar to what we're seeing play out in the equity space, essentially investors running to safe havens, moving out of risk assets like Bitcoin?
That definitely appears to be the case. We're seeing a sea of red across the crypto market. It definitely does not appear as if Bitcoin is acting as a safe haven from global instability. In fact, it's acting more like a risky asset. And, it does undermine, at least over the short term, the narrative of Bitcoin as digital gold, because Bitcoin is acting quite differently from actual gold, which recently hit an 8-month high. So Bitcoin is not acting as a safe haven, at least right now.
Hey, Emily, it's Brian Chung here. An interesting wrinkle to the central bank digital currency argument here, because some talk now about Russia maybe getting a little bit more of a political argument to create a digital ruble because it could be a way to get around sanctions. Explain a little bit more.
Yeah, this is a really interesting geopolitical element to this story. So the Bank of Russia is already moving ahead with a digital ruble. They're already moving into the pilot phase of that. But a couple of years ago, they said explicitly that a digital ruble would be a way to hedge against US sanctions. And now that the West is readying sanctions, this is becoming actually quite relevant. Both Russia and China have complained about US dollar hegemony. And that clearly is at least part of the calculation for developing a central bank digital currency that decreases dependence on the US dollar-based financial system.
Meanwhile, we've seen Russia moving forward with regulating cryptocurrencies. And as you highlight, Emily, this is kind of a reverse of what we've seen from other countries, which have gone as far as to ban cryptocurrencies in places like China. What does that ultimately mean? I mean, today we're talking about the military action, obviously the broader geopolitical story, but specifically on crypto. How quickly is this likely to move?
Yeah, so the Russia crypto situation has been a little bit confusing because there's clearly a bit of a conflict within Russia. The Bank of Russia has actually suggested that they wanted to ban crypto trade entirely, but that's not what's happening. Instead, Russia is moving towards regulating crypto, although crypto payments are prohibited. So, for now, crypto trade is legal to some extent within Russia. One of the reasons why the Russian government has been nervous about crypto is because it has been used to finance the Russian opposition. Russian opposition has very publicly taken crypto donations. So that's one thing. But now, at least for now, crypto is alive in Russia. The question is, will crypto serve as a safe haven within Russia itself? Perhaps as citizens of Russia are looking for a hedge against the ruble. Who knows?
Emily Parker, CoinDesk Global Macro Editor and Anchor. Always good to have you on the show. We are, of course, going to continue to follow the very latest out of Russia and the military action there, but also coming up, Hong Kong grappling with Omicron, the details as the region gears up to test its entire population. We're talking about 7.5 million people getting tested next month. That and much more coming up in our worldview on the other side. worldview today, the Russian parliament has given the green light for President Putin to use military force outside of the country, raising concerns about a broader invasion of Ukraine. Russia's already deployed troops to 2 separatist enclaves in the country after Putin declared the region independent of Ukraine. That has led to swift reaction from the West. Germany has halted the approval of Nord Stream 2, a key gas pipeline with Russia. Chancellor Olaf Scholz saying Russia has committed a grave breach of international law and recognizing those so-called republics of Luhansk and Donetsk as independent of Ukraine. The UK has imposed sanctions on 5 Russian banks and 2 individuals, while the White House is set to announce its own sanctions at 1 p.m. Eastern this afternoon. Ukraine's president, meanwhile, Vladimir Zelensky, calling on the West not to wait to impose the toughest sanctions, adding, in his words, the first steps of this aggression have already been taken. Hong Kong has ordered citywide testing for COVID-19 as it struggles to contain the worst outbreak since the pandemic began. 7.5 million residents will now be required to be tested 3 times next month, with a surge in COVID-19 cases overwhelming local hospitals now operating at 90% capacity. Hong Kong has reported 5,000 new daily infections over the last week. 145 people have died so far this year. The city has largely adhered to China's zero COVID policy, but Chief Executive Carrie Lam says there are no plans to impose a citywide lockdown yet. Gyms and businesses will remain closed while restaurant dining remains banned after 6 p.m. And over in Italy, the Coast Guard has rescued nearly 600 migrants off the coast of Calabria. The refugees were discovered piled on board 2 fishing boats as they attempted to make the journey across the Mediterranean. Rescue crews uncovered 1 body on board the vessel, headed for the Sicilian port of Augusta. More than 10,000 refugees and migrants have made the trip to Europe by water so far this year, despite frigid temperatures. Roughly 230 have died or gone missing.
Volkswagen reportedly exploring a listing of its Porsche brand via an initial public offering. The company is saying that it is negotiating an agreement with its majority shareholder, although a final decision has not yet been reached. And Akiko, this is pretty significant given this is the world's 2nd largest car maker by volume. Again, no final decision just yet, but the company is confirming that this is a serious discussion they're having.
Yeah, and we saw Volkswagen get a big pop, shares over in the European session on the back of that, up about, I was going to say 9%, 7.5% there during the session over there. 20 billion euros is what the expectation here is in terms of the IPO. Could be one of Germany's biggest listings this year, at least according to the Financial Times, and Porsche expected to be valued between 80 billion to 90 billion euros. You know, Brian, when you think about the direction Volkswagen has been trying to move in terms of going 100% all EV, Porsche is one of those brands that's been a big driver. Their EV model outpacing the 911 in terms of sales. They've sort of been moving in the right direction here, and investors seem to be really excited about the prospect of a potential spinoff, at least in the public markets.
Yeah, absolutely. Volkswagen as a whole making that big pivot over to EV, perhaps accentuated by the big emissions scandal that they had a number of years ago. But I think it's important to note that spinning off Porsche isn't a true raw EV spin-out play like was rumored with Ford at the end of last week, which I believe the company has kind of deflated the rumors of. But we have to understand that Volkswagen has in its own brand portfolio outside of Porsche some electric vehicles, as well as Audi, which also has their own separate EVs. So spinning out Porsche doesn't mean that all the EV portfolio is going to go out into that separate company. There's a big political reason for doing something like this, and that's because of the fact that this is a company that at least Porsche SE, which is the investment vehicle for the Porsche and Piech families that really own 50%, over 50% of VW's shares. This would reduce their holdings and their voting power over the Volkswagen brand itself, which we also have to remember also has a substantial government aspect of it as well, because Lower Saxony, that region of Germany, actually having a large investment stake in the company as well. So doing a spinoff of Porsche could reduce some of those holdings. So very interesting to see how the political aspect of all that comes into play with this as well.
Yeah, I mean, I think it speaks to broadly, if we're talking about Volkswagen specifically, about the transition that the company is undergoing right now since they announced that they would go 100% towards EVs, spinning off Porsche. To your point, there's a political element too, but that is part of this transition the company is undergoing to really go 100% in that direction. And, look, if you get a pop on the shares on the back of the announcement, obviously not confirmed, or at least the decision has not been made. We should say the company has said they are in fact considering it, but it'll be interesting to see how quickly this moves, and if in fact the expectations for this IPO, this being potentially Germany's second largest, will in fact transpire.
Yeah, I'm just waiting for them to bring back the microbus from the hippies era. Apparently it's going to be called the ID Buzz. Supposed to be released at some point in the next few years, but we'll leave that there for right now. Coming up on the
Volkswagen.
Yeah, exactly. Coming up on the other side of the break, a landmark settlement for U.S. women's soccer stars. We're breaking down the $24 million agreement for athletes like Megan Rapinoe following a lawsuit over unequal pay. We'll be right back. Big news in the sports world as a group of women on the U.S. national soccer team reached a $24 million settlement with the U.S. Soccer Federation following that lawsuit over unequal pay compared to their counterparts on the men's national soccer team. For more on this, let's bring in Yahoo Finance's Dave Briggs, who's been following the story. Dave, pretty important conclusion here to this long story.
This is a monumental day, quite frankly, Brian, for women's sports around the country, not just in the United States. This dates back to really like a Billie Jean King type of transformation of all women's sports around the country. Now, this settlement really just applies to the U.S. women's national team and the U.S. Soccer Federation, not other teams around the world, but it brings about important change, $24 million in terms of back pay, but more than that, an illicit admission that they had been underpaying women for years and years. Now, quite frankly, Brian, I'm not a huge fan of, now don't jump on me for being sexist, of equal pay for men and women in any sports. I'm a fan of getting paid what you are worth. And quite frankly, the U.S. women's national team in my estimation, in the Wall Street Journal's estimation, and just about any calculation you use, is worth more money. They should be paid more money than the men. They are better. They are more successful. They sell more tickets. They draw better ratings. And they sell more jerseys, Brian. So still, huge win for Megan Rapinoe and more Alex Morgan and the stars of U.S. women's soccer and the players of tomorrow. But quite frankly, I think they should be earning more than the men right now, and for years to come, they are far more popular. But this is big change, man.
Dave, you got me like ready to jump in when you talked about equal pay. But yes, to your point, women's soccer is huge in the U.S. How much of this do you think this settlement, in this acknowledgement, trickles into other sports, like women's basketball, for example?
I don't think at all. And that's why, Akiko, I'm not sorry again. Equal pay for men and women. How can the WNBA players anywhere near what you pay NBA players, considering, again, revenue generation, ticket sales, TV contracts, jersey sales, which is exponentially higher for the men. And when you look at tennis, for example, women's tennis, much like soccer, far more popular, a far better television product, sells more tickets, draws better ratings, at least in the United States. So a good argument could be made in both tennis and soccer that U.S. women should be paid more. And I am the first one to say that. You cannot apply this to just about any other sport because of the revenue generation. And when you look at the biggest body in soccer, that's FIFA and the World Cup, this should not apply to that, because the last World Cup generated $6 billion in revenue on the men's side, $131 million on the women's side. Soccer in the United States is far more popular for women, but around the globe, it ain't even close. It's apples and bananas. Men are far more popular, far more revenue generating. So nonetheless, I don't mean to water down this accomplishment. It is a huge day. As Megan Rapinoe said, when we win, everyone wins. It's a monumental step forward.
Dave, I want to kind of ask the question about going forward, what this settlement means, because it was, I believe, 5 stars that were part of the actual lawsuit itself. But then you had the U.S. Soccer Federation announcing this morning that there was going to be a new collective bargaining agreement so that the future generations of women's stars on the team as well will hopefully benefit from this. Do we know the terms of that and kind of by percentage how much more they should expect to be paid compared to historical payout?
We don't, because that collective bargaining agreement is not done. Now, this is all contingent on a new collective bargaining agreement being agreed to, which they have not. The reason the date matters so much is the court case goes before a judge on March 7th. They extended the current collective bargaining agreement to March 31st. They have until then to come up with a new deal that will be, in all cases, equal for both men and women. And it's not just pay, Brian. The biggest issue that women pointed out here, which was really gross, was that the working conditions were far better for men, which really makes no sense. We're talking about field conditions, locker rooms, travel. All those things were very different, much higher on the men's side than they were the women's side. So assume that all of those things will be equal. The last collective bargaining agreement had men being paid $263,000 per game on a 20-game basis, where women got paid $100,000, almost 3 times as much for the men. That number will now be equal once they come up with a new. They are under a ton of pressure, Brian, to make equal and to get that deal.
Yeah, Dave, I'm going to take a wild guess here and say more people, or the average person, can name a women's soccer star more than men's, at least here in the U.S. Dave Briggs, thank you so much for bringing us that story. Coming up, Home Depot is slumping despite beating earnings and revenue expectations. We're going to discuss more trending tickers up ahead after the break. Welcome back to Yahoo Finance Live. We are seeing all three major indices in the red right now, with the Dow down about 300 points. Our very own Inez Ferre at the Nasdaq for us this morning. And Inez, I know you're watching Home Depot. Shares there under pressure despite beating on earnings.
Yeah, that's right, Akiko. Home Depot shares right now down 8%. In fact, Home Depot is the worst performer on the Dow right now. Its revenue came in above expectations. Adjusted earnings per share also beating estimates. Same-store sales last quarter were up 8.1%. The home improvement retailers forecasting, though, for growth to decelerate in 2022. And if you look under the hood at the results for last quarter, its growth was driven in part by higher prices, because average tickets went up, but the customer transactions were down 3.4%. So that implies that inflation had something to do here, that higher prices are in the picture. Also, the company Home Depot forecasting a flat operating margin for this year. Taking a look right now at shares of Tempur Sealy, the stock for the mattress retailer, that is down the most since April 2020, down about 16% right now. And the company reported its quarterly results, adjusted earnings per share missing estimates, revenue missing analyst estimates, and one analyst at Truist suspecting a late quarter fall off and higher import prices that drove results. KeyBank's analyst Bradley Thomas saying that it was a very strong quarter, but still below Wall Street expectations. And we're also taking a look at DraftKings today. That stock is up more than 2%, reversing course from earlier this morning. It was under pressure in pre-market. It opened a little bit lower this morning, but now it's in the green again. Wells Fargo downgrading the stock to equal weight. Remember that the company reported its quarterly results last week. In a note to investors, the analyst over at Wells Fargo, Daniel Pulitzer, is citing growing concern on DraftKings' path to profitability given its fast-growing operating expenses. For the quarter, when it reported its results, it talked about costs in entering new markets, costs for marketing, and that put a lot of pressure on the stock. Last Friday, I'm going to pull up here a 3-day chart. You can see when the stock really declined last Friday. I want to mention, though, separately, Roth Capital upgraded DraftKings to neutral from sell. Brian, Akiko?
Yahoo Finance's Inez Ferre. Thanks so much for the breakdown there. Coming up on the other side of the break, tensions are growing after Russia's troop deployments in eastern Ukraine. We'll speak with a former White House official about the fallout as the U.S. and UK gear up to impose sanctions against the Kremlin. That's coming up next. Welcome back to Yahoo Finance Live. It is the noon hour here on the East Coast on this February 22nd, 2022, 2222 on a Tuesday. I'm Brian Chung alongside Akiko Fujita. A lot to cover in this hour, but first, let's of course take a look at the numbers as we start off the afternoon session. Across the board, we are seeing red with the Dow down 0.9%, the S&P 500 down 0.7%, and the Nasdaq down over 1%. Of course, a lot of this on the escalating Russia-Ukraine conflict as U.S. markets continue to weigh the risks of an outright invasion. We'll have the updates as the attention turns to the Western nations on a response following Russian President Vladimir Putin's speech yesterday. And then inflation remains a big story. It's being felt everywhere, including fertilizer. How are higher input costs for farmers bleeding into the prices that we pay for groceries at the store? The National Farmers Union will stop by to give us their outlook on inflation for 2022. But first, of course, Russia and Ukraine. So let's bring in our first guest for the hour, Christopher Smart, Barings Investment Institute head and chief global strategist. Christopher, it's great to have you on the show. We were just showing markets down across the board today. What do you see as the market digestion of the news headlines that we got over the weekend, now that we know that it appears, if anything, the tensions between Russia and Ukraine can only escalate from here?
Well, that's what it would seem. And I think those of us who were following these events closely would have predicted a much more risk-off environment for both stocks and fixed income markets. I think the dollar was even up, it was even down a little bit today, suggesting not so much a flight to risk, not so much a flight away from risk as a flight feeling more or less comfortable. I think the positive spin here is that the story is winding down, that Putin is sending troops across the border, but in fact, he already has his representatives in this part of Ukraine. Not much has changed yet. The recognition is a legal thing. It's a symbolic thing. It's not going to escalate from here. But I think if you, and that was something that you probably could have expected very early on in this crisis. But I think if you had listened to Putin's speech yesterday, it was a real barn burner. And he is essentially calling into question much of the post-Cold War order, the legitimacy of the Ukrainian state, the intentions of NATO allies in Europe itself. And I think it's hard to imagine, at least right now, things stopping right here. And that's why I think we may be braced for some more volatile times ahead.
Yeah, Christopher, I wonder if you can elaborate on that comment you just made about the story winding down. Do you mean the market risk and the jitters that have come with a potential invasion last week? Now we see the actual invasion playing out. Granted, it is so far limited to the separatist regions.
I think markets today are kind of breathing a very small sigh of relief that things aren't much worse than they are. But make no mistake, I think things are bad. And there is a lot of potential for them to get worse. Now, just to back up a half a step, I still think it remains unlikely that we're going to see a massive Russian invasion of Ukraine. That's a very big commitment. It would be very difficult. And I think the last thing Putin wants would be to be owning a very large country of very unhappy people under his control. I think more likely you'll see fighting in the Donbass escalate from here between Russian troops and Ukrainian troops, and that will lead to more severe sanctions that the Biden administration has been putting in the window really for the last several weeks. It's very hard for them. We'll hear from the president, I think, this afternoon. It's going to be very hard for them to pull away from something quite severe if things escalate from here.
Christopher, you were working in the White House in 2014, 2015, when the escalation between Russia and Ukraine was heating up over Crimea. What makes this episode different than then?
Well, a couple things. I think, first of all, then it was a much murkier set of developments that caught a lot of people by surprise. The fall of the president of Ukraine, who actually fled the country in the dark of night, I think caught everybody by surprise. And Putin's reaction to that, his use of that fluid moment to annex Crimea. And so the Obama administration, of which I was a part, was deliberately escalating pressure on him. The focus then, I think, was really to put pressure on Putin, his advisors, but also to protect the broader Russian economy from the impact of sanctions. What is different today is that the list of sanctions, potential sanctions that the administration has outlined, in conjunction with European allies, importantly, they have worked to make sure these things will move together. Is much more targeted at a broader set of impacts on the Russian economy, the Russian banking system, probably stopping short of something that will disrupt oil and gas flows, but something with very severe consequences for the Russian economy, with some disruption in Western markets as well.
Christopher, with that said, that threat has been there throughout the diplomatic back and forth. That didn't necessarily deter President Putin from going in yesterday. I mean, how effective can they really be?
Well, that's the thing with sanctions, right? If you're not going to send troops and you're not going to do nothing, this is a middle ground that to some extent has a deterrent character. I think things in 2014 might have gotten worse had we done nothing at all. This time around, I think Putin has been clearly bracing for them. He's been expecting them, maybe not expecting the unified Western response that there has been. And we'll see if it deters him from further actions. It's sort of an unanswerable question in many ways. I think the other important part about sanctions is they really do send a very important symbolic message and punitive message to the Russian economy that this is something that Europe, the United States, the global order, if you will, doesn't find acceptable, and some consequence has to be paid. He may be willing to pay that price for a whole variety of reasons. So I don't think it's realistic to expect that this is going to make him say, oh gosh, I'm going to turn around and go home, but it may, on the margin, deter an escalation from here that he might be considering.
Christopher, and then just kind of putting all the pieces together from a market standpoint, it's not like Jay Powell is going to have any sort of stance on the whole Russia-Ukraine conflict, but do you think that not just the Fed, but other global central banks are paying attention to this within the context of whether or not this is introducing some sort of market volatility or perhaps change of financial conditions, which they would want to pay attention to?
They are clearly paying attention. I mean, this is obviously outside of their bailiwick, much as the way Omicron and the global pandemic were outside of COVID were outside of their bailiwick. But they have to understand that in a similar but very different way, this is a series of events that could certainly raise the risk of higher oil prices, could raise the risk of maybe a change in demand functions, particularly in Europe. If you got to a stage where you interrupted Russian exports of oil, Russian exports of gas, you could see prices of oil going to $150 or higher. And if that stays there for any longer period of time, that's going to have some inflationary impacts they have to respond to. At the same time, it's going to be a big blow to investment confidence and demand. So they're going to have to walk a fairly careful balance as they try and determine which of those two forces they need to respond to most with a very blunt set of tools.
Yeah, certainly another bullet point to watch for in that next meeting from the Fed on March 16th. But Christopher Smart, Barings Investment Institute head and chief global strategist, thanks so much. We want to continue the thread on the markets with a look at crude oil right now. Obviously, a lot of movement given the news over the weekend. Brent crude oil up 3%, WTI crude oil up almost 2%. So let's bring in Victoria Green, G Squared Private Wealth founding partner and portfolio manager. Victoria, it's great to have you on the program this afternoon. You know, when you take a look at these sectors, the Spider Energy ETF has really outperformed the market up 23% over the last 3 months. Given the headlines that we've seen over the weekend, do you want to get in? Do you want to stay away, sideline your money? What's the proper approach here?
We tend to think that commodity-driven areas of the market were a good place to be to offset inflation. And if this happens, then I'd look a lot at the U.S. producers, potentially limiting some of your European oil and gas exposure because they're going to get hit harder. And I think one of the things that can get missed in the discussion on Ukraine and Russia is what is the effect on the U.S. markets? I know it feels bad. I know it feels scary. It's like another, gasoline on the fire to a situation that already felt fraught. But if you think about it, conflict really doesn't often affect the US markets as much as we think it will. So we tend to think right now in an inflationary environment, commodities are a great place to be, especially oil and gas. And I know they've had a good run up this year. But the question is, what's going to knock them off? Do we really see oil and gas prices coming back down to 70? Even if that happens, the bulk of the E&P producers that we like are in the Permian, and the break-evens are closer to $30 a barrel. So 70 would be fantastic, actually. 100, 150 is not sustainable. It's too much of a drag on the economy. So right now, I think if you look around the market, it still has a great relative value.
Victoria, I wonder if you can elaborate on that point a bit, because I think it's a good point you raise, which is, we see the headlines that say oil going up because of what's happening in Russia and don't necessarily make that direct line between what it means for U.S. energy markets. Obviously, when you look at a place like Europe, huge exposure in terms of imports on natural gas, oil, and other markets as well. How should investors be processing that news here in the U.S.?
Well, the first thing is never knee-jerk and never panic. If you look at how markets are reacting today, I think it's more about Home Depot's warning than it is about Russia and Ukraine. Our base case is Russia and Ukraine plays out like Georgia did in 2008 or Crimea did in 2014. It's remained to be seen if he's going to stay in the separatist regions or not. But what does that mean for U.S. oil and gas? Not to sound completely Machiavellian, but it's not terrible, right? If we're able to produce fuels the rest of the world wants and needs, that's great. We're more hindered by our ability to supply it. LNG, you look at what Cheniere's doing, it's going to be harder for them to actually increase deliveries to Europe and Japan because they're already kind of stretched. So the amount of gas Europe does get from Russia, I think they get about 35% of overall, is very difficult for us to pick up. It's interesting the timing of this invasion because it's kind of coming on the end of winter. So the leverage over oil and gas is a little bit less. But generally speaking, U.S. producers, especially those that are producing heavily in the shale regions, should benefit from increased stability and higher oil prices. The one thing I would caution is Iran is actually out there. And Iran's a bigger risk than war conflict is because Iran has a lot they could bring on the supply side that we'll see how this goes. Talks supposedly are going well. And if we see Iran sanctions come off, that is an unexpected addition of supply, and that could see the market reset a little bit lower for oil and gas.
So, Victoria, just to kind of drill down on that, does that mean that, in your opinion, the news coming out of Iran is actually more important than the fixation on the Nord Stream 2 deal, which apparently Germany said they'll halt?
So just again, to push back, what does Nord Stream do to help our U.S. oil and gas producers, right? Nord Stream 2 is just applying more gas from Russia to Europe. So if they halt that, again, it's not like we can easily transport gas over to Europe. And right now we're more hindered by our ability to get it to Europe than we are by our ability to produce it. So yes, I think for U.S., we're looking more at Iran and their ability to destabilize the market some, because OPEC has signaled they are not increasing. Even at $100 a barrel, they are very fine to keep their slow and steady, and they're actually missing and underperforming their targets. Most of their OPEC plus community members undersupplied because they had issues with their own countries and with getting distribution out. So Iran comes on, that could certainly see prices come down, which we want, right? We don't want this market to overheat. We don't want this market to bubble. So if we could see prices back down in the 60s to 80s level, that's much more sustainable because the drag on the consumer is less. Energy at $100, everybody's feeling pain at the pump. It hurts on inflation, and it's just not sustainable. So as you see these $100, $120 predictions, it's very hard for the U.S. consumer.
So, Victoria, what do you like in the oil patch? Or let's broaden it out to energy. Give me 3 names.
All right, so I'm a big fan of shareholder-friendly energy. So my top picks in that space are Devon, EOG, and Diamondback because they are just committed to pushing capital to shareholders. They refuse to really increase their drilling. You should have heard Devon on their earnings call. They basically were like, nope, no CapEx. Doesn't matter how much oil goes up. We're not going to produce more. They're basically flat on CapEx. So their job, as Devon sees it, is to push capital back through share buybacks and their fixed and variable dividend. So I like these plays because not only do you see
Sorry, just finish your thought, Victoria. Your connection just cut out right there.
Oh, I'm so sorry. Devon, EOG, and FANG with their fixed plus variable dividends, they're pushing shareholder capital great. So look at that. I can see some price appreciation still, as well as the ability to get the variable dividend of up to 50% of free cash flow. I think those are great picks in this space. And even if prices come down on oil, you're still seeing them generate a huge amount of free capital.
Victoria Green, G Squared Private Wealth founding partner and portfolio manager. Good to talk to you today. Coming up on the other side, home prices increased at the fastest pace in more than 34 years to end 2021. We're going to break down which areas saw the highest gains and what it all means for new home buyers on the other side of the break. Well, real estate in focus today with new data from S&P Case-Shiller National Home Price Index. Finding home price growth in the U.S. remained constant in December. S&P posted an 18.8% gain that is unchanged from November, but year-over-year changes have seen record increases. Let's bring in Danielle Hale, Realtor.com chief economist. Danielle, just talk me through what you're seeing right now. Are things going to start cooling down? Are we seeing this huge rush on low inventory, the fear of rising rates, or are you seeing that things could remain heated for a while, even with those rates going up?
Yeah, so what we saw in the Case-Shiller index today is that home prices continue to increase. And if we look at where they're increasing, Sunbelt metros top the list. But even in markets at the bottom of Case-Shiller's top 20, we're still seeing home prices advance at double-digit pace. So home prices are going up pretty much everywhere. The pace hasn't yet slowed down, but this is December data from Case-Shiller. And remember, mortgage rates were still quite low in December. They've moved up pretty significantly to start the year so far. In fact, they're almost a whole percentage point higher than where they were at the end of December. And so that's going to significantly affect how much home buyers can afford when they're putting offers in on homes in this real estate market.
Hey, Danielle, it's Brian Chung here. I really enjoy the research that you're doing with regards to, instead of looking just at the home price appreciation, kind of evaluating whether or not in some cases it might be better for people to rent versus buying a home. And the research that you have over at Realtor.com notes that in 26 of the 50 largest metros, it is actually a better financial choice to go off with buying a starter home as opposed to renting. Tell us a little bit more about where those metro areas are and how the numbers break out.
Yeah, I think that's probably a shock to most people since we've been talking so much about rising prices. But rising rents are pretty common across the board. Nationwide, rents are up almost 20% on a year-over-year basis. So they're growing faster than the pace of home prices. And that means in some markets, not in all, but in just over half of the 50 largest markets, your monthly costs are going to be lower as a buyer than they are as a renter. So in those markets, if you are in the market and thinking about making a move, it might make sense to consider buying over renting. Now, we've got the most expensive areas up there right now. So those are markets where renting makes much more sense than buying because rents are relatively affordable compared to the price of homes and what you're going to pay on a monthly basis. But in the South and Midwestern markets, those are areas where we tend to see buying make more financial sense on a month-to-month basis. And so areas like Birmingham, Cleveland, Pittsburgh, you're actually going to pay less per month if you buy versus if you rent. Now, it's assuming that you can find a home and win an offer on a home and that you have enough to put a down payment down and actually finance the home purchase.
I mean, Danielle, we've seen the occupancy rates tick higher in some of those key metro areas that you pointed to. If we're talking about purchasing a home and we're seeing the rates pushing higher, potential pullback, again, potential depends on the market. Does that suggest that rent increases are going to outpace those home purchases and monthly mortgage rates as we move forward or further into the year?
Yeah, that is what we expect. So rents are going up because in some cases they're making up for lost time. During the pandemic, rents didn't decline nationwide, but they did grow much slower than we would normally expect. And some markets did, in fact, see rents decline. So rents are making up for lost time. Inflation is pushing up costs for landlords. So they're dealing with higher maintenance, upkeep, utilities costs, property taxes, and they're pushing that burden into the rental price. And then the third thing is that rental vacancy is at an all-time low. And so that means in many markets, landlords don't have to compete for renters. It's renters that have to compete for the landlord's attention to get the unit. And so that is a recipe for continued price increases. Now, I will say we do expect the pace of rent growth to slow. So we're still going to see rents grow, but our expectation is that we'll see them average about 7% this year, which is still about twice what you would expect in a normal, healthy market.
Yeah, and Danielle, that's a good distinction that you bring up there, that just because in some cases it might be better to buy, it's not because home prices are going down. Where are specific markets where you're seeing a really hot housing market that is really expensive to rent and also really expensive to own a home? I know of one town in Texas, Hook'em Horns, that's also feeling that heat there.
Yeah, Austin is the top of many of our lists lately, and that's because it's just getting so much attention from buyers and renters, anyone looking to relocate from out of town. You've got the no income tax that Texas is famous for, that's drawing in a lot of people. You've got a growing, developing tech industry in the Austin market. Realtor.com has an office in the Austin area. So lots of tech companies located there are drawing workers in, and especially those who have flexibility, who may have been in the Bay Area and may not want to stay in that area anymore. They can find great affordability in Austin relative to the cost of homes in the Bay Area, whether we're talking buying or rent, and they can still be in a great tech market. And so even though prices are going up, they're still relatively affordable compared to those California prices.
Yeah, Austin, Texas, essentially the new Silicon Valley. Thanks so much for breaking all that down for us. Danielle Hale, Realtor.com chief economist. Coming up on the other side of the break, inflation hits farmers as higher costs on everything from seeds to fertilizers pushes up the cost of production. The National Farmers Union Vice President joins us next. inflation is impacting everyone, including farmers. Fertilizer prices up as much as 250%. Weed killers, seed, and equipment prices all up across the board. The big question, of course, how much will the consumer bear of these higher costs at the store? Joining us now for more on this is Mike Strands, National Farmers Union Vice President of Advocacy, as well as our very own Yahoo Finance's Adriana Belmonte for this conversation. Mike, it's great to have you on the show. Give us a lay of the land over what input costs are increasing for farmers and what the plan is to mitigate those inflation costs.
Yeah, we're in a really unusual time in the farm economy right now as we see prices on the rise for basic inputs for growing crops like fertilizer, like pesticide, like seeds, like equipment. A lot of these costs have really jumped up in the last few months as we've seen the supply chain disruptions due to the pandemic, but also from some of the geopolitical issues that have been going on right now around the world and some of the uncertainty there. Farmers don't have a lot of choices when it comes to who they buy from and where these inputs come from. There aren't many choices out there. So they're really beholden to the costs that are dictated by those big companies that sell to them.
Hi, Mike. I wanted to ask you, how much is it that farmers make on the dollar for things that are sold in stores to consumers, from their products? And, how has that been affected by inflation?
Consumers certainly have felt the pinch from higher food costs at the grocery store, but farmers on average, for every dollar that a consumer spends at the grocery store, only about 14 cents of that dollar gets back to the farmer. And that's because of all the different steps involved, from marketing and processing and distributing those agricultural products and turning them into food products that you see at the store. This varies, of course, from product to product, but it goes to show how many companies are involved in the processing, how many different steps are involved between the farm gate and the dinner plate. So farmers don't have a lot of control over food prices. They're beholden to the companies in the middle, just like consumers.
Yeah, I mean, on that front, how much cushion do they really have, and how much of that has already been passed on to consumers? What are you hearing about the coming months and how much more prices may have to go up as a result of their input costs?
Yeah, well, one of the biggest problems for farmers is that they're price takers and not price makers. In rare situations, can farmers dictate the price for what they're able to sell? And they have to take their crops to a certain company or a certain distribution point, and the companies there have authority over what the price is going to be. So farmers don't get to decide what that cushion is. They have to make some real limited decisions between selling to one company or another. I think that as input costs go up, it really hurts our farmers because they've spent a lot of time, especially in the last 5 years or so, recovering from some of the trade war impacts that they've felt. And some of the market had just started to recover from that, but now the increased input costs are having an impact on the bottom line for farmers.
So I'm glad you brought up the trade war, because my next question is, during the trade war with all the tariffs, it seemed like soybean farmers were kind of among the ones hit the most, or hit the hardest, I should say. With inflation, are there any specific agriculture sectors that have been particularly impacted harder than the others?
Yeah, that's a good point. The soybean growers were hurt most by the actions with China back in 2017 through 2019 or so. But since then, with inflation, farmers who are really dependent upon fuel prices, so increases there hurt a lot. That goes for pretty much all row crop farmers, but the costs involved there, along with farmers who are dependent upon fertilizer. And the urea and markets, for instance, are highly dependent on some of the other, or are linked with fuel markets as well. So really for row crops, increased input costs are going to have a big impact here in the coming months.
And Mike, I want to ask, I mean, you're in Washington, D.C. right now. Is there anything that the White House or Congress can do to address any of these pain points for the farming industry? I mean, we know that subsidies have been used in the past during the trade war. Would something like that be helpful now? Because that might bleed down to relief for consumers as well.
That's been a priority for our organization. It's helping decision makers in Congress and in the administration identify some of those action items to help address this. And a lot of it comes from the concentration in the industry, where there's so few choices for farmers and so few contingency plans, I guess, when things run into supply chain problems. During the pandemic, for instance, in beef, we saw a lot of processing facilities and slaughterhouses shut down when workers became sick with coronavirus. And that had a rippling effect through the agriculture economy. So what we'd like to see is emphasis on having more and smaller processing facilities available in beef, in pork, in other parts of the industry, so that when there are shocks to the system, there's an ability to find other ways to process those animals or those crops. And then that won't have the sort of supply chain disruptions that we've endured the last couple of years. So we want the administration to put an emphasis on breaking up monopolies where they exist across the farm sector, and to make sure that farmers have options, whether it's for who they sell to or what inputs they buy.
So you mentioned a lot of the immediate shocks, particularly how it trickles down to consumers. Are there any long-term implications that can happen for farmers specifically as a result of inflation?
Yeah, there's as changes to the kind of the business model, I guess, start to come into play. If we're going to see like a new price plateau for some of these inputs, as inflation happens across the economy, but it happens at different rates for different particular commodities or inputs. So if we end up in a new price plateau for one thing or another, that might have longer term effects. But I think with the longer term aspect that really comes into play the most is if other companies, there are so few companies available to sell inputs as it is right now. If some of those get acquired or are broken up or are bought up by other companies and absorbed, having fewer choices is going to have a really painful effect for farmers as the years go on.
Mike Strands, National Farmers Union VP of Advocacy. Appreciate you joining us today. And our thanks to Adriana Belmonte as well for joining in on the conversation. Coming up, the latest on Elon Musk's accusations against the SEC. This time, this Tesla CEO going after regulators for leaking information from a federal probe. We'll have the details on the other side. Well, Elon Musk is coming for the SEC yet again. The Tesla CEO now accusing regulators of leaking information regarding an agency investigation. Let's bring in Yahoo Finance's legal correspondent, Alexis Keenan, who's following that story for us today. Alexis.
Hi, Akiko. Now, the big question is what investigation that actually is. So we'll get there in a second. Now, the attorneys for Tesla and Musk, one of the attorneys has filed a second letter in federal district court in New York on Monday. That was yesterday. This is after a letter on Thursday accusing the SEC of withholding what is $40 million in Tesla shareholder money that is eventually supposed to go to Tesla shareholders as a settlement fund that will be eventually distributed to them. So also they're accusing the SEC of retaliation for Musk's public criticism of the agency. Now, this second letter, it comes in response to the SEC's own court filing, and that one came on Sunday. And the SEC at that point denying all of those claims. Now, this second letter also adds the accusation that at least one member of the SEC staff leaked information regarding an SEC investigation into Tesla and Musk. Now, Tesla and Musk didn't identify the nature of that investigation or to whom the information was leaked, so we don't know that information at this point. But they said that this action violates federal rules that require formal SEC investigations to stay private. Now, according to Tesla, there was a SEC subpoena that was issued to the company and to Musk in November without court approval, they say. Now, Tesla and Musk also say that this subpoena was for documents for information that the SEC was seeking on compliance or non-compliance with Tesla's disclosure controls, its executive communication policies, as well as the court's prior judgment. So Tesla seeming to say there that the SEC is looking for information on whether he's been compliant with that past settlement. Now, on the other hand, the SEC says that the agency hasn't issued any subpoenas at all, but in particular, they say, as for that prior case. So what's unclear is if there's a separate investigation from the one that led to that settlement. And we'll show it on the screen there. That original settlement was to end the dispute over Musk's 2018 tweet, saying that he had secured funding to take Tesla private. This new subpoena also coming just 10 days after another Musk tweet that was just last month, saying that he was asking his followers on Twitter whether he should sell 10% of his stake in the company. Now, Tesla is asking for the court to seek an on-the-record assurance that the SEC has not leaked any investigatory details, and also to explain why these shareholder funds have been held up. They're calling the SEC's claim disingenuous at best. So far, the SEC has declined to comment on these letters that are going back and forth between the two parties.
A very complex story there, Alexis. As a follow-up, how long is the SEC saying it's going to take them to put a distribution plan on these penalties together?
Yeah, so as part of this dispute, the Tesla is upset that this $40 million, and by the way, this was $20 million from Tesla and $20 million from Musk paid in order to settle that 2018 dispute. They say that they expect this distribution plan to come by the end of March 22, not a guarantee there, but that was one of the main points of these letters that are going back and forth. We still don't know yet if the court is going to agree on a hearing or a conference to talk about these issues, but we would expect that the court would grant the parties at least an opportunity to talk with the court and figure out where to go from here.
And you can, of course, continue to follow all of Alexis's coverage on our website, yahoofinance.com. Alexis Keenan, thanks so much for that. Well, throughout Black History Month, we are celebrating the successes of the community through our series, Black History Moves Us. Today, a conversation with businessman and TV personality Damon John. He sat down with our very own Marquise Francis to discuss how he is helping to cultivate the next generation of entrepreneurs.
I don't believe that I've done 1% of my potential when I look at the hardships and the challenges that the generations have before me have faced and gifted me the opportunity to do this. But I do believe that we have to take ownership of our own, and we have to check our own community first and make sure that we're seen in a positive light, no matter what our upcoming has been. So as a young brown dyslexic boy who was raised by a single mother who didn't have any money and didn't go to college and actually got left back in school, but did not sell drugs and did not have any specific skill, I do want people of color and people of all colors to say that is just a man who learned how to educate himself one way or another, a man who's a good father, a good son, and a good a God-fearing person who believes in his community. I'm pro-black, but never anti anything else. And when I think that I get a public stage to be able to show people that, the Damon Johns of the world, there's millions of us, and but many of us don't have these opportunities that I had gotten, or this luck, and that you can find the next Damon Johns who will hopefully bring up other communities and bring up other people. I think that is my responsibility. And fortunate enough, I'm able to find other great people. I know you said banks like Chase and various other banks and large corporations who say, today's the day. We need to stop. Putting lipstick on a pig and making false, empty promises. And let's do this. And I want people to know that we're doing this by putting our name next to you. So I think that I'm just a leader by example. I know that obviously the Cosby Show before me showed a lawyer and a doctor in a home, African American with kids who none of them were on drugs or fighting gangs, and people let them into their living rooms, no matter what color the people were, and said, "Wow, this is just a family." And that's what I want people to see me as when they see me up on stage.
And be sure to catch the full interview with Damon John as part of Black History Moves Us. That is, of course, Yahoo's celebration of the culture and contributions of the Black community. That is airing on Thursday, February 24th, 3 p.m. Eastern. It'll be streaming live on Yahoo. You certainly want to tune in. Well, coming up on the other side, we are checking the latest market action. The Dow now down more than 1%, while the Nasdaq slides about 1.3% there. The escalation over in Russia and Ukraine continuing to rattle investors. Jared Blickery is going to give us a market update on the other side. We'll be right back.
Welcome back to Yahoo Finance Live. Again, tensions coming out of Russia and Ukraine weighing on markets as all of the major indices across the board remain in the red and appear to be steepening their losses actually through the session. Let's bring in Yahoo Finance's Jared Blicker, who's got more on the action. And there's also earnings today, so it's a bit of a noisy market. Some stocks actually doing pretty well, but across the board, again, story still red.
That's right, and we can hit retail in a minute. Interesting that Macy's had a huge gap up about 9-10%, gave almost all of it back. And I'm looking at the indices here, hitting session lows. I'm going to start with the S&P 500. Here we are, just hit that new session low only minutes ago, and you can see barely positive right after the open, and everything is being sold into. If you put candlestick charts up here, or candlesticks, you can see not any really big downdrafts here, just kind of some slow incremental selling, and we've been seeing these negative headlines just kind of drip through the market all day. And this is the S&P 500 on a 2-month basis, and this is why I'm pretty negative on the technicals. We are just inching down into what could be support. However, with no momentum, there could easily be a big downdraft. I'm thinking if 4,300 goes, probably going to see 4,200 pretty quickly, and I don't have that much confidence that it will hold, but we'll have to see how that shapes out. And now I want to take a look at the sector action where we are seeing staples, not staples, utilities is the only sector in the green, so pretty defensive, followed by healthcare, financials, also the leaders here, but only utilities in the green. Here's retail. XLY is a consumer discretionary S&P 500 sector ETF. That's down 3%. And we can take a look at some of those retail names if I can find my heat map here. And here we go. Here's retail. So Macy's really had a nice report, kind of knocked it out of the park, and investors just not liking what they're seeing here. Let me put up a 1-year chart of M, and you can see it's been consolidating over the last few months and tried to break to the upside today. Here's a 2-month view, and this was sold. So anyone who is holding in here, probably protecting that area. So we'll have to see if there's another catalyst besides earnings that can get Macy's through that hump. Also looking at Home Depot, guess what? People aren't spending as much, and so a little bit of a negative outlook there. You can see now down 20% over the last 2 months. And if you take a look at the, let's see, 3-year basis here, haven't seen these price levels going back to at least 2021. So kind of at a big inflection point potentially, but usually we get more selling after these big down days, as we've seen with Facebook and many others this earnings season, Brian.
Jared, I'll pick it up here. You haven't mentioned Tesla, down in a big way, down about roughly 6%, but also some of the other EV names declining as well. What's happening there?
Yeah, a lot of these companies do have some, tangential, I guess, effectiveness, or not effectiveness. They would be affected by the Russian sanctions only because there's so many parts with respect to EVs and rare metals, not the least of which is palladium and platinum. Those are used in the combustion vehicles. But overall, a lot of those metals that are mined over there in Russia are used in cars. And so we're seeing a lot of these stocks here really painting to the downside. And this is just today. You take a look at what's been happening year to date, just some of these names off 30, 40, 88%. Just incredible to see some of the downdrafts here. Now, if we take a look, let me get back to our market view. I want to take a look at Tesla here. You can see down 23% for the year, but in a certain sense, you can make the case that it's simply consolidating after reaching these new record highs last year. And this is something that Tesla has done many, many times. We saw this here with that big run up in 2021. This was a painful sell-off, about 50%, all the way from 1,200 down to about 600. And it looks like we're doing, or that at least this chart is repeating, or at least rhyming in some way here. So we don't know when the upside comes, but for now, just consolidating still some of those gains. Probably the fallout point somewhere around 700 here.
Jared Blickery, thanks so much for that roundup. On the other side, a big Olympics flop for NBC as ratings slide during the Beijing Games. We've got a breakdown of the numbers up ahead. Well, the Beijing Olympic Games may now be in the past, but NBC is still reeling from the lack of viewers. Ratings were down 42%, Brian, from the Pyeongchang Games 4 years ago. With just 11.4 million primetime viewers, Olympics ratings hit an all-time low for the network. That is a big ouch, but I can't say I'm necessarily surprised here. I mean, how much of the games did you watch?
Not a lot. Actually, I was trying to watch the what was it, the alpine skiing mixed event where it's by nation and they have both men and women compete. I couldn't figure out the scoring of it. I didn't know what was going on, so I just ultimately flipped it off, and then I turned on Cool Runnings on Disney Plus. Just to still, that way I was still like in the spirit of the Winter Olympics, but I wasn't, because it's just more exciting. But yeah, I mean, you also have to wonder though how much the politics played into it as well, with kind of the administration and maybe NBC themselves kind of maybe downplaying the Beijing Olympics because of just the political tension between the United States and China, but then B, just COVID and the inability for NBC to physically be there in the capacity that they were in Pyeongchang. I imagine all of that weighed on them as well.
I mean, I will say, just on a personal note, I find NBC's coverage to be too hyper-domestic. I mean, we watch the Olympic Games because it's an international competition, and yet the only ones that are often featured are the American athletes. I'm not sure if that really has an effect at all, but we should mention, even from the Tokyo Games, it was down. It was down 26% from the 15.5 million primetime viewers NBC saw during the Summer Games last year. Streaming, by the way, had the largest or second largest for any Olympics to date. And so, you know, Brian, that raises the questions with so many of these ratings discussions is, are people migrating towards a different platform? Not a lot of people have cable, or at least a lot of people I know have cable. And so, you know, maybe they are looking at streaming and consuming games in a different way. But yeah, I mean, a 40% drop is significant.
Again, the problem is just competition. You know, if you're streaming on Peacock, the barrier to switch the channel is a lot lower than it is when you have to change the input on your television. Again, for me, that's the reason why I was like, you know, I don't understand what I'm watching, so I'm just going to watch the Jamaican bobsled story on Disney Plus again. And people can do the same thing with Netflix. You know what? I want to rewatch Tiger King because I don't understand what sport I'm watching right now. You could do that. And I think that's going to be a continuous problem for NBC going forward.
I did find myself going to YouTube a lot, by the way, to see, like, I would read the headlines and see, oh, I want to watch that again.
Watch the highlights.
And I did finally get into half pipe for snowboarding. That is just incredible to watch.
That's sick. That's pretty sick, I will say. Chloe Kim, obviously, tearing it up.
Yeah, exactly. That was the highlight, I would say, of my limited Olympic viewing. We should mention, this is going to wrap up things for Brian and I, but we are continuing to monitor what's playing out over at the White House. President Biden expected to speak at the top of the hour. Of course, we are expecting the U.S. to announce additional sanctions against Russia after Russia moved their military troops into eastern Ukraine. This part of a broader response from the West as President Putin continues to pressure Ukraine. And of course, we're going to bring those comments from President Biden live for you as soon as they begin at the top of the hour. In the meantime, we're seeing the sell-off accelerate in the session with the Dow down about 460 points now. Keep it right here.
Welcome to A Time for Change, everyone. I'm Alexis Christoforous here with Marquise Francis. President Biden expected to address the nation any moment now from the White House, where he is set to announce new sanctions as Russian troops enter a Ukraine region and what the United States and other countries are now calling an invasion. Members of both parties, including Ukraine's president, have been urging Biden to follow through on his repeated threats to impose severe sanctions on Russia if they do invade. The European Union and the UK earlier today announced their first wave of sanctions. As for the market reaction from stocks and bonds to oil, even crypto, markets are reacting to the fast-moving events we're seeing unfold in Eastern Europe. We're going to bring you President Biden's remarks from the East Room of the White House as soon as they start to happen. But in the meantime, we want to bring in our first guest for this week's A Time for Change. So imagine this. You're an executive at the Clorox company where you've worked for 20 years, and one day you get a LinkedIn message about a recruiter, and that recruiter wants to talk to you about joining a cannabis company. I don't know about you, Marquise. Do you respond yes to that?
Well, you do if you're our first guest. Troy Datcher is a former Clorox executive, as you just mentioned, and the current CEO of the parent company, the largest vertically integrated cannabis company in California. The company's chief visionary officer is none other than Jay-Z. So if you ask me, I think my answer would be yes. So Troy, thank you so much for joining us this afternoon.
Thank you for the opportunity. Great to be here.
Absolutely. So I have a simple question just to start things out. Which is harder, leading Clorox global sales at the top of the pandemic or diving headfirst into the cannabis industry with all of its complicated regulations and tough pricing conditions?
I'd have to say the latter. I spent 3 decades in the consumer products packaged goods industry with a couple of blue chip companies, Procter & Gamble and Clorox. And I spent 22 years at Clorox in the sales function. And so I was well equipped to deal with the challenges of the changing landscape of consumer products packaged goods, even in the face of a pandemic. I'm learning quite a bit in my new journey here as the chief executive officer of the parent company. A lot to learn about the industry, a lot to learn about being a CEO. In a very incredible dynamic landscape of the cannabis industry as it's forming here in the U.S.
So it's been a little over a year since the SPAC, about 5 months since you joined as CEO. So in that short amount of time, relatively speaking, what are some of the biggest challenges and also the opportunities that you see for the parent company?
Well, the biggest challenges are ones that we're all facing as California operators. There's been a commoditization of flower in the marketplace here, which has provided some challenges that were unique to the situation here in California. We've got some regulatory and legislative headwinds here that makes this marketplace a bit unique. And so we're all faced with those. The good news is all the organizations are faced with those challenges. And what we've done collectively is really band together. One of the welcoming things that's been great for me coming into the industry is really folks reaching out and sharing their war stories, being transparent with me about the challenges and the opportunities. And So I've found a very welcoming environment to step into in the industry because we're all facing some of the same challenges. The great news is that we've got people listening on both sides of the aisle on things that we think will be helpful to build an equitable, thriving industry that we can all be proud of a decade or more from now. So I'm really excited about the opportunity that we have in front of us. And I'm energized by the challenges that we're facing, because I think there are answers that we all collectively can get to together. And that's what makes this opportunity exciting.
Yeah, Troy, and I know equity is a core tenet of the parent company. So the parent company has a social equity fund. Tell us why your fund will succeed in a state where equity programs seem to be stalling.
Yeah, well, first and foremost, it was one of the reasons that really drew me to this opportunity is the purpose behind why we're the operator that we are today. Not only do we want to provide safe, effective products for the consumers in which we serve, but we want to build an industry from the ground up that's more equitable. And at the heart of that is placing aside the resources to help Black and brown entrepreneurs enter the space. And importantly, my team is dedicated to putting our resources, our knowledge, our talent against these operators to make sure they're successful. What makes us a bit different is that this is really born out of authenticity. This is really born out of a foundation of who we want to be as a stated objective, the most impactful company in the cannabis industry. That is not just a bottom line, top line objective for our organization, but we want to model what it's like to be a great corporate citizen in this new emerging industry. And so one of the things that we've set aside is that the dollars which you mentioned, but the time and the energy, the focus, the passion behind the work that goes from my team to these new entrepreneurs is something that we are all very proud of.
You know, Troy, here at Yahoo Finance all month long, we have been celebrating Black History Month. And I'm just curious what this means to you as a Black man in this job at this company, you know, at this point in time. What does this role mean to you? And sort of I mean, I know you're pretty brand spanking new there, but what's the legacy that you hope to leave for those who follow?
Well, legacy is a very, that's a really heady word. And it's one that hopefully we'll grow into as an organization. But I'll tell you that, like many communities that are reflective of my experience, I know people personally. My own family has been impacted by the war on drugs. These antiquated laws that have impacted our communities are ones that we're still fighting to make sure that we bring some justice and attention to them. And I firmly believe that if we can actually build an equitable industry from the ground up, from the very beginning, we're going to all be proud of the industry that we build, because it'll be inclusive and importantly, it will allow others to participate in what's going to be a really thriving economy that for the industry itself. I'll tell you this: I worked, as I mentioned, in consumer products industry for 30 years, and we've been trying to really retrofit the industry with diversity and inclusion over the last couple of decades. It's much easier to build an industry from the ground up with that intention than it is to retrofit it. And so we have an opportunity as an organization to set the standard. You know, I'm not very preachy. I'm not going to tell people I'm right and you're wrong. I think we can set the example, though, for others in the industry. You know, my leadership team will be reflective of the communities in which we live, work, and serve. The folks that are part of this organization will have a authentic connection to those communities. And that's what we're excited about, is being able to showcase how this can be a really great opportunity for all. And we'll do that by sharing the example versus preaching to others that this is a good thing to do.
Yeah, I appreciate that sentiment, Troy. And last question here. California obviously was on the forefront of legalizing marijuana, and we're seeing other states like New Jersey and New York legalize, but we're also seeing Black Americans who are looking to get these licenses far behind our white counterparts. And so just in your experience, for folks watching who are looking to get into that marijuana space, What's some word of advice here in the last 30 seconds that you would give to folks who look like you and I want to get into this space?
More so than ever before, I think states are doing a better job of providing a platform for folks to participate. If you take a look at what's being done now in states like New York and others as they're bringing cannabis regulation legal to the market, they are building social equity programs to allow folks to enter at the very beginning of the industry as it's being built. I'd ask that folks that look like me to just to inquire about those opportunities. Reach out to people like me. It's easier to find folks like me today than ever before. I'm a LinkedIn search away, but I think what you'll find is folks that have put one foot into this industry are reaching back to pull others in. And so I think what folks will find as they do their own research within their state and municipality and on what the rules are, they're going to be folks like me who may have a head start, whether that's a 5-month head start in my case, to reach back to others and provide as much knowledge, education, and understanding of the landscape as possible. So I'd say do your homework, reach out to others, tap into the networks, and I think what you'll find is folks who are reaching back, who want to help build an industry that's reflective, again, of the communities in which we serve.
Mm-hmm. Well, we certainly know you answer your DMs on LinkedIn. So Troy Datcher, the parent company CEO, thank you so much for being here. Coming up, as Black History Month comes to a close, Shark Tank superstar Damon John reflects on his own legacy. Stay with us. Welcome back to A Time for Change. It's been 30 years since the launch of FUBU, the hip hop apparel brand that put streetwear on the map. FUBU stands for Us, By Us, and was started by Damon John and 3 of his childhood friends from Queens. The company has gone on to have $6 billion in sales, and of course, Damon John has gone on to become a household name through Shark Tank, books, and motivational speaking. I talked to him directly about his legacy, and he answered with his trademark blend of inspiration and modesty. Take a listen.
I've only done 1% of what the people prior to me have done. I mean, there are a lot of people who risked their lives and lost their lives, and didn't have and marched in the streets until they died and never got to see the freedom that we are allowed in life. I think that, if I can keep educating and keep empowering communities of all colors and showing people that you don't have to be able to sing, dance, or have a very special skill, but if you're willing to get up before everybody and go to sleep after everybody, that you can make it. I think that is my biggest inventory and my biggest asset that I can help people with.
And then just looking ahead, 10, 20 years from now, what is your hope that folks can look back and say, Damon John, this is the legacy you left?
10, 20 years from now, there's going to be a young little man or woman who right now they're watching Shark Tank in their little PJs, eating some Captain Crunch. And they're looking at me and they're saying, I can be bigger and better than that man right there. He's showing me the path. And that person is going to be the next Oprah Winfrey or Barack Obama or Steve Jobs or Elon Musk, and they're going, or Warren Buffett, and they're going to change the world. And they're going to say, my first understanding that I can do it was I watched this guy who came from nothing, and he did it, and I said I'm going to do 10 times or 100 times or 10,000 times better than him.
And I guess they also have to wear that Yankee cap too, which I liked, Marquise. I don't know about you. That was a great conversation you had. Of course, folks can check out the whole thing at yahoofinance.com. There was one thing that sort of struck me during that interview, and I'm not a big fan of doing this, but it paid off for his mom. I know his mom took out a second mortgage on her home for like $100,000 to help Damon John start his company.
Yeah, it was really revealing. He talked about working at Red Lobster and going into all these banks and asking for a loan. He got shut down time and time again. So it's really that fortitude of believing in himself and his mother believing in him. I know it's super risky to take out a mortgage, and obviously in this case it paid off. FUBU, $6 billion. And I think the biggest thing I took away was just believing in yourself. He talked about waking up before everyone else and going to sleep. Make sure you get the sleep that you need, but really believing in yourself. I think that was the through line. And so really looking forward to showcasing that entire interview. And for everyone watching right now, be sure to catch that full interview with Damon John as part of our Black History Moves Us special, Yahoo celebration of the culture and contributions of the Black community this Thursday, February 24th at 3 p.m. Eastern, streaming live on Yahoo.
All right, be sure to check it out. Lots of great interviews there. Coming up here, though, on A Time for Change, NBC Universal saw its lowest rated Olympics ever 2 days after the closing ceremony. What is next for all of those athletes? We talked to an old Olympic pro about life after the big games in a moment. Welcome back to A Time for Change. Well, the Olympics are over, and for many of the nearly 3,000 athletes who participated, now the hard part begins, right, Marquise? Adjusting to life after the highs, lows, and adrenaline of those games.
Yeah, personally, I don't know if I could do it myself, but Lindsey Vonn won her last 3 Olympic medals in 2018 and spent the Beijing Games this time around as a correspondent for NBC. I talked to her recently about how she's reinvented herself post-Olympics and why she feels so compelled to speak out about mental health.
I think it just was important for me personally. You know, I first started talking about it in 2012, and that was really a step that I felt I needed to make, just to unload the burden that I felt on my shoulders. And, you know, since then, so many athletes have come out and started talking about it. You know, Michael Phelps obviously being kind of one of the first big athletes, and Kevin Love, and then, you know, obviously recently Simone Biles and Naomi Osaka. So I think that it's an important conversation to have, simply because through this conversation, we can shed light on an issue that I feel is, you know, maybe misunderstood or underrepresented, and hopefully help others to encourage them to seek help and go to therapy and get the support from family and friends that they need.
And a portion of your book that really resonated with me was the part where you talked about grief. And you talked about when you make a transition, even possibly a positive one, all of the feelings that come up. You talked about things like denial, pain, anger, depression, reconstruction, and then acceptance. So I'm curious, where are you at in your journey currently? And how have you used your mental health journey and going to therapy even in a productive way moving forward?
I actually think therapy's been one of the best things for me in this next chapter. You know, since retiring from skiing, it was definitely a difficult transition, as you described, all those feelings that I went through. You know, I relied on skiing for pretty much my entire life. I've been skiing since I was 2.5 and racing since I was 7. And I think it's an interesting transition, you know, as an athlete, because you're, you know, again, you're relying on something, and I've always been very goal focused. And, you know, I woke up one day and skiing was gone. I didn't, you know, obviously I have a lot of business, but, you know, there's not a tangible goal right in front of you. You know, business is obviously a lot different, also measuring success. And I think that's one thing I enjoyed about skiing, is that, you know, as an athlete, you work hard and you see, you know, a measurable level of success. So all of those things kind of were difficult for me to maneuver around, but therapy was a really big, was huge for me, in the sense that I was able to really realize what I wanted now in this next chapter, and realize who I am without skiing. But it was a difficult transition, that's for sure.
You mentioned business, because another part in your book, you talked about really delving into the space of business. And one of the things that you actually said is that you don't get involved with anything you don't believe in. So you've been able to be in different rooms that they know you, but they don't necessarily always want to hear your opinion, but yet you had to break through kind of the stereotypes. So what has that experience been like, really breaking through and letting people understand you know what you're talking about?
I think it's a really good challenge for me. You know, obviously I wish that I had more respect in a lot of ways when I walk into a room for my opinion, but I think it's good for me to learn and, you know, obviously take those steps and prove myself. You know, I want to be able to walk into any boardroom and have people respect what I have to say. But I think that's, you know, that's taken me a while, and I think it's going to continue to take me a while to really have that level of respect, because right now, you know, I'm an athlete and I'm coming into a room. You know, I think my looks, you know, may or may not help me. I think maybe it's more of a negative than it is a positive, because, you know, they don't necessarily want to hear what I have to say. So it's my job now to be educated and be in a position where I can contribute to the companies that I'm advising, the funds that I'm advising as well. And hopefully my opinion will be respected over time.
I'm curious, how do you exactly choose what company you want to invest in next?
Well, obviously the numbers are important. You know, I want to make sure I'm diligent in those details, but I think for me, the main thing is looking at the leadership. I really believe in relationships and leadership, and all the companies that I work with have amazing leaders. I've been with Under Armour for almost 20 years, and I've always believed strongly in Kevin Plank and his vision for the company. You can't have the level of success that you need without great leadership. So that's, I think, for me, the biggest component to choosing the companies that I work with.
Right. And now that you have officially stepped away from actually being a skier, you're stepping into all these other arenas, right? You're an author, you're now a commentator and an investor. So I'm curious, how have maybe some transferable skills from being an athlete translated to all of these different sectors?
My work ethic is the biggest component that I've taken from skiing into business. I think what made me great at skiing was my ability to work hard, but also to never be complacent and always try to learn and keep an open mind. So now in this next chapter, when I walk into a room, I'm trying to learn, I'm challenging myself, I'm always working hard. And I'm doing, I'm working hard, not just in the boardroom, but, behind the scenes as well, because preparation is key. And that's, again, another component to the work that I put into my skiing career that made me successful. So there's a lot of similarities in how I prepare and how I approach business, similar to what I did in skiing.
And you recently had an internship with VC firm General Catalyst. I'm curious, how was that experience?
It was great. Paul Kwan was such an amazing mentor to me and really kind of walked me through a lot that goes into investing and funds and just everything that I didn't know. He really walked me through it. And the only reason why he even approached me was because I'd gone to a previous speaking engagement and I was asking CEOs all of these questions. And that's why, he actually contacted me and asked if I wanted to do it. So I think, my drive to learn is what's helped me get to this position.
We talked about, obviously, all the work you're doing, books, production, all these things. I'm just curious, outside of skiing, what does Lindsey Vonn do for fun?
I'm pretty boring when I'm not working. I mean, I'm usually trying to, when I'm not working, I'm either working out or I'm trying to relax, which entails, eating ice cream and watching TV on the couch with my dogs. If there's a perfect night, that's what it would be for me. I'm a pretty simple person.
All right, and that was a great interview, by the way. Lots of great insights there from Lindsey Vonn, Marquise. And that's going to do it for this week's A Time for Change. From myself and Marquise Francis, thanks so much for joining us. But don't go anywhere. There is still a lot more to come here on Yahoo Finance Live. We are awaiting remarks from President Biden regarding the latest on the situation between Russia and Ukraine. He's expected to announce new sanctions against Russia. The U.S. now calling troop deployment there an invasion by Russia into eastern Ukraine. So stay with us. Lots to cover, including how it's all playing out for the markets, from stocks and bonds to oil and even the crypto markets. We're back right after this.
Good afternoon, everyone. I'm Karina Mitchell, along with my co-anchor, Alexis Christophers. Thanks so much for joining us on this busy Tuesday afternoon. We are expecting to hear from President Biden momentarily from the White House over those rising tensions between Russia and Ukraine, which escalated over the last 24 hours. U.S. officials now calling the independence that Russia called for Luhansk and Donetsk as an invasion. So we will wait to hear what he has to say. We are expecting sanctions to come in. Markets at session lows ahead of those comments. So let's take a quick check of the three major benchmarks to see what they are doing now. The Dow is down by 505 points. That's slightly off session lows. The S&P is down by 52 points, and the Nasdaq is lower by 202 points. Let's take a check of the bond market as well to see what is happening there. And we see the 10-year is now at 1.92, so coming off its high earlier today, and the 30-year yield at 2.23. All right, as we await comments from President Biden, let's get a preview of what he is expected to say and bring in our Yahoo Finance's Jennifer Schoenberger. Jennifer, the U.S. has held back on announcing more sanctions, just those initial ones that came yesterday, while the EU and Germany has made a bigger response.
Good afternoon, Karina. Yes, as we await President Biden here, who appears to be running a bit behind, he is set to offer an update on Russia sending troops into Ukraine, whether that officially rises to the level of invasion and what punitive actions the U.S. could take. The president expected to announce new sanctions on Russia, though those sanctions are supposed to be different from that severe set of sanctions that the U.S., in conjunction with Western allies, is expected to take. That, according to White House officials last night, though, of course, given the fluid situation and the developments, that is subject to change. We did hear earlier today from Jonathan Feiner, White House Principal Deputy National Security Advisor on CNN, who did call Russia's actions a, quote, invasion when pressed on what term to use, though the White House has stopped short of actually using that term thus far. Now, all of this coming after, as you mentioned, President Biden signed an executive order on Monday that would block trade and investment by Americans in those regions of eastern Ukraine that Moscow now recognizes as separate from Ukraine. And all of this, of course, coming after the European Union as a whole, as well as the UK, have issued their own sanctions against Russia, including sanctions against Russia's Vladimir Putin's inner circle. So we await the president, the world awaits America's response, guys.
And Jen, we already know that the UK and European Union have imposed what they're calling their first wave of sanctions. Can you give us a feel as to what those are and what we as the U.S. might do in response?
Yeah, so the UK taking the tact of sanctioning individuals within Russia. They're targeting as well Russian banks. They have targeted Russian banks and 3 Russian billionaires that are within Putin's inner circle. So they are trying to target Putin directly. We'll see what the U.S. has up its sleeve. There have been a slew of actions the U.S. could take. Again, officials telling reporters late yesterday that they will stop short of the most severe sanctions that they are hoping to use in conjunction with Western allies. What those specific sanctions are at this point remains to be seen.
All right, Jennifer Schoenberger, thank you so much. We're going to stay on this crisis and bring in our next guest for analysis, Ariel Cohen, PhD and Senior Fellow from the Atlantic Council. Sir, thank you so much for being here. I just want to hear from you. What do you think President Biden needs to say? What sanctions need to come, in your opinion? And then why wait so long? I know he signed that executive order. We just heard about that from Jen yesterday, but those were muted compared to what Germany and the EU have instigated, and the UK, as far as sanctions.
Well, first, this is an invasion because I carefully listened to 1 hour long President Putin's rambling justification on Russian TV, what they're doing. And they said they're going into Ukraine. They deny Ukraine essentially the right to exist, despite the 2 presidential elections Ukraine went through. The Ukrainian president has more legitimacy than Mr. Putin. Secondly, they said that the two regions that they recognize, they don't recognize just the areas currently controlled by the separatists, the Russian-supported separatists. They recognize the whole administrative boundaries of that region. That means they would go to the Sea of Azov, the sea that is adjacent to the Black Sea, which means more war. And Putin was talking about how the whole territory of southern Ukraine, of eastern Ukraine, all of it belongs to Russia. And it's very clear to me that they are moving in the direction of expanding the war. They understand that NATO and the United States do not want to fight them in Ukraine. And I understand why. We are coming out of 20 years of nonstop wars, more than 20 years. We do not want another war. And the Russians want to rebuild their Eastern Orthodox Slavic empire. That's Ukraine, Belarus, and Russia. And that's what Putin is doing. Therefore, the sanctions should be strong. They should understand that they will be severely impaired in terms of their economy, in terms of their living standard. So their aircraft industry, their high tech, their oil and gas, all will be subject to severe sanctions, both from the US and Europe. To my surprise, the Germans are going ahead and are suspending the Nord Stream 2 pipeline, and their sanctions against the banks, the sanctions against individuals in the Putin circle, all 351 members of the Russian parliament, the Duma, who voted for this despicable invasion.
So, Ariel, can you tell me, you expect Putin to go after the entire Ukraine area, and I'm wondering, why did he choose to go this route by granting independence or recognizing independence, as opposed to what he did in Crimea and annex the area? And if you're, areas like Lithuania and Estonia, how worried are you, and how closely are you watching? Because does he end here, and why is he choosing now to do this?
I would say that for now, he chose Ukraine because Ukraine is not a member of North Atlantic Treaty Organization. It's not a member of a military alliance, whereas Lithuania, Latvia, and Estonia, the three Baltic states, are. And we will have a much bigger issue at hand if Putin starts presenting territorial claims against these republics. And what he did was unbelievable. He went back 100 years to the creation of the Soviet Union in 1922. We're at 100 years of the creation of the Soviet Union this year. And he tweaked and twisted different arguments, how Ukraine was created supposedly by the Bolsheviks. That is not true. Ukrainian independence was declared right after the February Revolution, before the Bolshevik coup. Yes, some territories were added, some territories were subtracted, but this is immaterial, because what Putin is doing, he is destroying the principle of invincibility of European borders that was recognized by the West and the Soviet Union in 1975 in the Helsinki Agreements. He goes back even to the Yalta Accords of 1945, when Stalin, Roosevelt, and Churchill agreed on borders of Europe. And now Putin is moving in the direction of erasing these borders. This is extremely dangerous. I still don't think that we're moving towards a clash between NATO and the United States and Russia, but the territory of Ukraine, all the way to the Dnieper River, I wish I had a map here, all the eastern Ukraine and the capital city, Kiev, or Kyiv in Ukrainian, and the south all the way to Odessa is in play right now, unfortunately.
And then I'd like to talk about energy prices, because Germany halting certification of Nord Stream 2, what does Russia do in reaction? And is Europe prepared for it? Because 40% of the gas that goes to, natural gas that goes to Europe, comes from Russia.
For the first time, Europe imported more LNG, liquefied natural gas, than piped gas. Most of Europe's gas is coming from Russia. I think with the Nord Stream 2 that now is in play, it would be 50% plus of the German gas would be from Russia. Currently, it's 40%. And Europe has created with its own hands this ridiculous situation because they were shutting down not just coal. I understand why you want to shut down coal because of the emissions, but they also were shutting down zero emission nuclear power plants. So they were left with only gas because their solar and wind were not sufficient to supply energy they need for their industry and for the heat in their houses, and also natural gas that they need for industrial production. So they created this problem. It's a up to $2,000 per 1,000 cubic meters. In Europe, they are metric, they trade in cubic meters. So it's a very high price. And because Russia was squelching the supplies already, they don't have a lot in reserves right now. So one cold spell and Europe will have to either disconnect some of the electricity or slow down industrial production. It is an ugly situation. And they need to think hard and fast what to do. Maybe bring back some of these nuclear stations. Germany is planning to disconnect or disconnecting last year. It's 6 altogether. That's a lot of power.
That is a lot of power and a lot of challenges ahead. It's like we're watching a chess game and waiting for the next move. We'll have to leave it there. Ariel Cohen, PhD and Senior Fellow from the Atlantic Council. Thank you so much for your perspective today. Alexis, I'll send it over to you.
All right, thanks a lot, Karina. Lots more to get to here, including how all of this is playing out for investors on Wall Street. We're going to dive in right after this. Welcome back. It looks like the stock market is now hitting fresh lows for the day as tensions between Russia and Ukraine escalate, with the U.S. now saying that Russia's troop movement into eastern Ukraine is, quote, an invasion. We've got Inez Ferre live for us at the Nasdaq for a look at what is moving today. And Inez, I was looking at the sectors. All 11 S&P sectors are down, with consumer discretionary leading the decline. You know, in addition to all this that's playing out between Russia and Ukraine, we got news here that consumer confidence slipping to a 5-month low.
Yeah, that's right, Alexis. Consumer discretionary is down the most right now. You've got some of the defensive sectors that are losing the least, but still all 11 sectors of the S&P 500 in the red. Let's take a look right now at what's happening with the markets, because we are around session lows right now. We're watching the Dow that's down 1.7%, down about 582 points right now. The Nasdaq down 1.7% as well, and the S&P 500 also at session lows. Taking a look at some of the commodities, we are watching Brent crude prices, and I'm talking about Brent because Brent tends to be more reactive with these geopolitical tensions. Remember that Russia provides about 10% of the world's oil, and this morning Brent crude reaching $99 a barrel, but giving back some of those gains. Of course, you've got nuclear talks with Iran that are progressing. That would mean more supply, keeping a lid really on oil prices. WTI up 1.2% right now at around $92 per barrel. I do want to mention natural gas up 1.7%. Remember that Russia provides more than 1/3 of Europe's supply. Some of that runs through pipelines in Ukraine, but you did have Russian President Vladimir Putin saying that Russia is going to continue uninterrupted natural gas supplies to the world markets. Year to date, natural gas is up about 18%. And then just mentioning gold futures, because we've seen quite a bit of a movement with gold futures hitting a 9-month high earlier. Right now, up about 0.2%, up more than $5 per ounce at $1,905 per ounce. Alexis, Karina?
Yeah, a lot of people moving into gold as that safe haven. But also, what's going on with the other metal space? Because I know aluminum and nickel are at multi-year highs over a supply threat from Russia.
Yeah, that's right. And you've got some of these other metals that have been moving higher because Russia is a big miner for some of them. Specifically, let's take a look at platinum futures, which are higher today. We're also taking a look at palladium futures on our Wi-Fi interactive board. Palladium up more than 1%. Now, Russia is a big exporter of both palladium and platinum futures metals. Russia, in fact, is the second largest miner of platinum, and it is and the world's largest exporter of palladium. And palladium, by the way, is used in automotive exhaust systems and smartphones. So this is having quite a big impact on other metals. Also, I want to mention nickel is up more than 1%. I don't have it on my chart here, but nickel is also used for electric vehicle batteries. And in fact, I'm going to pull up the EV space right now, and you can see the EV space getting largely decimated today. Tesla down more than 6%. Some of these other EV players as well lower today. Karina, Alexis?
All right, few places to hide today for sure, Naz. Even crypto getting hit pretty hard. We're going to talk about that in the next hour. Thanks so much. Karina?
Okay, we've got much more market coverage ahead as we await comments from President Biden, now expected to speak at about 2 p.m. at the top of the hour. But stay with us. We'll come back after a quick break. And welcome back to Yahoo Finance. Well, we are seeing the markets accelerate losses as tensions over Ukraine and Russia continue to escalate. We are expecting comments from President Biden in the 2 p.m. hour, and we'll bring those to you as soon as they happen. But we want to stay on the markets and bring in our next guest for reaction, Scott Ladners from Horizon Investments, the Chief Investment Officer there. Scott, thanks so much for being here today. Just want to get your sense of reaction in the markets today to the escalation in tensions over the last 24 hours.
Yeah, it's been a little bit of a round trip, a couple of round trips actually in the last 24 hours. I woke up in the middle of the night last night, took a look at my phone, and saw futures down like 90 in the S&P. So we're down 2% or so. And then I woke up for real this morning, and we were almost back to flat, and we were actually up for a little bit of time this morning. After some of the economic data. So that sort of reaction, along with what the ruble's doing, is not reacting tons and tons until the last few hours, and what rates are doing, importantly, in the United States, are telling me that the people are they're already sort of positioned for something like this. But certainly some of the headlines over the last couple of hours have not been helpful. That's drug, that's certainly hurt risk sentiment, hurting crypto, is hurting stocks. But we do think there's some positioning that is probably going to be a little bit of a buffer to the downside. But that's being juxtaposed against a really poor liquidity environment in markets right now that are meaning that any of these moves that we're getting right now are just going to be exacerbated, either to the upside or to the downside. And that's just the nature of the beast right now. But we're actually okay with how the markets are taking this right now. The thing that we're really watching is credit spreads, because the transference of like any of this Ukraine and Russia action into actually impacting U.S. financial markets is not going to be through earnings. It's going to be through something like an energy scare or energy price hikes that will probably end up being fairly temporary, and therefore sort of producing possibly a growth scare. And so credit spreads would probably be the thing that you would want to watch to pick up on that. We're not seeing very much movement out of credit spreads right now.
Well, then what do you see happening with the energy sector? Because we saw Brent pushing 100 earlier today. It's now retreated. It's down to about 96. WTI also escalating. Where do you see prices going if there is an even further escalation? And how long do they remain elevated?
They could certainly go up from here, and because just looking at options markets, there's a lot of options bets that are out there in the oil market right now that are predicting Brent prices between $100 $125. Just for technical reasons alone, we could see oil jump to something like that. That would probably be temporary though, because at the end of the day, if we end up getting some sort of hot war, if we end up getting something that's more drastic than we're predicting right now, that's downside for growth. And very high energy prices are pretty inconsistent with with downside growth scares. In addition to that, we have started seeing some rig counts in the United States go up. So at some point, the shale guys turn the machines back on, and they start pumping oil and becoming that very important marginal supplier to the world. They really haven't started to do that yet. They're just maybe getting ready to. But having sustained oil prices north of $100, we really don't see in the cards.
Scott, I want to ask you, usually markets don't normally react too much to geopolitical tensions, but obviously this is a huge deal. So I'm wondering what mistakes do investors need to avoid making today? What can they make? Kathy Wood from ARK Investment says the biggest mistake one can make is piling into index funds at the moment, because that's where all the risk is. What's your opinion, and where does your allocation go at this point?
We do think that you should be a little bit more defensive, just because, look, this year we think is going to be a little bit of a choppy year. It's not going to be an easy year like last year, where you had basically the wind at your back from a monetary standpoint, you had the wind at your back from a fiscal standpoint, you had the wind at the back from a consumer spending standpoint. All of those things that were tailwinds last year are going to be a little bit more of a headwind this year. And so we do think we're in for more of a range-bound type of market, probably like violently going nowhere sort of market for 2022, with a little bit of an upside bias towards the end of the year. But it's this is one where you're probably just going to want to sit tight. You're probably going to want to try to avoid the head-to-head the day-to-day headlines, because extrapolating out from what we're seeing on the intraday moves is going to be really, really challenging in a low liquidity environment where we're really in sort of a vacuum in terms of the amount of information we're going to get out of anything that's going to be meaningful towards even like a 1 month to 3 month sort of investment horizon.
Easier said than done, avoid the headlines. But I'm wondering, how does all of this impact Fed policy? And do you think now that a 50 basis point hike next month is off the table?
Yeah, we've never really thought that the 50 basis point hike was much of a probability. You've had some outside members of the Fed suggesting this was a chance, but the core members of the Fed are pretty staunch in the fact that, listen, we don't need to be making large shifts. The Fed has gone through, frankly, the last 5 months they've been lurching, and all global central banks have been lurching from policy to policy. That's not how central banks want to operate. So I think we need to harken back to maybe some of the measured pace language that we had in Greenspan in the early to mid 2000s, when really they were hiking 25 basis points every single meeting. The market understood that, they knew that. It was almost a kind of a calming influence, as calm as a kind of a rate hike cycle can be. I think the Fed's really wanting to get back towards that measured pace type of language, that measured pace type of communication, and stop lurching from hawkish to dovishness, because that kind of reaction function is not helpful for either the real economy nor for financial markets.
Okay, we will have to leave it there. Thank you so much, Scott Ladner, Horizon Investment Chief Investment Officer. Thanks for your perspective. Alexis?
Thanks a lot. We're still waiting for President Biden to address the nation on the very latest between Russia and Ukraine. We'll give that to you live once it happens. We're back right after this. Welcome back, everybody. You are looking at a live picture of the podium at the East Room of the White House, where we are awaiting President Biden to make remarks on the Russia-Ukraine conflict as tensions there escalate. President Biden expected to join the UK and the European Union in imposing stiff sanctions against Russia for what the U.S. is now calling an invasion into Ukraine. And there are few places to hide for investors amid all of this geopolitical uncertainty. We have three major indexes now at fresh lows for the day, with the Dow off more than 600 points. Every one of the 11 S&P 500 index sectors are lower. The S&P down now 71 points, and the Nasdaq Composite giving back more than 260 points. Amid all of this, of course, we've got oil rallying, gold, as well as investors seek the safety of some commodities. And earlier we had Brent marching towards $100 a barrel oil. I want to check in with Jared Blickery now for a closer look at what has become a broad-based sell-off. Jared?
That's right, Alexis. And we're going to take a good look at those commodities in about 30 minutes with the WTI close. But let's take a look at the Nasdaq Composite here. Down almost 2%, and it's been a steady bleed lower for most of the day. Not seeing any big down spikes, but that also means that there's not that momentum to the downside just yet. And that means breaking these lows here pretty easy. And in fact, looks like we're about to do that in the Nasdaq. S&P 500, a little bit less bearish here, but you can see still closing in on those 4,200 lows. And be surprised if we don't hit those and exceed them sometime in the next 24 hours. Let's take a look at the sector action. Nothing in the green. Utilities had been about an hour ago. It has sunk into the red, followed by healthcare and real estate. Those are the outperformers. But check out consumer discretionary. Home Depot and Macy's earnings weighing, well, at least the stock reactions, I should say, weighing on the sector. Energy also down about 2.5%. Materials taking it on the chin as well. And you take a look at the mega caps inside the Nasdaq 100. Tesla's a standout. That's down 6%. And in fact, if you take a look at our EV screen, a lot of these companies under pressure. Some of them have exposure to Russia, but generally the situation there, anybody with European or Russian energy exposure looking to be a little bit bearish today. Also taking a look at some of our market leaders, all of these in the red, but I want to concentrate on the bottom row because this is where money is flowing out of, these very sensitive industries. We got cannabis, Chinese internet stocks, retail, solar, home builders, which recently hit record highs, IPO, and of course the ARK Invest components not looking that bullish today. Now, if you're looking for a spot where we might see a little bit of green, well, guess what? It's not the travel sector. We got Airbnb down 7%, Booking down 4%, and the cruise lines not faring that well either. Carnival down 3%, Avis Budget Group down 5%, guys.
Yeah, a whole lot of red on the screen there, Jared. And amid all of this, we forget it is earnings season. You touched on it. Macy's reporting fourth quarter fiscal earnings, and Home Depot as well, beating on the top and bottom lines, but fourth quarter gross margin missing expectations. Yeah, a lot of companies have had those troubles with margins this earnings season. Nevertheless, analysts really like a lot of the results. They did raise their dividend by 15%. And let me just pull up the stock here. So 9% down is a pretty big move for Home Depot. You take a look at what they've done over the last 3 years, still holding on to gains of 62%. And of course, this was an early pandemic favorite when people were spending money to rebuild their homes and also add on to them. And that's still going on, but to a lesser degree. Some of that demand evidently pulled forward a little bit. Now, Baird, which rates the stock and outperform with a price target of $425, over $100 above the current price, sees the gross margin decline of 36 basis points, worse than Baird's expectation of 15 to 20 basis points. Similar to prior quarters, average ticket drove Home Depot's comps. That's up 12.4% as traffic declined against steep 1 year ago comparisons. So people spending more money per average ticket is actually increasing their comps, even though foot traffic is down. So I think that's pretty telling as well. Baird is watching inventories. Those increased 32% year over year, likely due to inflation, as they say, and higher in-transit inventory. Those rising inventories can weigh on results as well. Also want to take a note from Wells Fargo. They rate the stock an overweight, price target of $460. You can see about $150 above the current price. Home Depot's size and scale clearly helping manage through today's difficult inflationary environment. But with incremental EBIT margins moderating to 18%, it appears that pricing and mitigation levers can only go so far. But there you have it. Home Depot still looking at gains of 62%, but let's check this out. Over the last 3 months, some of these retail stocks really under pressure here. Home Depot down 23% over that time period.
Yikes. All right. I know Home Depot and Boeing, two of the big Dow components that are pulling that index so much lower today. Want to get to the Yahoo Finance Plus investment idea of the day, Jared. It is a bullish call on Marriott. In their earnings call, they were talking about a return to corporate travel.
Yeah, it's pretty interesting there. Nice to see that getting mentioned as well. So this is a report by Argus Research, and let's take a look at what they're saying about Marriott. Now, Marriott recently hit record highs. You can't see it right now, but those highs from last week were records. So they have a long-term target of 206, maintaining their buy rating after a strong quarter. They're also saying, we believe that Marriott's profitable fee-based business, strong liquidity, and emphasis on corporate travel. They position it well for an earnings recovery in 2022. The company's global operating model, in which it is able to expand room capacity anywhere in the world, also a strong positive. And they go over some of the numbers, ending by saying they're raising their 2022 estimates to $5.50 from $5.45, and setting a 2023 estimate of $7. So their long-term earnings growth rate forecast is 12%. Just a quick look at the chart. Again, these are record highs, had a pretty strong 3 months, as a lot of reopening stocks did. And you can see up over 8% during that time period, guys.
All right, thanks a lot for that roundup. Lots going on today and a lot of red on that screen, Jared Blickery.
Yes.
Want to stick with the markets now and bring in Craig Fair, investment strategist at Edward Jones. Craig, on a day like this, when there are fast-moving, changing headlines regarding geopolitical tensions, what are the top 2 things investors should be thinking about with regards to their portfolio?
The first would be you have to make sure that investment decisions are aligned to your situation. Anytime where, nothing, speaks of a fluid situation more than a still cam on an empty podium, right? That suggests that there's news incoming. And I think the markets are reacting in real time to that. I think that the challenge and the important thing for investors is to not feel like you have to react in real time. So if you're looking out at your situation, whatever it is you're investing for, whatever that horizon is, and that goal hasn't changed, it's probably important to make sure you're calibrating your investment decisions today to that. I'd say that's number one. The second one would be, as investors, we are not, completely merciless to oscillations in the market. And again, if you have that horizon that gives you some time, pullbacks like this can be opportunities. I'd just point out, traditionally, if you go back over time, geopolitical risks that flare up like this, and this is not to diminish the human toll and element of this, but geopolitical risks tend to have really fleeting impacts or implications for the market. They tend to correct. We could even go back to Crimea and Georgia, specifically with Russia. Those pullbacks corrected very, very quickly. The unique element this time is that we have the Fed that is not there to throttle back a little bit at this stage. The Fed is going to have to remain anchored to combating inflation. And I think that's what's giving the markets the most amount of anxiety at the moment.
Okay, so, are these longer-term threats as you see it to the market, or is this just going to be a short-term impact, however things play out between Russia and Ukraine? How should investors be looking at it in terms of a timeline?
Yeah, I'd characterize it more as short-term. That's a challenge, right? Because anytime you're dealing with, take, for example, the previous challenge for the markets, which continues to be one, which is trying to recalibrate around a Fed tightening cycle. Those are conditions that we've seen in prior cycles. Markets can attempt to price those things in. It's really difficult when you're talking about geopolitical tensions, foreign affairs, because there are a lot of wild cards at play. That's obvious at this stage in this situation with Ukraine and Russia. So I think as an investor, again, the timeline should certainly be longer than today or even this week. We're probably going to see markets remain highly sensitive to these incoming headlines that either suggest there's hope for diplomacy, which will probably cause the market to rally, and then any indications that things are getting worse in terms of that conflict, military conflict. That's a really short-term view of things. But I would say if you can look out a month, a quarter, much longer than that, even 3 to 5 years, the conditions don't suggest you need to be making huge amounts of changes to your portfolio based on the situation today. It's going to be much more around economic cycle, Fed monetary policy cycle, and the profit cycle. That's going to be the broader gauge you want to make investment decisions on.
And speaking of Fed policy, we know we've got the Fed meeting in March where the market was heavily expecting the first interest rate hike from the Fed in years as it tries to wrap its arms around rising inflation. Do you see what's playing out now between Russia and Ukraine as perhaps giving the Fed pause? Maybe they hold off on that interest rate hike because of all the uncertainty globally.
You're probably right in terms of the market trying to handicap what the Fed is going to do. I think maybe more so than any time we've seen since the financial crisis, this is probably a point at which the Fed is not blessed with as much flexibility as they have been in the past. Go back over the last 2 years, even before the pandemic, go back over that prolonged period post-financial crisis. You saw the Fed put, so that downside perceived perception from the Fed that if conditions were to get rockier, the Fed could throttle back a little bit on any view of tightening. And I think that probably right now, that flexibility is much smaller than it has been over the past decade. Now, that being said, is the Fed going to ignore these geopolitical risks? Probably not, insofar as these risks are a headwind to overall economic growth. I think the Fed will be sensitive to that, remembering that the Fed has to pay attention to its dual mandate: rising inflation, which means the Fed's going to have to remain vigilant on tightening policy; maximum employment. By all accounts, the labor market is extremely tight and healthy, so a little less flexibility there. But also that third mandate, so to speak, the unofficial mandate, which is financial conditions. That's probably where these geopolitical risks are going to show up, in financial conditions. So to the extent that these really start to have a meaningful impact on financial markets, we might see the Fed find a little bit of flexibility, but I don't anticipate that we're going to see a meaningful ratchet down in the expectations for tightening in the near term.
You know, Craig, we're looking at a live picture of the big board down at the New York Stock Exchange. The Dow is off more than 700 points just a few seconds ago. Do you think that to some extent the U.S. markets are overreacting to what's playing out on the geopolitical stage right now? And where do you see opportunity? Because we certainly see commodities rallying as we try to get a handle on what's happening there between Russia and Ukraine.
Maybe an overreaction in terms of these blip by blip moments. I mean, anytime you're talking about major geopolitical conflicts between world powers, it's obviously unsettling. And I think the cautious reaction here is probably worthwhile. There's maybe 2 points I'd point out here. One, the S&P 500 was higher this morning. It's meaningfully lower at the moment. That, again, is a good indication of the fact that the market is trying to handicap or price this all in real time. And as an investor, you got to take a step back from that minute by minute, tick by tick reaction in the market. But more broadly, think about prior to the last week or two, before Russia, Ukraine really popped into the headlines, we had seen a correction in the markets, but it wasn't fully balanced. We were seeing it more in those high valuation tech names where rising rates posed perhaps a bit more of a headwind. So it was a concentrated pullback. You look at today, we're seeing the Nasdaq, the S&P 500, and the Dow all rather close to each other in terms of the magnitude of the drawdown, which suggests this is more of a risk-off reaction to the market. That tells us there are opportunities in the market. As a longer-term investor, you can capitalize on these short-term dislocations, these periods when emotion takes over. So where, as you asked, Alexis, where are those opportunities? We do think, again, this is not going to extinguish the economic cycle, both domestically or globally. So we do think that those more cyclically oriented investments, that's often referred to as the value style versus growth in some cases, cyclical sectors like energy and financials and industrials and materials, more geared to the economic cycle. We think there's a second wind here as these short-term geopolitical risks fade, and that focus back on an economic cycle that I don't think is going to be undermined this year. That probably benefits those more economically sensitive areas, and probably a good opportunity to add, particularly when those are pulling back.
All right, we'll leave it there.
Thank you. Investment strategist at Edward Jones. Thanks so much for joining us today. We appreciate it. As you can see, we are looking at a podium shot there at the White House in the East Room as we await President Biden's remarks on Russia, Ukraine. He is expected to announce new sanctions against Russia because now the U.S. is calling deployment of troops to eastern Ukraine an invasion. I want to bring in Edward Fishman now, adjunct fellow at the Center for a New American Security, who advised the Obama administration on economic sanctions. Thank you so much, Edward, for being with us. If you were advising President Biden during this situation, what might you tell him with regards to economic sanctions?
Sure. Thanks so much for having me. As you said, the Biden administration has said that this is an invasion. And in the last few weeks, they have signaled very clearly that an invasion would lead to swift and severe consequences on the Russian economy. President Biden has the power at the stroke of a pen to throw the Russian economy into a tailspin. And that's largely because of the outsized role that the US financial sector continues to play in the global economy. So I would be advising President Biden not to hold back, not to get cold feet, and to impose the sanctions that they've been planning and coordinating with allies for the last few months.
And then what are some of those sanctions? I know stopping the sale of sovereign bonds is one of them. What other sanctions can they impose?
Sure. I do anticipate that the Biden administration will extend sanctions on sovereign debt to secondary transactions. The initial sanctions were just on primary transactions with Russian sovereign debt, but that really won't be the marquee part of the package. I expect the Biden administration to impose really significant sanctions on the largest Russian state-owned banks. So the Russian banking sector is quite concentrated. There are just a handful of banks at the top that really account for the lion's share of the sector. And I would be very surprised if the Biden administration doesn't impose some pretty substantial penalties on some of those banks today. And I do think at the same time, there will be room to ratchet up those penalties in the days and weeks ahead if Putin escalates his aggression further.
You know, Craig, I'm wondering how much these sanctions might truly harm or hurt Russia, because we saw on a very public stage at the Winter Games, which just wrapped in China, that there is a bond that is becoming stronger between Russia and China. So I guess my question is, what can the U.S. and really the world do to impact Russia the most with regards to sanctions?
Look, I think there's a myth out there that Russia's economy is sanctions-proof. Certainly, in the last 8 years since we initially imposed sanctions in 2014, Putin has done things to try to insulate Russia's economy from sanctions. But Russia's economy remains very vulnerable. It's often touted how $630 billion have been accumulated in foreign exchange reserves. What's not often said is that 2/3 of those foreign exchange reserves are held in dollar, euro, and other Western currency denominated assets. Those all could be frozen at the stroke of a pen by President Biden and his counterparts in the EU and the UK. China, I do not anticipate will be a white knight in this situation. I do believe that the Chinese government will take advantage of the situation. Certainly, if Russia needs new markets and there's a profitable way for China to get involved, I'm sure they will. And by the way, the same applies on the flip side. I think as as Russian commodities go off global markets, if there are opportunities for China to increase its market share, I don't anticipate Beijing to hesitate for one moment. So I think that Beijing will do what's in its interest, and I don't think that it's going to rescue Russia anytime soon.
And Russia will certainly do what's in its own interest as well. How could that impact us here in the U.S.? We're no stranger to crypto attacks and hacks from Russia. Do we expect more of those, and what could they target?
It's a great question. And I do anticipate if the Biden administration does reach for some of the more severe sanctions that they're planning, that there could very well be retaliation. You saw a threat earlier this morning from Dmitry Medvedev from Russia about increasing gas prices in Europe. It's also possible that there's retaliation in terms of cyber attacks. But the thing I want to stress here is that when you're comparing the US economy and the Russian economy, they're just not in the same league. The US economy is just so much stronger, so much larger than the Russian economy. There's just an asymmetric amount of leverage that the United States has. So I think if Russia were to retaliate against the United States, the more likely type of retaliation would be asymmetric retaliation in the cyber domain, and less so counter sanctions, because I don't believe that Russia really has that much ability to affect the United States through sanctions.
What about in terms of the oil markets? I mean, Putin is saying that he's not going to disrupt supplies going through Ukraine. It seems as though the market's not truly believing that. We're seeing Brent crude nearly touching $100 a barrel. What could world economies do in terms of sanctions to put the squeeze on Russia to at least continue that lifeline, that oil lifeline through Ukraine if tensions do indeed escalate?
Sure. Well, when we're talking about oil, the Biden administration has been pretty careful to signal that oil will not be included in the first wave of sanctions. Of course, they'd be rightly concerned about spiking oil prices even higher than they already are. But what I will say is that none of us really can project exactly where oil markets are headed. And for some historical context, in 2014, when I was involved again, we imposed pretty substantial sanctions on Rosneft, the state-owned Russian oil giant, as well as sanctions on Russia's Arctic offshore deepwater and shale oil projects. And what happened in the next 6 months? We saw oil prices tank. So it's not always exactly clear how oil markets will respond, but I don't anticipate oil will be part of the first tranche of sanctions. I think that'll be held in reserve in the event that Russia escalates even further in Ukraine.
Okay, we will leave it there. Edward Fishman, Adjunct Fellow Center for a New American Security. Thanks so much for stopping by and your perspective today. We are getting ready momentarily for President Biden to speak from the White House on the escalation in tensions between Russia and Ukraine. Before that, let's bring back our Yahoo Finance's Jennifer Schonberger for more of a preview of what we can expect. Jennifer.
Good afternoon, Karina. We are now about moments away from the president's remarks. He's about an hour and 20 minutes behind schedule here, but we do expect an update on the reaction to Russia sending troops into Ukraine over the weekend and whether that rises to the level of an official invasion, what punitive actions the U.S. will take. We do know that the president is set to announce new sanctions against Russia, though those sanctions will not be the punitive package that the president, along with Western allies, have promised in response to an official invasion by Russia. Now, this coming after Jonathan Feiner, the White House Principal Deputy National Security Advisor, called Russia's actions this weekend an invasion when pressed on the word to use for that, though the White House has stopped short of actually calling this an invasion. So we'll hear whether the president puts that official term on Russia's latest actions. This after the president signed an executive order on Monday that would block trade and investment for two separatist enclaves in Ukraine that Moscow now recognizes as independent from Ukraine. The UK and the European Union as a whole have announced their own.
All right, we're gonna head over to President Biden at the White House for his remarks.
Well, good afternoon. Yesterday, Vladimir Putin recognized two regions of Ukraine as independent states. And he bizarrely asserted that these regions are no longer part of Ukraine and their sovereign territory. To put it simply, Russia just announced that it is carving out a big chunk of Ukraine. Last night, Putin authorized Russian forces to deploy into these regions. Today, he asserted that these regions are actually extend deeper than the two areas he recognized, claiming large areas currently under the jurisdiction of the Ukrainian government. He's setting up a rationale to take more territory by force, in my view. And if we listened to his speech last night, and many of you did, I know, he's setting up a rationale to go much further. This is the beginning of a Russian invasion of Ukraine, as he indicated and asked permission to be able to do from his Duma. So let's begin to, I'm going to begin to impose sanctions in response far beyond the steps we and our allies and partners implemented in 2014. And if Russia goes further with this invasion, we stand prepared to go further as with sanctions. Who in the Lord's name does Putin think gives him the right to declare new so-called countries on territory that belong to his neighbors? This is a flagrant violation of international law and demands a firm response from the international community. Over the last few months, we've coordinated closely with our NATO allies and partners in Europe and around the world to prepare that response. We've said all along, and I've told Putin to his face more than a month ago, that we would act together. And the moment Russia moved against Ukraine, Russia has now undeniably moved against Ukraine by declaring these independent states. So today, I'm announcing the first tranche of sanctions to impose costs on Russia in response to their actions yesterday. These have been closely coordinated with our allies and partners and will continue to escalate sanctions if Russia escalates. We're implementing full blocking sanctions on two large Russian financial institutions, VEB and their military bank. We're implementing comprehensive sanctions on Russia's sovereign debt. That means we've cut off Russia's government from Western financing. It can no longer raise money from the West and cannot trade in its new debt on our markets or European markets either. Starting tomorrow and continuing in the days ahead, we'll also impose sanctions on Russia's elites and their family members. They share in the corrupt gains of the Kremlin policies and should share in the pain as well. And because of Russia's actions, we've worked with Germany to ensure Nord Stream 2 will not, as I promised, will not move forward. As Russia contemplates its next move, we have our next move prepared as well. Russia will pay an even steeper price if it continues its aggression, including additional sanctions. The United States will continue to provide defensive assistance to Ukraine in the meantime, and will continue to reinforce and reassure our NATO allies. Today, in response to Russia's admission that it will not withdraw its forces from Belarus, I have authorized additional movements of U.S. forces and equipment already stationed in Europe to strengthen our Baltic allies, Estonia, Latvia, and Lithuania. Let me be clear, these are totally defensive moves on our part. We have no intention of fighting Russia. We want to send an unmistakable message, though, that the United States, together with our allies, will defend every inch of NATO territory and abide by the commitments we made to NATO. We still believe that Russia is poised to go much further in launching a massive military attack against Ukraine. Hope I'm wrong about that. Hope we're wrong about that. But Russia has only escalated its threat against the rest of Ukrainian territory, including major cities and including the capital city of Kyiv. There are still well over 150,000 Russian troops surrounding Ukraine. And as I said, Russian forces remain positioned in Belarus to attack Ukraine from the north, including warplanes and offensive missile systems. Russia's moved troops closer to Ukraine's border with Russia. Russia's naval vessels are maneuvering in the Black Sea to Ukraine's south, including amphibious assault ships, missile cruisers, and submarines. Russia's moved supplies of blood and medical equipment into position on their border. You don't need blood unless you plan on starting a war. Over the last few days, we've seen much of the playbook that Secretary Blinken laid out last week in the United Nations Security Council come to pass. A major increase in military provocations and false flag events along the line of contact in the Donbass. Dramatically staged, conveniently on-camera meeting of Putin's Security Council to grandstand for the Russian public. And now, political provocation of recognizing sovereign Ukrainian territory as so-called independent republics in clear violation, again, of international law. President Putin has sought authorization from the Russian parliament to use military force outside of Russian territory. And this set the stage for further pretexts of further provocations by Russia to try to justify further military action. None of us should be fooled. None of us will be fooled. There is no justification. Further Russian assault in Ukraine remains a severe threat in the days ahead. And if Russia proceeds, it is Russia and Russia alone that bears the responsibility. As we respond, my administration is using every tool at our disposal to protect American businesses and consumers from rising prices at the pump. As I said last week, defending freedom will have cost for us as well and here at home. We need to be honest about that. But as we do this, I'm going to take robust action to make sure the pain of our sanctions is targeted at the Russian economy, not ours. We're closely monitoring energy supplies for any disruption. We're executing a plan in coordination with major oil-producing consumers and producers toward a collective investment to secure stability in global energy supplies. This will blunt gas prices. I want to limit the pain to the American people are feeling at the gas pump. This is critical to me. In the last few days, I've been in constant contact with European leaders, including with Ukrainian President Zelensky. Vice President Harris met in person with the leaders in Germany over the weekend at the Munich conference, including President Zelensky. At every step, we have shown the United States and our allies and partners are working in unison, which he hasn't been counting on, Mr. Putin. We're united in our support of Ukraine. We are united in our opposition to Russian aggression. And we're united in our resolve to defend our NATO alliance. And we're united in our understanding of the urgency and seriousness of the threat Russia is making to global peace and stability. Yesterday, the world heard clearly the full extent of Vladimir Putin's twisted rewrite of history, going back more than a century, as he waxed eloquently, noting that, well, I'm not going to go into it, but nothing in Putin's lengthy remarks indicate any interest in pursuing real dialogue on European security in the year 2022. He directly attacked Ukraine's right to exist. He indirectly threatened territory formerly held by Russia, including nations that today are thriving democracies and members of NATO. He explicitly threatened war unless his extreme demands were met. And there is no question that Russia is the aggressor. So we're clear-eyed about the challenges we're facing. Nonetheless, there is still time to avert the worst-case scenario that will bring untold suffering to millions of people if they move as suggested. The United States and our allies and partners remain open to diplomacy if it is serious. When all is said and done, we're going to judge Russia by its actions, not its words. And whatever Russia does next, we're ready to respond with unity, clarity, and conviction. We'll probably have more to say about this as it moves on. I'm hoping diplomacy is still available. Thank you all very much.
Are you still open to meeting with Vladimir Putin?
All right, you have been listening to remarks from President Biden. They were wide-ranging remarks. He said that Putin bizarrely indicated the independence of two areas in Ukraine. He said Putin is setting up the rationale to go much further and believes that this is the beginning of a full-scale invasion of Ukraine. He did announce some sanctions as well, a first tranche of sanctions. They include, again, penalties against two large Russian banks and sanctions on Russian sovereign debt as well, so they cannot trade on international markets. For more reaction, let's bring in our Yahoo Finance's Jennifer Schonberger. Jennifer, there was a direct message from Biden. Don't mess with us.
Absolutely, Karina. That's right. The president calling Russia's actions to send troops into Ukraine the beginning of an official invasion by Russia and announcing new punitive actions against Russia. The U.S., as you said, going to sanction two of Russia's banks, including Russia's military bank. Its sovereign bonds is going to cut off access to U.S. and Western markets and financing so that they cannot trade with the U.S. or the rest of the West. Starting tomorrow, they're also going to impose sanctions on Russia's elites and family members. The president called Russia's actions a, quote, flagrant violation of international law and warned that the U.S. is prepared to take further action in the form of sanctions against Russia should Russia continue its aggression, as the president expects. Biden says he's also authorized U.S. forces and equipment to help Baltic states. He called this a defense mechanism. He still hopes that the diplomacy path is on the table, so giving a option there to still come to the table and talk. As opposed to going straight to war. The president also saying that he is talking with oil producers and consumers about ways to limit prices, oil prices, gas prices at the pump so that Americans don't suffer even more from gas prices and oil prices that are already on the rise. So just a couple of comments there from the president. Back to you.
And one of the takeaways for me too, Jen, was that President Biden said the U.S. has no intention of fighting Russia, but will defend every inch of NATO territory. And he said that they are going to be dictated by what Russia does, not by what Russia says, because we know all along President Putin has been saying oil supplies will not be impacted. And as we see it play out in the oil markets, it doesn't seem as though traders have a lot of faith in what Putin's saying.
Yeah, absolutely, Alexis. All along, the White House has been saying we are looking at Russia's actions. We don't trust its words. In fact, Russia has repeatedly put out false campaigns, staged different reports to try to put on the news, to turn things around on Ukraine and other allies, the West not falling for that. Certainly, the U.S. seeing right through that.
All right, Jen Schonberger, thanks so much for recapping the president's remarks. As we saw there, he left the podium rather quickly, did not take questions from reporters, and they had plenty of them. I want to bring in Yahoo Finance senior columnist Rick Newman into the show now. Rick, I know you were watching what we were just watching with regards to President Biden. He says he hopes it doesn't get ratcheted up and that diplomacy can win the day. What are your thoughts on that?
Well, I mean, it seems foolish to make any predictions here, but I find it fascinating that this whole thing is unfolding in this step-by-step, almost incremental process. I mean, Putin has zero element of surprise here because everything has been telegraphed. What Putin himself has not telegraphed, NATO has telegraphed, Biden has telegraphed with all the information and in some cases classified intelligence they're releasing. I mean, as a military tactic, if you're going to take an objective, you want to take it as quickly as possible. You don't want to take a little bit, then take a little bit more and a little bit more after that. It makes me wonder if Putin is sort of testing the waters here and seeing, okay, let's see what kind of sanctions they're actually going to impose if we now assertively just take these two areas where we've sort of had a presence. Let's just go and take them and see what happens. So now we know Biden has said, well, here are the sanctions. And so the next question is Putin going to take the next step and go beyond those two regions and start tanks and other machinery rolling further into Ukraine? And then I guess we'll have another round of sanctions from Biden. It suggests to me that Putin might be 97% certain that he wants to do this, but maybe not 100% certain, because it will cause a lot of pain on Russia and the Russian economy and his Russian billionaire friends.
So what is his next step in that sort of situation? Because how far does he go? Biden just said he expects that there will be more aggression in Ukraine. And we had an analyst on earlier that says this is just the beginning. And, this was part of Putin's plan. He wants the entire of Ukraine back again. He said historically and culturally, it is a part of the former Soviet Union. And then if he does take Ukraine, what's next on his list? Lithuania, Estonia?
I mean, nobody can get in Putin's head on this. But I think it's important to remember there's a broad spectrum of things Putin could do. So the armchair generals are probably thinking about tanks rolling all the way across Ukraine to Kyiv and all the way across to Ukraine's western border and then occupying the entire country. They could probably push the tanks and the armor divisions all the way across the country, but it's another thing altogether to occupy a country, especially cities and urban areas. I mean, it's just a total recipe for getting bogged down and getting stuck in guerrilla warfare. So there are other things Putin could do. Putin could keep his forces where they are without moving troops all the way across Ukraine and do things such as terrorist attacks, cyber attacks. There are many ways he can menace the Ukrainian government while the hammer hangs over their head, if you will, with those armored convoys, seemingly ready to roll. One thing I think we can safely say is Putin is not going to leave any territory that he occupies because of course he cares as much as any leader about saving face and looking strong. So one thing Putin is not going to do is back down from something he's already done. But if he's as clever as many analysts think he is, he has to be asking himself, am I really ready to take on all of these sanctions and everything else that the Americans and the Europeans are threatening with pretty good unanimity at this point? This may be one thing that has surprised Putin, is the extent to which Europe and the United States really do seem to be on the same page.
All right, Yahoo Finance senior columnist Rick Newman, thanks for jumping on the show here to break it down for us. Stay with us, though, because we're going to take a look at how all of this is impacting the commodities markets. And we're not just talking oil. We're going to speak with an agricultural expert on what these escalating tensions between Russia and Ukraine could mean for food commodities. That's up next. Lots of action in the oil pits today, everybody, where oil prices approached $100 a barrel on the threat of a Russia-Ukraine war. Jared Blickery standing by now with the latest there. And I know, Jared, it's not just Brent and WTI. Natural gas prices surging in Europe after Germany halted Russia's Nord Stream 2 pipeline.
That's correct. And this is our commodities heat map. You'll notice a wide plethora of different groups in here that are surging. Let's take crude oil first. We just had March futures settle at $92.35 per barrel. Here is the open overnight price action since midnight. You can see prices were as high as $96 per barrel. You'd have to go back to August of 2014 to see a price that high in WTI. And as we've been talking about, Brent nearly topping $100 per barrel, came within a few cents of that. So really seeing things fly here. I want to take a look at our energy stock heat map before I proceed to some of the other commodities. We have Exxon down 1.5%, Chevron down 1%. Some of the smaller players like Pioneer down nearly 5%. They are a bit more volatile. Apache down nearly 4%. But take a look at the year-to-date gains, and pretty impressive here. Exxon still holding on to gains of 25%, BP up 16%. Some of the smaller players like MRO up 31%. So a little bit of a downdraft today in the energy stocks, but crude oil still holding on to those gains.
And Jared, besides oil and energy, other commodities also making moves, metals, particularly aluminum and nickel, making moves under that Russia supply pressure.
That's right. Russia is an important miner of palladium and also platinum. And so in addition to some of the base metals, we're seeing gold. Gold has been breaking higher as well. Not a huge movement today. It's up about 1/4%. But look what's happened over the last 2 months here, especially with these candlesticks, just kind of launching to the upside. And you can really see it on a 3-year basis. It had based for over a year. And when markets do that and they break to the upside, usually they get a follow through equal to the time period of consolidation. Also tracking wheat, the grains. Look at this, wheat up 5%. This is over the last 3 years. This has been actually a pretty stable trend for wheat. We've seen a lot of volatility, both ups and downs in some of the other commodities, but wheat up 74% over the last 3 years. You can also take a look at corn. Corn up 3% today, up almost 80% over the last 3 years, trading at $6.74. I remember when I first started trading it was trading in the 200s, so quite a different environment. And finally, let's take a look at natural gas. Let's see if I can find it here. NG equals F. Maybe I will, maybe I won't here. I'm on pins and needles, but here's aluminum. Aluminum also up 50% over the last 3 years. So don't know if I'm going to get to all of these tickers, but I think I leave you with the general idea that commodities are once again surging here.
Thanks again for a great job, as always, on those charts for us, Jared Blickery. And while we are seeing the broader market sell off amid the Russian invasion into Ukraine, we're also seeing agricultural commodities surge, as Jared was just pointing out. The two countries account for nearly 30% of global wheat exports alone. And with a look at what these tensions could mean for food prices globally, joining us now is Michael Swanson, Wells Fargo's chief agricultural economist. So, Michael, we know we're already grappling with high food prices. In fact, inflation, we know, at a 40-year high. So what could these kinds of disruptions do to food prices for us here in the U.S.?
You know, we're going to be competing with other markets. Typically, you know, we're not focused on growing wheat in this country, but with these types of prices and the move that we've seen, we'll see acreage go into wheat to support those markets that can't access Ukraine or Russia. And obviously, when you reduce the supply here or increase the exports out, it's definitely only going to add to the food inflation in that category, which is a pretty important one to us.
What in particular do you think we could see the biggest price spikes occur? I mean, is it, you were just talking about wheat, is that sort of the sweet spot? Because I know Ukraine has been referred to as sort of the breadbasket of the world.
Well, it's interesting because when you look at the numbers these days, Russia's kind of crept up out of nowhere. In 2010, they were only about 6% of global production. Today, they're closer to 12%, 11%, 12% in that range. And there's a lot of the MENA, you know, Middle Eastern, North African countries that are well aligned with them for logistics and trade patterns. And if they don't have access to that, either that or the Ukraine, they're going to have to shift. It's going to be Australia, it's going to be Canada, it's going to be the United States. And that demand, like I said, works its way through the farmers' planting decisions, and they're right in the heart of it right now. And so basically, if we devote more acres for those markets, there's less acres for our markets. And right now, we see an incredible demand for edible oils from the biodiesel initiatives we're putting in place. We're seeing strong meat demand around the country and around the world as well. So something has to give to support that additional demand that's going to come from those markets.
Michael, what is the capacity of the USDA to step up production and maybe help out other countries if Russia does hold off on those wheat exports?
You know, in the short term, they don't have a lot of levers to pull because we do a good job. I mean, everybody I work with who farms as well as they can, and there's very few unallocated acres in the United States. So now the USDA does have access to the CRP ground, crop reserve program, but that would be a major step to say, hey, we're going to take it out of the CRP program with its environmental consequences and put it into the market. That would be a very strong response from the USDA and the federal government around crops.
Outside of the U.S., what other parts of the world could really see disruptions here? Talk to me a little bit about the Mideast, maybe Africa. What would these food supply disruptions mean to people there?
You know, one key country to think about would be Egypt. Egypt's a very large importer of wheat. And of course, their arable amount of land is fairly limited. But you have to really tip your hat to the Egyptians. They've initiated major programs recently in the last couple of years to increase irrigation in a very strong way. And it's under actually the Egyptian Air Force in charge of their newly irrigated ground as a strategic response to this security issue. So the Middle East, countries like Egypt, saw this coming and they've been putting things in place to deal with it. So there's a lot of moving pieces in this picture right now.
How long could, higher prices, commodity prices take to sort of settle and become lower in your estimation?
There's kind of a two-step process going on here. One is, Ukraine and Russia have stocks on hand that they were going to export. And if those aren't available, then you have to resource, to meet the needs right now. A bigger problem would be if both Russia or Ukraine, due to this conflict, were not able to plant as many acres as they typically do. Then we see that extend from the current situation into multiple crop years as we try to make up for that loss. So it'll be a big issue if the Ukrainian economy is frozen due to problems and they don't plant, or Russia doesn't plant due to sanctions. You could see this become a multiple year issue around that lack of supply.
All right, we're going to have to leave it there, but thanks for that perspective. Michael Swanson, Wells Fargo's chief agricultural economist. Karina?
Okay, and we'll have much more reaction to President Biden's comments on the escalated tensions between Ukraine and Russia. Stay with us. Welcome back to Yahoo Finance. We want to bring in our Jennifer Schonberger once again to recap some of the comments that we heard from President Biden just a short time ago, saying that he believes Russia is poised to go further and further into Ukraine and aggressions there. Jennifer.
Good afternoon, Karina. That's right. President Biden calling Russia's actions to send troops into the Ukraine, the beginning of a actual invasion into Ukraine, calling it a flagrant violation of international law and announcing new sanctions against Russia. Those sanctions including sanctions against Russia's military bank, also its sovereign bonds, cutting off Russia's government from Western financing. Russia will no longer be able to trade with U.S. Or other allies in the West. And starting tomorrow, they will also announce sanctions on individual family members and Russian elites. Now, Biden says that these new sanctions go further than the ones that were imposed in 2014 against Crimea, and that the U.S. and Western allies are prepared to enact more stinging sanctions. But these actions may not be enough to satisfy some Republicans on Capitol Hill. Starting to get some response in this afternoon. Minority Leader of the House, Kevin McCarthy, tweeting out, Vladimir Putin's decision to launch a renewed invasion of Ukraine is reprehensible. Sadly, President Biden consistently chose appeasement, and his tough talk on Russia was never followed by strong action. Perhaps some of this crafted before Biden's speech, because if you go deeper into McCarthy's statement, Republicans are looking for more crippling sanctions on Russian financial institutions, as well as Russian military. So we saw some of that action from the president. Remains to be seen how much deeper Republicans would like to go. So we'll keep you posted on the response here, both from lawmakers as well as leaders around the world. Karina.
Oh, Jen, I'll take it from here. I know that this follows similar movements by the European Union and also the UK imposing what they're calling their first wave of sanctions. And today, during his remarks that we took live here on Yahoo Finance just a short time ago, President Biden said more penalties, more sanctions will follow if Moscow goes further. Any indications what that might look like? We had an expert on earlier saying that perhaps sanctions regarding oil could be coming down the pike.
Yeah, that's quite possible, because the president did mention during his statement that he's been talking with energy producers and consumers about ways to mitigate the impact of sanctions on gas prices domestically here to protect Americans from higher gas prices. So I imagine that would certainly be on the table. But the White House hasn't exactly tipped its hand, only said that they are prepared to enforce more stricter sanctions should Russia continue with its aggressive efforts, as the U.S. expects.
All right, Jen Schonberger, thanks so much for that. Want to get you all a check of the markets here as we near the 3 o'clock hour on the East Coast. And while lower, stocks are well off their worst levels of the session. Earlier, the Dow was down about 700 points. It has now about nearly halved that. It's off 383 at the moment. The S&P 500, well off its lows. It was down more than 75, now down 29. And the Nasdaq Composite was off more than 260 points. So an incredible comeback here by big tech, with the Nasdaq now down just about 97 points. Jared Blickery gave us a nice overview of the oil markets earlier. We had Brent crude almost touching $100 a barrel, and WTI, as you can see, up more than 1% on the day at 92.27. Even President Biden admitting during his remarks earlier on Russia-Ukraine that Americans are going to feel the pinch at the gas pump, and he is working with others within government to see how he can best deal with that situation and perhaps spare us the worst of it. We could be looking at gas prices at the highest level since 2013. All right, stay with us. Much more Yahoo Finance Live to come after this from myself and Karina Mitchell. Thanks so much for being with us these past 2 hours.
Welcome back. You're watching Yahoo Finance. Here's what we're watching today. Escalating Ukraine-Russia tensions sent all three major indices down. The Dow fell close to 700 points at one point before gaining ground back, and oil prices edging closer to $100 a barrel. President Biden just announcing a first tranche of sanctions affecting two Russian banks, a military bank and Russia's sovereign debt. Russian lawmakers gave the green light for President Putin to use military force outside the country. This on the heels of Russian forces entering breakaway regions of Ukraine and as sanctions from Europe roll in. More market reaction ahead. Plus, Federal Reserve Governor Michelle Bowman signaling that she's open to more than a traditional 0.25 percentage point rate hike. With the Fed almost certain to raise rates at its March 15th meeting, will a half-point rate hike start bringing inflation down from its 40-year high of 7.5% without taking markets and economic growth too far down with it? And Bitcoin falling under 38,000 today, with other cryptocurrencies falling too, as Ukraine-Russia tensions rise. Crypto assets also mimicking what we're seeing with FANG stocks and other high-growth tech assets that have also been struggling year to date. With a perfect storm of Fed rate hike uncertainty and more crypto regulation ahead, we'll unpack how all this is affecting the industry. I'm Rochelle Akufo, along with Emily McCormick and Brad Smith.
Let's take a brief look here at the markets as we kick off another week. It's on a volatile note, and with all of the international conflict that you mentioned, Rochelle, in focus here by the markets, we've got the Dow down right now by about 1.1% with 59 minutes left in trade on the day, 371 points lower. So we're off of session lows, but still deep in declines right now. The S&P 500, you're seeing that lower by about 0.6% right now, a little more than 0.5%. And then the Nasdaq Composite, the tech-heavy average, that's down by about 0.5% at this point in time, 70 points to the downside there. And so with more on the key levels that we're watching going into this final hour of trade, and in this final hour of trade, we've got Yahoo Finance's Jared Blickery standing by. Jared, what are you seeing that sticks out right now?
I'm seeing a little bit of a relief rally in the Nasdaq and the S&P 500, not so much the Dow, but here was when President Biden belatedly began his words this afternoon addressing the nation and the world, and you can see pretty quick jump to the upside, probably market participants thinking at least no new news is good news, so difficult to see what the next direction is going to be, but we are testing those session lows from, not session lows, we are testing the yearly lows in a lot of these markets right now, notably the Nasdaq and the S&P 500, so kind of at a critical area. Now, the good news, some of the mega caps have turned into the green. We're seeing a little bit of a relief rally in Microsoft and Alphabet, Nvidia up 0.75%. Also Tesla, which had been down about 6%, now down only about half of that. You can see it's in about the middle of its trading range today. Take a look at the leaders, and guess what? We got a few in the green right now. Utilities, real estate, healthcare, and then financials. Nothing up by a big amount, but nice to see some green here. To the downside, consumer discretionary, perhaps off of those Home Depot results, that's down 2%. Energy also off 1%, but crude oil, Brent crude oil, hitting nearly $100 per barrel for the first time since 2014. And let's take a look at our leaders as well. It looks like chip stocks in the upper left, the SOX index, that is getting some love. That's up 0.5%, followed by, well, we got these two switching places here, the ARK Innovation Fund, biotech, software, and then regional banks. So a little bit of love here. Let's take a look at the ARK Invest and see if we have any green. So a couple of these names like Spotify, just barely turning green. Zoom is up 2%, Twilio up 4%. So we are seeing some gains there. Also an interesting relief rally in Roku, which got absolutely drubbed last Friday, I believe it was, off of its earnings announcement. So still off 20% there, but we are seeing a little bit of money flow into those fringe industry groups and sectors and factors that had really been flagging earlier today.
Jared Blickery, thank you so much for that breakdown with yet another volatile session underway. And for more analysis, we're bringing in our next guest of the hour. Thomas Phillipson is an economist at the University of Chicago. Thomas, thank you for joining us. We have stocks now heading toward a third straight week of losses amid Russia-Ukraine tensions and fresh sanctions on Russia's financial institutions now coming from the U.S. How much of a threat to U.S. equity markets does this geopolitical situation currently pose?
Well, I think, peace through strength has been sort of what we've gone away from with Biden, obviously, relative to the Trump. And financial markets are obviously particularly interested in peace as opposed to this kind of uncertainty. And I think this is kind of a double whammy that's hitting markets now, because first, with explicit regulations, the Biden administration went after energy supply in the US, obviously. But now implicitly with this tension coming on, we're reducing one of the top three, another energy supplier to the world, which is Russia. So I think, explicit and implicit policies are sort of creating a double whammy here, which is why we're seeing the $100 a barrel coming into play today and probably go up potentially, depending on how this plays out.
And tying this into the monetary policy implications, are we at the point where the increased threat of a full-scale Russian invasion changes the calculus for how hawkish the Fed should be starting after its March meeting?
I think energy inflation, or price increases, I should say, rather than inflation for particular sectors, is one part of what's going on with overall inflation. But inflation is so broad-based that it's not sort of due to single industries. It's so broad that, it's about 75% of industries now have more than the Fed target of 2% inflation. So it's a very broad inflation. That's not the key driver of inflation is, the Econ 101 of money supply going up and prices going up. If you have more supply of something, always prices go down in any market, in particular when the price of money goes down, that's called inflation. So I think that's the overall driver of the broad inflation we see, and it's not sector-specific sort of supply issues. Obviously, energy prices are among the leading ones, but that's potentially due to policy as well. But I don't think we're going to see reduced inflation in other sectors than energy anytime soon.
And Thomas, speaking of the existing energy inflation that you mentioned, you've said that the conflict is adding to existing energy inflation in ways that could have been mitigated with the different U.S. energy policy. How could the U.S. have perhaps anticipated this, and what kind of energy policy would have perhaps lessened the blow in the exposure?
I mean, we cut down U.S. energy supply day one in the Oval Office, right? So with the pipeline being stopped, and then we open up the Nord Stream for Russia. Now we're shutting it down potentially, or the Germans, and we are both working to shut it down with the war. So I think, clearly world supply of energy would have been different if both of these things were not happening at the same time.
And it's interesting because with each new negative development on Ukraine, we're seeing this market sell off. Why isn't that priced in at this point, especially given how proportionate the risk posed to the U.S. economy by being exposed to this by this invasion and the possible sanctions retaliation? Is it a disproportionate response?
I think it's been escalating, and you've seen that the last 2 or 3 weeks. We didn't know exactly what was going to happen a couple of weeks ago. Now it's escalating with Russia declaring the 2 regions in Ukraine as independent, etc. I think it's this escalation of the tension is potentially why we see subsequent pricing adjustments coming down the pipe.
So additionally here, we got to talk about the Fed too, because that's the kind of intersection that we find ourselves at, where everything that's taking place internationally is also colliding with uncertainty about how fierce the Fed will be with its rate hikes that are anticipated to come, and whether that's in the quarter point, whether that's increasingly to be talked about in the half a point range as well. As of right now, you've got Bullard, Bowman, Bostic, all of them signaling at least potentially a half point. And so what are you going to be watching for as they are continuing to signal and be as transparent as possible, even prior to the next meeting where they will provide that decision?
I think that, people are, the hawkishness they're talking about is kind of mild relative to what's going on. We have 7% inflation, at least CPI. And, rates are at most going to go up to 2 or something. So we have large negative real rates, no matter whether they go in 25 or 50 basis points or even a little bit further. The real issue is that, the Fed is today actually pushing inflationary policy still. We're still waiting for anything. And this is now a year into the inflation. So they're very late in the game. And that's obviously something that economists have kind of argued for a very long time. that the government or the bureaucrats have a hard time keeping up with the economy, and they're well-intended actions, but many times the Fed is just too late when it's responding to anything. So they're responding. The Fed's name of the game is to respond with price controls in credit markets, but they time those price controls in credit markets very poorly often, and often very much lag the economy. And I think we're seeing that as a prime example of what's going on this year in 2022.
Certainly. And so with that in mind, Thomas, we now have both the White House looking at inflation as a result of some of the international concerns that they've been tracking, and them having to, and President Biden having to address that, in addition to what you just laid out and how late the Fed is to tackling inflation. And so when will citizens, American people, consumers, who will they feel a bigger impact from in their decision making as of right now? Is it the Fed, or is it how the White House is going to try and quell any type of price at the pump inflation that we've already seen?
Yeah, I mean, the Congress, I think both the Senate and the House is sort of waking up to this now, and they're kind of putting constraints a little bit on the White House. So I think, the fact that we had, a fiscal response in itself, many economists do not think generates inflation, because you take money from some people and give it to other, and whether if that's tax funded today or in the future through debt, you basically moving money around. The issue is that you basically monetize the debt, and what we're seeing today is sort of a prime vindication of Milton Friedman, as opposed to modern monetary theory, which says you can print money or increase the money supply without having inflation, which is the exact opposite of what Milton Friedman argued, essentially. So I think we're seeing that today. We have massive money supply increase, and we have massive inflation. I don't think it's a huge mystery what's going on. And I think Congress is kind of putting the brake on the White House in that respect.
Thomas J. Phillipson, who is the University of Chicago economist, joining us here today. Thanks so much for the breakdown and the conversation. Appreciate the context and insights as well. And everyone, coming up on the other side of this short break, we're seeing levels in oil that haven't been seen since 2014. How the Russia-Ukraine conflict is also pushing prices on the other side of this quick break. Welcome back, everyone. We've been keeping a close tab on oil prices as they have been moving higher and hitting some of the levels we haven't seen since 2014. You've got a good look at Brent crude oil hitting $96 on your screen right now. It's up on the day by about 2.9%. Then additionally, WTI crude oil, that is up by about 1.3% on today's activity. We've been hovering within this above $90 price range for both of those measures for quite a few sessions and weeks now at this point. RBOB, we're also tracking the gasoline futures. You're seeing that up on the day by about 1% and over the past 5 days in aggregate by about 0.8%. We'll keep close tabs on all of these levels as well going forward from here, considering the international conflict that we've been measuring and continuing to give you some more updates on the impacts within the energy sector as well.
As Brad highlighted, crude oil prices are back in rally mode as tensions between Russia and Ukraine escalate further. Rob Thummel, portfolio manager at Tortoise, joins us for more now on the energy markets. Rob, Brent crude oil prices rose to reach just under $100 per barrel earlier today. How much higher do you expect oil prices to climb given the geopolitical concerns as they stand right now?
Yeah, no, thanks, Emily. So I think oil prices probably are going to be elevated for a while. We've got a geopolitical risk now that's embedded in oil. And frankly, if you look at where oil inventories are, prices are where they were in 2014. Global oil inventories are at low levels like they were in 2014. So I would fully expect oil prices to remain high for a while. The global oil market is actually undersupplied. Demand for crude oil is back to pre-COVID levels, yet OPEC Plus and U.S. production is not back to pre-COVID levels. So the net result of all of this is probably declining oil inventories. When that happens, you continue to see higher oil prices.
And when do you expect this discrepancy between supply and demand that we're seeing right now to start to narrow? When do you expect to see OPEC Plus and U.S. supplies specifically ramp to meet that demand?
Yeah, so as you know, OPEC Plus has been gradually increasing their oil supply. They will continue to increase the oil supply, throughout this year and into next. But at some point, they're going to reach their capacity. And then the U.S. probably will also start to grow oil supply. So the answer to your question is, when will we see a balanced market? Hopefully sometime mid to late this year, but it could be into 2023 as well.
And when we think about the natural gas side of the market, earlier today, Germany indefinitely halted the certification of the Nord Stream 2 gas pipeline, which would have significantly increased the amount of gas sent to Europe directly from Russia. What are the consequences of this to energy markets in Europe? And does this also carry implications for the U.S.?
Yeah, so from the U.S. perspective, the good news is that the U.S. is more than self-sufficient for natural gas. Actually, in the U.S. produces more natural gas than we consume. Hence, we have extra or excess natural gas production to export to other countries around the world, including Europe, including Asia, including South America. That's really important. And that's actually a really important advantage. If you think about natural gas, it's decarbonizing in that it's less carbon than coal. And it's also relatively cheap, especially relative to oil. So the U.S. is one of the countries that has excess natural gas that it can really use to its advantage. Now, that's important because in Europe, 30% of Europe's natural gas is imported from Russia. And we will see how this conflict affects that. Probably won't affect it much, but definitely there's always going to be heightened concern about the reliability of Russia as a supplier of natural gas and that critical energy commodity to Europe. U.S. is able to step in to a certain extent, but it will take a while would take a while for the U.S. and other countries to fill a larger role for Europe.
Well, and in addition to the action that we saw from Germany today, the U.S. also unleashed a first level of sanctions on Russian financial firms this afternoon. Could further sanctions be imposed on Russia without significantly disrupting the energy markets of European allies? Because even financial sanctions that aren't energy market specific or crude oil specific could potentially disrupt payments for oil and gas, could they not?
Well, yeah, if you deal with Western banks, obviously that's the dollar is such an important component, and obviously a lot of U.S. banks are really critical in settling oil-based transactions. Russia is a large exporter of oil. It's the third largest oil producer in the world. It's the second largest natural gas producer in the world. It's an energy export economy. Russia needs the rest of the world just as much as the rest of the world needs Russia in terms of the energy that it provides to Europe and to Asia in particular. The U.S. to a lesser extent needs Russia from an energy perspective, but Europe and Asia really need the Russian oil and natural gas supplies, and so extending sanctions to affect Russian oil production and the energy supply out of Russia probably would be really detrimental at this point. I think it would have to get pretty severe for us to reach that point where that decision was made.
And how do you see these tensions impacting not just energy commodity prices, but energy stocks and the U.S. energy sector? How should investors in these areas be thinking about the conflict that we're seeing with Russia and Ukraine?
Yeah, Emily, I think that's a great question. So just big picture, nobody wants to profit off of a first European war if that happens, since World War II, and that's not what investors, I think, want to do. But what I think you'll see, what I think we've seen now is the opportunity is you're going to have higher energy prices, you're going to have higher commodity prices, you're going to have inflation tied to energy commodities. And so the energy sector is a great place to capitalize on that. The energy sector, unlike other sectors, offers high dividend yields for a lot of investors. The sector is not trading at multiples that other sectors are. So I think there'll be a rotation into the energy sector out of other sectors that are trading or were trading at near all-time highs. The energy sector never got there. With high commodity prices, it supports really strong cash flows. It really helps these companies continue to pay high dividends, reduce their debt, buy back stock, and eventually they might get back to growing their production volumes. But the energy sector is really well placed for this particular environment for investors who are concerned about, obviously, how do they get income in a rising interest rate environment, and how do they also deal with higher inflation, and what companies and what stocks benefit from that. The energy sector historically, and this time as well, will benefit from inflation and the need for higher income.
Certainly something we continue to watch as energy commodity and stock prices continue to outperform in this environment. But Rob Thummel, portfolio manager at Tortoise, thank you so much for your time.
All right, up next, a closer look at swinging cryptocurrencies and how macro events like a Ukraine-Russia conflict are increasingly weighing on them.
Welcome back. Prices for major cryptocurrencies have tracked the risk-off mood in markets this afternoon. And let's take a look where some of these tokens are trading. Bitcoin prices trading around the $38,000 level. We are off session lows here for the largest cryptocurrency by market capitalization. At session lows today, it had been trading below $37,000. And then taking a look at some of the other major names, Ethereum prices also down during this afternoon session, but down by less than 1% now as we speak. Litecoin also down about 2.3%. And then taking a look at some of the major altcoins, Solana down 1.5%, and Dogecoin, of course, down about 3.7%. So another area of the market where we are seeing a bit of some risk-off action, as we also see the red in major indices as well.
Well, as you heard, the Bitcoin back from the brink after falling below 38,000 at one point. Then President Biden's announcement of sanctions on Russia swung it back above that mark. Well, for more context on crypto's movement, I'm joined by Jeff Roberts, Decrypt's executive editor. Welcome to the show. Now, Bitcoin we did see was hovering around that key support level of about 37,400 most of the day before it then shifted gears. If that does get broken decisively at some point, how does the risk get managed from then on?
Well, I mean, it's Bitcoin, so you can never quite predict what's going to happen. But I know some people are, making noises about 30,000 is the next floor of Bitcoin. I don't think that's going to happen. It's doing okay right now, but this episode shows again that Bitcoin, like everything else, is vulnerable to macroeconomic shocks.
And it's interesting because at one point, Bitcoin was considered one of those safe havens like gold during market uncertainty, but now it's acting more like some of these other high growth tech assets and equities. How much of that shift is due to some of these large institutional investors versus other factors in the industry?
I think you put your finger on something. Yeah, I think that the institutions hold it to a degree far more than they did a few years ago, so that when the market panics, they dump their Bitcoin along with everything else. They're not kind of hodlers or true believers in Bitcoin like the early crowd was. But, you're right. It underscores for a long time, the narrative of Bitcoin was when the world goes to hell, Bitcoin's going to be there. But now we see that when the world goes to hell, the price of Bitcoin falls alongside stocks and everything else.
And it's interesting because with any optimistic news then that you hear about Bitcoin, people start talking about when is it going to hit that 100,000 mark, perhaps 200,000. Do we have a sense yet of because of how it's now tracking with some of these risk-offs, where this could actually be looking, say, in a year from now?
No, it's a mug's game to predict Bitcoin's price in a year. I mean, I'll just reiterate what I usually say. Every year Bitcoin, doesn't die, it just gets stronger. And I think Bitcoin is just more resilient than ever. It's going through a slump right now. I say this not as an ideologue or believer in it, but it's just I've seen it written off too many times that it will have its slumps. And remember, it hit like 60,000 or almost 70,000 last year. It went on the run of its life, and it's in a bear market right now. Some even think we're in a crypto winter. But look at the floor now. Bitcoin used to, fall down to, 3,000. Now, it's news that it's at 38,000. So, I think long run, Bitcoin's still Bitcoin. It's going to, build and climb slowly. But, it could have a rough stretch ahead.
Now, I want to talk Ukraine because up until this point, it had been positioning itself to be a key decentralized finance hub. I mean, it has a burgeoning tech economy, low taxes, less red tape. And then, of course, the Ukrainian parliament passing a bill to legalize cryptocurrencies and exchanges Thursday, but not yet to adopt it as they're still sort of trying to determine regulations. What are your thoughts on whether Ukraine could be a case study for the role of crypto being used during conflict at times when people are not able to access their money through traditional means like banks?
That's what people are watching. And I know in Afghanistan, this conversation came up as well. And I think what we find for sort of a small tech savvy, minority of people, they can flip to it. But the reality is Bitcoin is still not practical for a lot of ordinary people to use. So for all the predictions that, hey, Bitcoin's going to save it, here comes crypto. The reality is it doesn't really work that way. What I am curious about though, too, is, what I'd love to know is how much Bitcoin is the Kremlin holding? Because there's been rumors that, Vladimir Putin owns a lot of Bitcoin or cryptocurrency. That's not really what you asked to know, but, these things are so layered. layered and complicated that, in terms of Ukraine becoming a crypto state overnight, not going to happen. But I think every time these things do happen, it does reinforce that, the importance of private crypto networks. Likewise, in the debate is, will they cut Russia off from the SWIFT banking system? If that's the case, what does that do to crypto markets? But I think all of these events just sort of reinforce that, it's probably a good thing that there are these distributed, decentralized, somewhat indestructible financial networks out there people can turn to.
That's interesting, because then you have, in the case of Canada, with that also being a test perhaps for crypto and blockchain, as Canada's government has this standoff over crypto payments to protesting truckers. How do you see that playing out? And does that really signal perhaps where governments could be able to step in and where they might not be?
Yeah, it pushes the capacity of governments. Decrypto was just at Ethereum Denver, sort of the big gathering of all the Ethereum folks, where Ethereum founder Vitalik Buterin spoke and said that, Canada's actions are a worrying signal. What if this becomes the new norm? But, as we discover on the ground is, in theory, crypto is invisible. You can, control your own currency. But the reality is most people don't know how to use it in that fashion. So watching Canada flex its muscle, go after the exchanges, seize people's Bitcoin, shows that the government still can have the upper hand, but it also strengthens resolves of people who really believe in decentralized cryptocurrency, use their own wallets and stuff like that, and are able to avoid those sort of actions by government. So I think this is just the latest iteration in a long kind of cat and mouse game between governments and crypto believers. But yeah, the combination of what happened in Canada and what's happening in Russia is probably going to strengthen the hand of the hardcore crypto people to say, hey, here's the time to really, learn more about how to hold your own currency.
And this is happening as President Biden is expected to issue an executive order in the coming days to have government agencies study cryptocurrencies and also a central bank digital currency. How should investors in crypto platforms be preparing for perhaps a digital dollar while a more comprehensive crypto regulatory environment is also on the way?
Now, these are fun kind of parlor discussions, but the reality is there's going to be no central bank digital currency in the US. The privacy implications are, too enormous, and the banks don't want that. And as for the executive order, that's going to make a bunch of headlines, but the reality is, President Biden's fully occupied with Ukraine, and there's not much he can really do to order. He can't say there is no Bitcoin. The order is going to be something to the effect, from what I've heard from my DC sources, is, okay, agencies, SEC and Fed Reserve, come up with a plan, so it's going to make a lot of headlines because it shows Bitcoin's, and crypto is in the big time. There's executive orders out of it, but it's going to be, I think, a lot more sort of, sound and fury than it is substance, but it'll certainly make the news.
Indeed, it always does. Well, thank you so much for your insights. Jeff Roberts there, Decrypt's executive editor. Thank you again.
With markets in decline on the day, major averages lower across the board, we're going to get a deeper dive on the other side of this short break, including letting you know which of the 2 out of the 11 S&P 500 sectors are holding on to their gains. We've got that update for you on the other side of this short break.
Welcome back. You're watching Yahoo Finance. Let's get a check now on how Treasury yields are doing. They were in the red for most of the day. As we take a look at the 10-year and the 30-year, now they're both in the green, just edging over. We're seeing that the 30-year is up about 0.08% and the 10-year up about 0.082%. And also the VIX, which has been tracking obviously the volatility there. A lot of people wondering in terms of risk and stress in the markets. That is also up. That is also up to the tune of 4.9%.
And bringing in Yahoo Finance's Jared Blickery. Jared, help us break down some of these levels just a little bit more.
Well, let's start with the VIX, since we see that on our screen right there. And I'm going to scroll down here. We'll take a look at equity performance in just a second, but it is almost at the 30 level, and you can see that in the intraday price action. But I like to take a longer term view where we can see the relative spikes that we've had historically. Now, when we were last visiting the lows of the S&P 500, let me put that chart on real quick. This is a 2-month chart. We were heading lower, and that's when we got those lows in January. But you take a look at the VIX, of course, it moves opposite to equities prices usually, and we got that big spike up. So we haven't eclipsed that just yet, but you can see definitely inching higher here. And then you take a look at the VIX of the VIX, that's a little bit subdued, and actually that's not flashing any kind of warning sign. So it could be that the regular VIX just a little bit elevated today. But you take a look at that S&P 500 chart. I do not like the technicals on this. We are just inching lower without any real impetus. The fact that we're able to test these lows without that much momentum probably means we're going to break them in a big way. So then we look to even lower prices, and we can see maybe on a 2-year basis where some support is. I've seen it coming down all the way to about 3,800. That would be a significant decline. Hopefully we don't see that. But if we were to get a little spike down and we came right back up, that would actually be pretty bullish, because we would not have had as much momentum likely on this phase of the down move as this one. So that sets up what we're calling a divergence. Now, I do want to get to the sector action of the day, and we're seeing a little bit more green, but not as much as we were during our last report about 30 minutes ago. Utilities and healthcare just barely holding on to some gains here. Consumer discretionary and the energy sector, those are mired in the red here.
And Jared, in addition to stocks, the commodity space has seen a lot of action as well, from crude to grains and metals. How are these responding to the latest on Russia and Ukraine?
Yes, let's take a look at WTI crude, because I think that's pretty telling. We just settled a little bit higher on the day, but still trading above $90 per barrel. And you take a look at what's happened on a 2-year basis, a lot of dramatic price action. As we recall, it spiked down to -40, but I want to bring it to a year to date so we can get a little bit more color here. We've just been bouncing around between $90 and about $96 per barrel here. Also, we just had contract rollover, so keep that in mind, but definitely flirting with these higher prices. And Brent, by the way, Brent hit nearly $100, triple digits, first time since 2014. RBOB gasoline futures also elevated at $2.71. Of course, that's not what you pay at the pump. Lots of other costs that go into that. Here's gold futures. Gold futures look kind of muted today. We've been up and we've also been down, but nevertheless, you can see the trend over the last few weeks since the beginning of February. So gold breaking higher as well. Copper futures really just not doing much today. Those are down slightly, but it's the energy prices where we see a lot of movement. And I'm going to go to our futures heat map here, and not just energy, also grains. I can't forget about wheat here. Wheat's up 5.5%. We got that Brent crude that's up 3%. Heating oil, that's up 2.6%, and soybeans up 2%. I could go on, but you really get the idea of what's going on here. So energy prices, grains, all kinds of different metals, precious and otherwise, getting a bid here today.
Hey, Jared, just while we have you, can we talk a little bit about the yield curve and the tightening that we're seeing there right now, especially as we've been tracking the 2s and the 10s as of this point in time? And there you've got to look at the 5-year up on your screen now, too.
That's right. The reason I'm beginning with the 5 is because we're seeing a lot more movement upwards at the lower end of the curve. So if you were to think you have the very short-term rates here, the very long-term rates right here, the 5-year, which is right around here, that's up about 4 basis points. You take a look at the 10-year, that's just about flat. Well, that's up about 2 basis points. And then the 30-year had been in the red. We're going to call this break even because it's just a fraction of 1 basis point. But the point is that the lower end of the curve with the shorter maturities are actually rising more slowly than the long end of the curve. And sometimes the long end of the curve is actually falling. All of this means that the yield curve is compressing, becoming flatter, and of course that's a recession indicator. Not that that means we're going to have a recession in a few months or even a few years, but it does highlight the instability that's built into the system here with the Federal Reserve. And I just want to show the 10-year again. I do have a chart of the 2 versus the 10-year. It's called the 2s 10s, and that is back down to 40 basis points. Might be hard to see here, but here's the peak in April, March and April of last year, and it's been a pretty steady, slow slog down for this important recession indicator. Still at 39, 40 basis points, but when it gets down to 0, that's when you really have to consider that the Fed may be overreacting here and that a recession getting priced into the markets.
All right, Yahoo Finance's own Jared Blickery, thank you so much for that breakdown. And coming up, we'll have more analysis on the latest on the Russia-Ukraine situation and its impact on inflation as we see stocks continuing to sell off. Stick with us.
Welcome back to Yahoo Finance. We're going to take a look at how markets are faring on this down day. Could be headed for the lowest close of 2022 if it keeps pace. Let's check in with how Treasury yields are doing. We're seeing the 10-year up now 0.02% after being down most of the day, and the 30-year yield also up 0.002 points. As we're seeing, that was also slightly in the red, but for most of the day, and now it's come back in the green. And also for the VIX, as we take a look at how that risk and stress is affecting the markets, we're seeing that's up 4.9%. So obviously still a lot of risk priced in there, and people sort of still wondering how everything is going to unfold with Russia, Ukraine, as new sanctions are announced just today.
Speaking of Russia beginning to invade Ukraine is a significant weight on the markets today. And President Biden this afternoon took action to announce economic sanctions against Russia while reaffirming support to Ukraine. Here's a short clip of what the president had to say during his conference this afternoon.
We're implementing full blocking sanctions on two large Russian financial institutions, VEB and their military bank. We're implementing comprehensive sanctions on Russian sovereign debt. That means we've cut off Russia's government from Western financing. It can no longer raise money from the West and cannot trade in its new debt on our markets or European markets either.
Joining us now, we've got Joe Brusuelas, who is the RSM chief economist. Joe, good to speak with you here this afternoon. Help us break this down even further. Do the sanctions go far enough at this point, as Russia has already begun its invasion?
So in my estimation, the sanctions are proportionate to the limited incursion into eastern Ukraine. I would think, given what they're saying and given what our allies over in the UK are signaling, that if the Russians do move past the Dnieper River, we get a full-fledged invasion, then we'll get the more tougher, more robust, probably more biting sanctions. But right now, one of the reasons why we're seeing the market respond the way it is today is restraint on the part of the allies, at least for today.
And so with that in mind, there is this annexed thought of what other economies this could have an impact on. What material impact do you anticipate the Russia-Ukraine conflict to have on even the U.S. economic recovery momentum that we've been trying to continue to see move forward?
Okay, if the status quo holds, all we're going to see is a very limited impact on growth and inflation. Should we see a full-fledged inflation followed by much more tougher sanctions, then we're going to be in a very different world. So a couple of weeks ago, we modeled a 2, 3, and 5 standard deviation shock to the U.S. economy. Our baseline is now expecting a 20% increase in the price of oil. Now that's from 2 weeks ago. We're about 7% of the way there. If that occurs, you'll see 1% shaved off growth this year, U.S. domestic product, and you'll see an additional 2.8% or thereabouts increase in inflation. If that occurs at one point, we will pass 10% on a year-over-year basis. Now, at that point, given what's happened, given this possible exogenous shock from the geopolitical sector, it would make sense the administration begin to move forward to provide some relief to middle-income, working-class households and the poor, because food and fuel will become quite dear. And it would be, in my estimation, a good idea to revive the child tax credit, because I think that it's a proven way to provide direct relief targeted at households that need them, those with children who then in turn spend it on food, fuel, clothing, and shelter.
Okay, and so you started to get into some of the measures that the White House could implement, and Biden, of course, earlier saying that he was looking to mitigate energy price impacts to U.S. consumers. But break down the child tax credit for us a little bit more and why that would be so significant, especially at this time.
Okay, so it's a tested and ready program. We implemented it during the pandemic. And essentially what it did was it targeted households with children. The plan was so broadly written that it actually reached 95% of all households with children, monthly checks for 6 months, and then a tax credit for the other 6 months. And we were able to track the use of that cash via the Census Bureau's special pulse surveys. So when we took a look at that, what we saw was this was a program that was actually utilized to buy necessities, not necessarily luxuries. And this is what you want to see during times of stress. And let's be honest, the rate at which inflation's increasing, we're likely to move close to or above 8% when we look at the next monthly reading in the CPI. Stress was building among American households, especially those in the 3 lower quintile of income groups. If we do see a further energy shock due to the Russian invasion of it, or a total invasion of the Ukraine, you can expect more of the same.
And so, Joe, when we think about the U.S. and the international investments that have been made into the U.S., there's also the significance in the amount of investments that have come in, even from areas like in Russia. And because it's hard to trace back to know exactly where those investments are coming in from, how significant is this Ukraine and Russia conflict in America and some of the investments that they have already received, that we have already received, whether they be for things such as infrastructure or for other measures to ensure that there is the capital that's ready to deploy for some of the economic buildup as well?
All right, so in my estimation, we're really talking about a small quantity of money. The Russians like to recycle petrodollars in London and places like Miami. Typically, it moves through the economy via the purchase of homes and investments in businesses. Federal government can target this. These are large movements of cash, and they're able to engage in what they call micro-targeting of economic sanctions. This is not going to disrupt the financial system. It's not even going to disrupt your local neighborhood, right? The main issue at hand is, will there be another supply shock to the American economy, to the global economy, to the EU and German economy in particular, via, again, the energy channel, via oil prices and rising natural gas? That's the much bigger issue at hand than whether a very small number of very wealthy people find out that they can't tap their credit cards to go out to very expensive restaurants in London or Miami.
Certainly. And then just lastly, while we've got you, Joe, the impact, of course, that this has as of right now, at the same time where we're going to be waiting to see what the tenor and the size of the Fed's rate hike will look like. How much more difficult does this make the Fed's decision? We heard from one of the Fed presidents, Michelle Bowman, over the weekend, who in this American Bankers Association commentary did not once mention international relations or anything that's taking place overseas.
Okay, so the Federal Reserve and their global central banking brethren are in a very difficult position now. They're going to have to hike into what could be an energy shock and a slowing global economy. My sense is that the Federal Reserve ought to hike by 25 basis points at the March meeting, but they ought to use the opportunity of both the communique and the summary of economic projections to note the risks around the evolving global environment and just frankly admit that, hey guys, we hiked by 25 basis points. We're incredibly data dependent and we don't know what we're going to do next. And that will be in part linked to the evolution of the crisis in Eastern Europe. And I think that's a good place to stop because they just simply do not know. My sense is that the 7 hikes priced in, 125 basis points, might be a little much. I'm comfortable with 4 or 5, but we'll have to see how this year evolves. The central bank, boy, I wouldn't want to be one of them right now. This is going to be the worst time, really, in our common career cycles.
Yeah, I don't think either one of us are envying that position right now. Joe Brusuelas, who is the RSM chief economist, joining us here today. Joe, appreciate the time and the conversation this afternoon.
The closing bell is just minutes away, and we'll highlight the biggest moves in the final moments of trading as the S&P 500 heads towards its lowest close of 2022. The Dow also in sharply negative territory. That's after this quick break.
Welcome back to Yahoo Finance Live, everyone. We've got just minutes left in today's trading session, and it has been a volatile one to kick off this abbreviated trading week as the markets are pricing in and major averages declining right now as they are pricing in as well. The international conflict between Russia and Ukraine, you're taking a look at some of those levels. I want to bring in Yahoo Finance's Jared Blickery. As Jared, we're nearing either correction territory for some of the major averages or even more so some of the year-to-date low closes.
That's right. And I had forgotten the S&P 500 actually never entered correction territory. That's down 10% on a close-to-close basis. Kind of arbitrary. It was very close, but nevertheless, probably going to do it on the close today. Now, here's a longer-term chart, and this is why I'm not that confident that we're going to recover anytime soon. That's because we haven't sufficiently tested those lows. Even if we got a reversal in the entire Ukraine situation and Moscow backed off, I'm not sure it would be enough to take us through these levels up here, 4,600, because that's all about the Fed. And that issue is definitely not off the table. Seeing a lot of red and dark red here, kind of nasty going into the close. We got Apple down 2%, Tesla down 4%, had been off 6% earlier in the day, but also seeing some of the travel names like Airbnb and Booking down. They're down 5 and 3.8% respectively. Netflix down 3.5%. Take a look at the sector leadership. Well, not a lot of leadership. I guess you can say utilities is the least bad off in the room. That's down 2% or 0.2%. But consumer discretionary, really where we've seen a lot of weakness today, not only there, but also in some of the ARC components, except for DraftKings and Roku. Nice little bounce back there from Friday's loss. But overall, nasty close to begin the week, guys.
All right, thank you, Jared. All right, coming up, stay tuned to Yahoo Finance Live. Myself, along with Brad, Emily, and Jennifer Schonberger, will be bringing you the latest outlook for crypto in 2022 as investors consider new opportunities in the space. We'll be speaking with innovators like FTX CEO Sam Bankman-Fried, in addition to taking a closer look at crypto regulation with former SEC enforcement official Alma Angotti. All that and more after this break.
This is a Yahoo Finance All Market Summit Extra, Crypto in 2022, presented by Intuit TurboTax Live. The opportunities for crypto investors are increasing by the day. New ways to trade, new places to invest, and the new innovations to follow. Over the next hour, we'll hear from crypto trailblazers. What are they watching? And what is the biggest story for crypto in the months ahead? We'll also examine some of the best new ideas around cryptocurrency investing. And what about the feds? We're tracking the latest developments in Washington, from new taxes to new regulations. Join us now for a very special Yahoo Finance All Market Summit Extra, Crypto in 2022, presented by Intuit TurboTax Live.
Hello, everyone, and welcome to our special. I'm Brad Smith. It's great to have you with us.
And I'm Rochelle Akufo. And before we kick things off, we want to take a look at how the markets closed today. Closing bell just ringing now. All three indices in the red. At one point, the Dow was down close to 700 points. It clawed back some gains, though, but still a tough down day for all three major indices. All right, now let's turn to our special with one of the biggest names in crypto, FTX CEO Sam Bankman-Fried, SBF, as he's also known. Thank you for joining us. So a $32 billion market valuation in 3 years, and that's despite bear market worries and still expanding then with crossovers into gaming and more. How did this rise happen so quickly, and which sectors are providing the most interesting opportunities for collaboration or perhaps disruption going forward?
Yeah, thanks for having me. I think that it's obviously a testament to the team that we have and everyone who's been working hard on this. I think the biggest things that we were targeting when we started the company, I think still see as the big drivers of it are, a combination of seeing a really compelling opportunity where the existing companies were not as strong as they could be, and going for it. In terms of where we're looking, I think obviously we're looking at gaming. We're looking at what's going to happen with NFTs there, and seeing really big opportunities in the space, which we're excited about, and excited to help be the back end, hopefully, for a lot of the whatever the metaverse ends up being.
Certainly, and $32 billion valuation, as Rochelle mentioned a moment ago. I mean, you've downplayed expectations for a rushed IPO, but after the consolidation that we've seen, especially in trading platforms a few years back, Morgan Stanley and E-Trade, Schwab and TD Ameritrade, do you anticipate that we're going to see tie-ups among crypto platforms, considering the multitude of different end users that you service, as you mentioned a moment ago?
I do think so. And I think we've, in fact, already seen some of this. I think that we've already seen a number of smaller platforms start to be acquired by larger ones. We've acquired a couple ourselves, as have a few of the other big players in the space. And I think that I do just expect that trend to continue for exactly the reasons that you're citing.
I mean, and it's really incredible because obviously crypto has come such a long way from obscurity to then retail investors sort of jumping in and out and that causing wild swings, now to having these large institutional investors in there as well. Now, on CoinMarketCap, when you compare Bitcoin to the biggest companies and assets in the world, it's one spot above Berkshire Hathaway and one below Tesla. So how are these evolving types of investors then really shaping the market?
Yeah, so far we've definitely seen institutions start to get involved in the space, but it's been much more of a trickle than a deluge so far. We haven't seen sort of mass institutional inflows in the way that I think some people were anticipating. And I think a lot of the reason for that is that, first of all, these tend to be slow-moving companies, right? Like, these are just companies that are always going to be methodical about how they enter. But in addition to that, I think that there are a lot who are waiting for more regulatory clarity before they feel comfortable diving in. Those are, I think, the two biggest things that we're seeing, sort of like institutions on the lookout for, in order for them to feel more comfortable, making sort of a bigger imprint in the space than they have so far.
Now, with the inflows and the volume growth that you've already seen, you've already been profitable, and then the target for 2021, that was $800 million in profits, from what we understand. Considering the early 2022 volatility, do you anticipate that FTX can reproduce or replicate the same level of profitability this year?
I'm optimistic that we'll be able to grow it. And obviously, I don't know for sure. It depends on what happens in markets, but we had a large amount of growth over the course of 2021. We have continued growing. We are, our average sort of volume, so far in this year has been greater than our average volume was in 2021. And there are a lot of large areas for growth that we're hoping for, over the rest of the year. I think especially as we see how the U.S. regulatory ecosystem ends up, unfolding.
Now, shifting gears, I want to talk about that Super Bowl ad, obviously with comedian and well-known skeptic of everything, Larry David. Now, a lot of people can relate to that. A lot of people are still sort of on the fence, don't really know how to feel about crypto, even though we're this many years in. Now, in a statement, you said we need to meet people where they are, and that means embracing skepticism. A lot of people who are now the biggest advocates of crypto once had significant reservations. So with so many crypto ads and platforms out there, how did yours pay off then in terms of the interest generated as well as new signups, people really trying to get more interested in this?
Yeah, I mean, I think it was huge in terms of the amount of interest that it generated. We got a lot of really positive feedback and reception from it, create a lot of buzz. And I think overall are pretty happy and excited with that. In terms of actual signups, interestingly, that's not as much our target. Obviously we want signups and I won't be one to speak against them. But we've much more been thinking about how can we get our name out there so far, then how can we maximize growth, over the next few months. There's a long game ahead of us here. And, given that, I think we're just a lot more concerned with where this could be going, in the long run and how we can build up, who we are as a brand rather than doing anything we can to get, as many registrations. One sort of data point relevant to that is I think our sort of, Twitter account grew by something like 50% in following over the course of the ad.
Wow, so certainly effective there. Now, in terms of long-term strategy, I also want to talk some of these partnerships that you have with some of the most recognizable brands in the world, including Major League Baseball, the Miami Heat, Riot Games, as well as a number of celebrities and athletes, Tom Brady, his wife Gisele Bündchen, Steph Curry, Trevor Lawrence, David Ortiz, and even at the college level, UC Berkeley. How does hitting all these different demographics at once play into your long-term vision for the company?
Yeah, I mean, we think that crypto is an area that, is going to have appeal across a large number of different segments and demographics. And we want to be able to target, as many of them as possible and really reach out to as many people as we can. And so I think that's a big part of trying to broaden out the base of who we're reaching, with our partnerships. And then the other thing is just, really, as always, trying to focus on which are the partnerships that we feel really good about, that we feel really good working with the partners on, and that we feel will really bring a lot to our company long term.
FTX CEO Sam Bankman-Fried, of course, known colloquially as SBF. Thanks so much for taking the time here with us today. We certainly appreciate it.
Thanks for having me.
Absolutely. And everyone, coming up, best strategies for trading crypto. We're going to be joined by Bitwise Asset Management Chief Investment Officer Matt Hogan. Stay with us.
Welcome back. I'm Emily McCormick, and you're watching Yahoo Finance's special Crypto in 2022, presented by Intuit TurboTax Live. And with us now, a true pioneer in the investment world, Bitwise Asset Management Chief Investment Officer, Matt Hogan. Matt, it's great to see you. Thank you so much for being with us this afternoon. I want to ask first about the price action that we've been seeing in cryptocurrencies. Now, Bitcoin is below $40,000, Ethereum below $2,700. And this comes, of course, after a record run that we saw in these prices last year. But as a CIO, does this latest slide concern you?
It always is uncomfortable when the market goes down, but I think we're actually setting up for an extraordinarily strong second half of the year. Look, the current pullback is being driven by three things which are going to resolve. One, of course, is the broad market shift to a risk-off market that's pushing through all sorts of risk assets, of which crypto is one. I think we're most of the way there to adjusting to this new reality. The second piece is Biden's executive order on crypto, which is coming out this week. I think once we get past that, that'll be a relief. And then some tax-related selling. So I think there's short-term hurdles in front of us. But as I look at the underlying trends, I'm extremely bullish about where we end up by the end of this year.
And where do you think Bitcoin ends at the end of this year, if you have a certain price target in mind?
I'd love to put out a price target. I think we are going to go substantially higher. I wouldn't be surprised to see us challenge and even surpass the previous all-time highs, as long as things break along positive lines. Examples of what that would mean: if we get a Bitcoin ETF approved, if we see reasonable regulatory outcomes out of Washington, D.C., and if we get broader continued positive trends in terms of institutional adoption of crypto, I certainly think new all-time highs are in sight by the end of the year if we see those kind of things.
And in terms of the price action we've been seeing now, we have been seeing these major cryptos sell off alongside other risk assets like stocks recently. Two-part question here. What do you think has been driving this increased correlation? And then second of all, does this create challenges for Bitwise? Because if you want to create an ETF that can generate a return that potentially outperforms the market, and yet the holdings are moving similarly, at least directionally, to the broader market, does that impact the way that you think about your holdings?
Oh, I think that's such a great question. The thing about crypto, which investors are learning, is that crypto assets are driven by two factors. One, they are risk assets. So when you have a risk-off trend in the market, they can fall out of favor from a short-term perspective. There's also the crypto-specific drivers, right? Those sort of fundamental characteristics, which I spoke about earlier: institutional adoption, positive regulatory developments, technological advances. In short periods of time, that risk-off sentiment can overwhelm those secular trends. And that's what we're seeing right now. That's what we saw in March of 2020 when it sold off at the start of the pandemic. The important thing for investors to remember is that those long-term trends are exactly that. They're long-term trends and they're extremely powerful. So over meaningful periods of time, the correlation of crypto to other stocks and other risk assets is very low. It's just during these short risk-off periods that you can see this correlation bounce to one. The message for investors, and what we emphasize at Bitwise, is that means you need to hold for the long terms and even think about these pullbacks as opportunities to establish new positions.
And Bitcoin continues to be the dominant cryptocurrency by market cap, with the overall market value of cryptocurrencies hovering below $2 trillion currently. It's also the top holding in Bitwise's 10 crypto index fund. Do you expect Bitcoin to remain the leader in crypto, or when might another overtake it?
Oh, that's a great question. I think Bitcoin has a lock on the market for digital gold, a lock on the market for non-sovereign currency. I'd be very surprised to see another crypto asset overcome Bitcoin's lead. It's just too well suited for that particular market. I think what you're pointing to is we're seeing this Cambrian explosion of new applications of crypto: DeFi, Web3, the metaverse, NFTs, all of which are being built on non-Bitcoin blockchains, on the Ethereum blockchain, on the Solana blockchain, on other blockchains like that. Ultimately, I do think the addressable market captured by those more performant blockchains could arguably be bigger than Bitcoin. Will it get there this year? I don't know. Will it get there eventually? I wouldn't be surprised. We're extremely bullish on that all-purpose blockchain space, the layer one space, which is led by Ethereum.
And Bitwise has funds that offer exposure directly to baskets of crypto assets and also to crypto-related stocks. What do you think presents the bigger long-term investment opportunity? Is it investing in a crypto stock like a Coinbase, or is it a crypto asset directly like a Bitcoin?
I love all my children equally. Look, we think crypto asset indexes that own Bitcoin, Ethereum, a diversified basket of crypto indexes is a great way for many investors to access the market. In the long term, there's probably more opportunity in that space, more opportunity for those network protocols to grow really substantially. But crypto equities are a great way to play this market and really easy for investors. You can access ETFs by companies like Bitwise, the ticker BITQ, in your brokerage account. It holds traditional stocks. We're all still waiting for a spot Bitcoin ETF, and we're many years probably from an index-based Bitcoin ETF or crypto ETF. In the meantime, these crypto equities offer a nice way for everyday investors to gain exposure to the enormous growth we're seeing in the broad-based crypto ecosystem. So I think it just depends on what you're looking for: ease of access, or maybe the slightly larger, more volatile, but larger opportunity in crypto assets themselves.
And when we think about the long-term impact of greater institutional adoption of cryptocurrencies, the latest Bitwise survey of financial advisors' attitudes towards crypto assets found that 94% of advisors received questions from clients about crypto last year, up from 81% the year prior. How do you expect increased allocations to crypto in client accounts to impact the space overall?
Oh, it's a huge story. I mean, you just mentioned that crypto is about a $2 trillion asset class, which has been built largely on the backs of retail self-directed investors. But we know that that's a small fraction of the market. That's maybe 20% of the wealth market in the US. Financial advisors control another 40% of the market, and institutions control another 40% of the market. We're just at the earliest days of financial advisors moving into crypto, but I think they're going to move extremely rapidly. The percentage allocating in client accounts is growing by 50% or more each year, and that compounds aggressively over time. So if you look at the size of the market cap today, you look at that 40% of US wealth that still needs to move into that market, the potential impact on prices is very material, and it's starting to happen. It's happening at an accelerating rate. And I'm very excited for what that will mean.
All right, we'll leave it there for now. Matt Hogan, Bitwise Asset Management Chief Investment Officer, thank you again so much for your time this afternoon.
Thanks for having me.
It's tax season, and the IRS wants its share of crypto. Up next, all the new rules and an easy way to do your tax return. Stick with us.
Welcome back to our special Crypto in 2022. Joining us now is one of the best people to talk about taxes and crypto, Chandan Lodha. He's a former project manager at Google working on search and Android, now the co-founder of CoinTracker. Chandan, great to see you.
Thanks so much for having me.
So first, I want to talk about changes. So what are some of the biggest changes for tax filers this year who traded crypto?
The big thing that we're seeing this year is a big explosion in complexity of different types of crypto use cases that people are using. So we've seen a massive rise in DeFi and NFTs, and of course, users using more and more cryptocurrency exchanges and wallets. And with the added complexity there, it becomes more and more difficult to comply with those crypto taxes. That's where software like the software we work on at CoinTracker can help users sort of seamlessly and accurately get those calculations done.
And we certainly know the IRS won't be pulling any punches. They want to make sure people are filing correctly. Are there any tax breaks or savings regarding crypto this year?
There absolutely are. The savvy investor can definitely take advantage of the tax code. So, for example, there's an opportunity to do cryptocurrency tax loss harvesting, essentially selling positions that are at an unrealized loss and then buying them back in order to realize those losses. And again, using tax software can help you identify those opportunities, especially when we're in a down market like we are for many users today.
Exactly. I mean, we're seeing a lot of cryptos were sort of down year to date, sort of really fluctuating with a lot of this macro news out of Ukraine and Russia. But for those people who just started trading crypto last year or perhaps didn't file, what can they expect from the IRS if they're not compliant and caught up this year, perhaps in terms of things like grace periods or penalties?
Well, unfortunately, the IRS doesn't have grace periods for cryptocurrency taxes because the rules have been out now for several years. The important thing that new people can do when they're getting into cryptocurrency is keep really good records of all of their transactions. And again, using tax software can help do that. The key thing to do is to do your best and try to be honest when reporting these capital gains and losses. And again, if you're at a loss, there's actually an opportunity to claim those losses and claim deductions. So it works to many users' advantages to actually go ahead and file those taxes.
Now, I want to talk about some of the subsections that you mentioned. You mentioned NFT sales, which obviously gained a lot of momentum over the past year and a half. But then you also have people who've been earning money from mining crypto. What do they need to be aware of?
Right. So for people who are mining crypto, you potentially have crypto income there. When you receive the fair market value of, let's say, mining Bitcoin, that's income, and that would be reported just like other types of income that you might have on your tax return as well. So again, it's important to keep good records of what are the addresses you used, which transactions occurred, which awards you earned from your mining, and keeping track of all of that in tax software can help make it a very seamless filing experience instead of pulling your hair out when it comes to tax filing time.
So then what are some of the biggest questions that you're hearing from your users at varying investment levels?
Right. Crypto taxes can be very complicated. Crypto itself is already, a bit of a complexity there. And add in the tax code, add in different coins, wallets, exchanges, transferring assets between different places. It can be really confusing to figure out how to accurately identify cost basis, how to claim losses, how to even keep track of all these gains and losses. So the biggest question we get from folks is how to even stay on top of crypto taxes to begin with. And my number one recommendation to everyone is to keep good records. Use exchanges and wallets that allow you to easily export your transaction history. Use good tax software to stay on top of your transactions year round. Don't wait until April 15th or tax day, April 18th, I believe it is this year, to start working on your taxes. Get all your records uploaded now, today, and so that by the time tax day rolls around, everything is sort of seamlessly uploaded and ready to go, and your accountant will thank you later as well.
You certainly don't want to wait until the panic sets in. Now, I want to shift gears and talk about some of these crypto-friendly hubs. You have states like Colorado hoping to accept tax payments in crypto by the end of this summer. So what are the complications that come with that? And what's the likelihood that the IRS will accept crypto as payment?
It's great to see that various local jurisdictions becoming more crypto friendly, like the ones that you mentioned. I'm not sure I would hold my breath for the IRS accepting crypto payments for taxes anytime soon, but we can hope, and we'll keep our eyes out for that. The key thing to remember there is when you dispose of crypto, even for paying taxes, that is a disposition event. And in the eyes of the IRS, that would be a capital gain or a capital loss that is incurred there. So even if you're paying your taxes, it's still a disposition of property, and that's still an event that you would have to keep track of and realize a gain or loss on that transaction.
And as you mentioned, even explaining cryptocurrency is difficult enough, let alone then your tax filings. But what about the filing process for those who manage holdings in overseas crypto exchanges? How is that process different?
If you're holding crypto outside of the US, you're still going to be subject to US tax filing rules. So you're still going to have the same capital gains and capital losses that you would if you were holding your crypto on a US-based exchange. The difference is that there might be some additional IRS filing requirements or other government filing requirements for assets held in foreign accounts. So for example, cryptocurrency holders who have substantial holdings, often in sort of the 50,000 plus range, might be subject to FATCA filing requirements, which are basically disclosures to the government, but not additional taxes.
Now, just quickly, I want to highlight this. You're now tracking 3% of the entire global crypto market cap on CoinTracker. What sort of insights is that giving you about where perhaps investment is headed and perhaps the industry?
That's right. Yeah, over $50 billion of crypto assets are now synced to CoinTracker on a daily basis. And the beauty of that is it helps us and our product team have a more informed view of where cryptocurrency users are coming online, what types of use cases are becoming more and more popular. And some of the things that we've really noticed take off in a big way in 2021 and now heading into 2022 are in the realms of decentralized finance, DeFi, and NFTs. And those are both areas that we're planning on investing a lot more effort in to make the tax tracking, the portfolio tracking, and the user experience a lot better.
Well, thank you so much. There you go. People, no excuses now. It's starting early when it comes to filing your taxes if you're trading crypto. Thank you so much. Chandan Lota there, co-founder of CoinTracker. Thank you for your time.
Appreciate it. Thank you.
All right, still ahead, the next generation of crypto entrepreneurs. Cordell Brodus joins us, and he'll tell us about the pitch he made to his father, Snoop Dogg, that kicked off a very profitable new family business. This Yahoo Finance All Markets Summit special, Crypto in 2020.
Welcome back to this Yahoo Finance special on crypto in 2022, presented by Intuit TurboTax Live. I'm Jennifer Schonberger. Cordell Brodus, son of rapper and businessman Snoop Dogg, is making his mark on the crypto sphere, helping to shape the future of NFTs and crypto gaming. He is the inspiration and drive behind Snoop Dogg's foray into the metaverse and crypto, and he joins me now to discuss the future of crypto, as well as his latest ventures. Cordell, welcome to the program. It's great to have you.
No, thank you for having me. Thank you for having me, Jennifer. I really appreciate this.
It's great to have you. So tell me, to get the conversation started, how did you decide to get involved with crypto, and how did you get your dad to buy in?
So I was introduced to crypto in 2017 by Nipsey Hussle. I had told him that I was making X amount of money per month. And he told me it was like invest in cryptocurrency and buy real estate. And I didn't listen to him right away. And, once the market crashed in 2018, I thought it was an opportunity for me to buy in. And that's when, me and, Nick Adler and the rest of our team, we kind of put our heads towards going into crypto, going into NFTs, and building the Snoop brand in the metaverse.
And how did you get your dad to buy in? Did you go to him and say, hey, Dad, I've gotten involved with crypto. Here's how it works. Here's why you should get in?
He's more of a show me, don't tell me guy. So I had to show him what we could do in this space. And our first deal was presented by crypto.com, and it made 7 figures. And then that's when we kind of got his attention, and he started to see the NFT hype was real.
I know you've released a series of NFT projects that have been successful. You're consulting for Sandbox and MoonPay. Tell me, what are some applications you see now that we haven't seen quite yet as far as NFTs are concerned in the gaming space as well as the entertainment industry? How are you looking to shape that?
I think there's a lot of cool opportunities to get in, but there's also a lot of, not so good projects. And you just got to be wary of that and keep your head on the swivel, because like any industry, there's going to be a lot of good and there's going to be a lot of bad. And if you just follow those blue chip projects like the Sandbox, Bored Apes, the Crypto Punks, the Gala Games, the World of Women, I think once you immerse yourself in those communities, then you'll be directed to those cool projects that's going to last long.
How do you see crypto shaping gaming?
I think everything is essential, everything's complementary, and this whole space is cross-pollinated. So, the gaming is complemented by the music, which is complemented by the fashion, because you could dress your avatar. And I just see it being somewhere where people can socially connect with others and also gain financial wealth.
You've, as we mentioned, released a series of NFT projects. You're consulting for a couple of companies here. What are the newest projects that you're working on? And are you involving your dad in any of them?
Yes, my dad is actually my client. So it's so amazing to work with him, and he actually gets to follow my lead for once.
And where do you see NFT applications going in 2022? This seems like a very fast evolving space, and certainly one that's going gangbusters.
I think it's going to be even bigger. Last year, every day there was 50,000 wallets created. And I think this year it may even double or triple. And, the more people that we onboard, the bigger the community, the bigger the state, and everybody can just reap the benefits.
Let's talk about the metaverse, Cordell. How do you see the concept of the metaverse evolving? What is the market opportunity there? And how do you see NFTs being applied?
I think NFTs is just the entry point. I think the metaverse is going to be where we spend most of our times. Because, just like when the internet came around, everybody was scared that the internet would take away time from their families, from their friends. But, in actuality, it brought people closer because, you're able to connect with people thousands of miles away and keep relationships open.
You mentioned your dad is one of your clients, and I know the inspiration behind getting him involved in crypto, in helping to create Snoopverse, which is now on Sandbox. How are you steering that now? How do you see that evolving? Certainly, we've seen virtual real estate go for hundreds of thousands of dollars, if not millions in certain cases.
So, real estate was the first entry point for our sandbox deal. And now, secondly, we have our 10,000 avatar collection dropping February 22nd. And lastly, we'll be entering into the concert realm with the metaverse and having my father perform and, other special acts. And just, giving the community something that's missing.
I wonder, to your point, you guys could leverage, as artists, the metaverse platform or other platforms to try to reach younger individuals who are interested in the music side and then may kind of translate over to the crypto side.
I mean, and not even just to speak about music, we can speak about art. Like Nick Small is a 13-year-old NFT artist, and his collection dropped last month and he made over $200,000. And that's life-changing, empowering women artists in the space and empowering just, creatives all over and what have you. And I actually told my dad this. I said, this space kind of feels like the birth of hip hop, like how everybody was just, mingling with each other and just freestyling and making beats and everything was just fun and new. It's kind of like the same with NFTs and in the crypto space, but you don't have to have, that big chain. You don't have to have that fast car. You don't have to be a tough guy. So I think it's just a fair playing ground for everybody to reach success.
All right. Well, Cordell, thank you so much for your insight. It sounds like you're working on some exciting projects. We wish you the best of luck. Keep us posted and hope to talk to you soon.
Thank you, Jennifer. Thank you for having me.
Up next, the regulators go after crypto. We'll have the latest from Washington on what the feds are doing now. Stay with us.
Welcome back to our special Crypto in 2022, presented by Intuit TurboTax Live. The feds are cracking down on crypto. My next guest knows all about it, having spent over 25 years in top roles in regulation and enforcement. She helped prosecute some of the biggest Wall Street cases and even consulted on the Leonardo DiCaprio film, The Wolf of Wall Street. Alma Angadi is currently with the consulting firm Guidehouse, and she joins us now. Alma, great to have you here with us today. In crypto regulation, first and foremost, many people are just wondering, what's the biggest red flag that prompts an investigation?
So it depends on what kind of investigation you're talking about. If it's fraudulent crypto, and there have been a lot of scams that the SEC and others have brought, where companies are saying, we're developing this cryptocurrency, this token, and there isn't one, right? It's just all a fraud. There is also the issues of using crypto for criminal proceeds. So you have one of the biggest issues that the government's grappling with now is ransomware. Many hackers want ransomware paid in crypto. Now, because of the special mitigants, you can trace the transactions. Cryptocurrency exchanges can identify those transactions that were paid in ransomware. So it kind of depends on what you're looking at. Almost any bad thing that you can do with fiat currency, you can do with crypto. So it's going to be all of those same crimes.
And so we know the ethos that has really prompted and developed decentralized finance. How is oversight also navigating this space as well and evolving along with the space?
So that is a really good question. So the regulators typically, and I think correctly, go a little slow at the beginning of new technology advancements in financial services because they don't want to overreact and cut off financial innovation. But at the same time, once these innovations become popular, they have to worry about how they are affecting consumers. That's the fraud piece, and the consumer protection piece. How they can be used for financial crime and fraud and sanctions. That's the middle piece. And how could it disrupt the global financial system or the US financial system? That's a lot of the discussion about stable coins. How could it affect the broader financial system? So that's where they are now. It's a broad acceptance of different kinds of cryptocurrencies and NFTs and DeFi and platforms. And the regulators now are trying to get a handle on how best to regulate all of those different iterations of technology on the blockchain.
Certainly. A fortuitous time for us to be having this conversation. We know President Biden is expected to sign an executive order this week. It's anticipated to require government agencies such as the Department of Treasury, State, Homeland Security, Justice as well, to study crypto. And also central bank digital currencies, which has been a hot topic of contention as well. And they're going to be prompted to come up with some type of strategy in their own regulation of digital assets. So do you believe that there will be a large-scale form of crypto regulation that will come forward in 2022 versus what we've seen to this point being the piecemeal precedent that has resulted in mostly fines as of right now?
So I think the crypto ecosystem hopes there will be, because there is a lot of uncertainty in the market as to what products and services you can provide, who regulates you, and how you can control those safely. So I think they're hoping that there will be some certainty, whether it's one big new crypto agency, which would surprise me, or some sort of rules of the road among the agencies, kind of like we do with banking and money, right? The SEC regulates if you buy stock with money. The CFTC regulates if you buy derivatives with money. Banks are regulated by the banking regulators if they hold money for you and make loans. So, it might well be something like that, but just with clearer rules of the road.
I have to hustle to my finish here, but 93% of seized assets during the 2021 IRS fiscal year, it was crypto, $3.5 billion worth. So how much in gains do people stand to lose if their filings are incorrect?
Well, I think a lot of those seizures were criminal proceeds, not IRS money owed. And so, but because it is so traceable, and if they know your wallet address, they know you had it, kind of like your bank account records, it would be easy to tell if you're not paying taxes on that cryptocurrency gain that you made. So Always a good
Certainly.
idea to pay what you owe.
And just lastly, since you mentioned that the majority, the lion's share of it really was criminal proceeds, how advanced at this point is tracking money laundering attempts, even across NFT assets too?
Oh, it's very advanced. There are several cryptocurrency blockchain analytics companies. There was just an article, report by the Chainalysis, one of the blockchain analytics companies, talking about how they could see wash trading in NFTs, just like you used to see with stock, people passing it back and forth to give the appearance of volume and increase in price. Then you sell it to someone else and you split the proceeds or make the money. So it's actually quite sophisticated, and that's a whole topic for another day. It's very interesting.
Certainly. And you mentioned that it's unlikely that we'll see some type of large kind of crypto task force necessarily that's kind of put together this year. But what would that timeline look like, especially as you mentioned that the space is clamoring for this so that there are guidelines and boundaries to know how to move forward?
Well, I think you'll see a task force. I don't think you'll see a separate whole new agency for this. And I could be wrong, but it seems like that's a heavy lift to do when there are agencies that are equipped to regulate aspects of this. So I think they'll sit down, they'll figure out who needs to regulate what, and hopefully get some nice, solid guidance out there to the industry so that everybody knows how to proceed safely.
Alma Ungadi of Guidehouse, the consulting firm, joining us here today. Alma, we appreciate the time and thank you so much for the insights and context. And everyone coming up.
Thank you for having me.
Certainly. Everyone coming up, crypto's next big thing with Ava Labs President John Wu. Stay with us.
Welcome back. Our next guest is building the next big thing in crypto. We're joined now by Ava Labs President John Wu. John, it's great to see you. Thank you so much for your time this afternoon. Crypto has come a long way over the past several years, and past year especially. Give us a quick snapshot of where we are now in this space and how Ava Labs and Avalanche are helping solve the current challenges at this stage in the industry's development.
Happy to. And it's good to see you again. So I think what is really great about Ava Labs and Avalanche is it has the ability to attract both crypto native products and projects as well as developers, as well as traditional enterprises and financial services firms. So what's happening is you get an inflow of developers from those sides of the aisle, if you will, and they're all looking for ways to deploy on open permissionless blockchains and create utility.
And last year, we saw smart contract platforms like Ethereum and Solana broaden out. DAOs and NFTs really had a breakout year. What are your biggest predictions for crypto and DeFi this year?
So yes, there was a lot of breakouts last year, but crypto is so new. Don't forget some of the great things that happened last year are going to continue to happen this year. But in addition to all that, I think still the word DAO or the acronym DAO is still only a thing that most crypto native people are aware of. I think you're going to see more and more of this so that it becomes part of the nomenclature of a normal person. There are more and more DAOs popping up. You hear of B2B, B2C, you're going to hear about B2DAO soon. Another thing I think is happening right now is continued inflow of Web 2 type talent, whether that be a Google or Facebook engineer who wants to get into the blockchain crypto space, or be that banker from XYZ Wall Street Bank who's now interested in trying to create business development deals for a blockchain company. That inflow is going to continue to happen this year.
Well, and as you mentioned, a lot of exposure to the latest innovations in crypto and blockchain are still contained to those already in the space or just dipping their toes into the space. What do you think is going to be that project or the use case for crypto or blockchain that makes it a ubiquitous or perhaps even necessary part of people's everyday lives?
Well, everyone wants that one thing that's going to just turn it on and become the overnight success. But the reality is still very evolutionary. We saw DeFi create a lot of interest, and now financial services firms are very interested in it. The NFTs create a lot of adoption. And right now it's about gaming. Gaming companies and AAA publishers are looking for their Web3 strategies and talking to all the top players in this space. On top of that, you have brands. You've seen Nike, Adidas, world-class brands all exploring NFTs and also exploring the metaverse. So I think it's not one thing. It's this whole Web3 movement that continues to grow at a massive pace and a great growth rate.
And when you think about some of the blue chip S&P 500 companies that have started to delve into the space, you think of Meta, Facebook, you think of Microsoft now with Activision Blizzard. Who do you think is perhaps best positioned to be a long-term leader as we continue to build out the metaverse and shape what that could be in the future?
So Facebook's going to go about their metaverse in their way, more of a closed loop ecosystem. I think one of the things that will attract people to a metaverse environment on a blockchain, because it's open. More and more of these traditional tech companies in Web 2 are having a hard time retaining the trust of the users and that of other companies, to be fair. I think what you're going to see, though, is that the gaming companies, you mentioned Activision and other AAA publishers, they're probably going to start doing a lot of things, not necessarily what you would think metaverse is, but just in pure gaming. And that's very exciting because you can get quality gameplay like that and imbue that with the NFTs that give you a unique character that you can carry over, and then a play to earn concept around that. Then you have a very, very powerful adoption mechanism.
And in the financial services side of adoption, one of the predictions that you've discussed previously for this year is that hedge funds will begin looking to use DeFi for institutional projects. What would these projects look like, and what would this mean for the space going forward and the expansion into this?
Well, there's two ways. One, they're trying to create, with partners like ourselves, a DeFi for institutional product, where it's proper KYC, AML, etc. And that's super exciting because one of the benefits that people don't realize of the decentralized finance ecosystem is the disintermediation of all the middlemen. And therefore, you can get more yield, partially just from the fact you're disintermediating people who take a piece of that reward away. The second thing that they're doing, I think, is also pretty exciting, is they're trying to figure out ways to wrap these products in a way so they can also provide it for their end user. certain operating agreements of hedge funds and VCs still don't allow you to invest in tokens directly. So they're creating unique like SPV structures and other structures that allow their end customers to participate in some of the cool stuff you see in DeFi and other things that crypto native people do.
And on one hand, there are these projects that you're talking about, and then there's also the trading that's happening in crypto. Is speculative crypto trading that's been going on, especially in the past year, alongside the meme stock frenzy that we've been seeing, is that an issue in your view? Does this create a hurdle for adoption and detract focus from these underlying projects that are taking place? Or is this just staying relatively contained in its own corner of the crypto landscape?
I think you look at the history of emerging technology, whether it be now crypto or internet stocks back in the late 90s, that speculative furor that develops around these companies really highlight two things. One, interest in users, but also the wisdom of the crowd is basically saying at some point, this is going to be here. This technology is going to be here. It may or may not be the specific companies that are existing today or back in the late 90s, but out of this group, there will be the Amazons, there will be the Googles that will pop up. So speculation is just part of any emerging technology.
So ultimately, who do you think is going to be the Amazon then, or the Google, to use that analogy? Is it going to be an existing player that you see continuing to grow and get bigger? Could it be another emerging platform that you're seeing just developing at this point? And what are going to be the features that make an Amazon or a Google, to, again, use that analogy for the crypto space?
So I think this is like the third generation of crypto already. The first generation was Bitcoin, the second generation was Ethereum, and third generation has been this new group of, call it layer ones and other crypto companies that have improved upon the previous generation of technology. It's no different from, call it Friendster, MySpace, and then Facebook. I think this group of new cryptocurrency / blockchain companies have the right timing in terms of both technology and interest from the greater populace that it's going to happen from one of these. With that said, I do believe it will be a multi-chain world. It's not going to be just one winner take all. It'd be more like kind of social media. It would be, maybe a winner take most, but then you still have a whole bunch of other dedicated specialist social media platforms out there.
All right, we'll leave it there for now. Ava Labs President John Wu, thank you again so much for your time this afternoon.
Thank you.
And that's our show for today. Thanks for joining us. Yahoo Finance Live kicks back off tomorrow at 9 a.m. Eastern. Stay with us for the best in business and financial news, and of course, crypto. Have a great night.